Hello CMA final students. I hope your preparation is going on well for upcoming December 25 exams. I believe recently uploaded International Taxation Marathon is contributing immensely for your exam preparation. So many students are asking me to do marathon on regular taxation as well. So that's why I am coming up with you CMA final Direct Taxation Marathon Part 1. In this marathon, I am covering return of income, income tax authorities, survey search and seizure, assessment procedures, appeals and revisions, trust taxation. Many students are asking me, sir, when we are reading assessment procedures, it is completely theoretical. We are getting boresome. We are not able to understand. So in this marathon, I have clearly explained all these concepts. Just listen to this marathon and do the problems efficient. Okay. And transfer pricing, assessment procedures. These two are pillars to clear CMA final DT. If you do not prepare transfer pricing, if you do not prepare assessment procedures, don't go to the exam. Because only if you prepare these two, there are high chances that you will clear CMA final DT. So this marathon will definitely contribute a lot for your success in direct taxation in upcoming December 25 exams. And this marathon is in 100% English. Listen all the concepts very lucidly explained, and you need to invest around 6.5 to 7 hours of time. That's it. You will understand all these concepts clearly. Okay, I wish you all the very best. Thank you. Let's start the marathon. So yes, students, today's live revision is about return of income and assessment procedures. Before I start with whatever the running notes that I am writing and teaching to you during the live revision series, that running notes is available in my website. So you can log into phoenixbyuma.com. You can go to free resources. In free resources, there is running notes. Yesterday, we discussed transfer pricing, right? Whatever transfer pricing running notes that I have discussed, it is available here. If you want, you can download also. Likewise, today I am teaching return of income and assessment procedures. Once the class is completed, return of income and assessment procedures running notes I will upload in my website, so you can download it from there. Okay, thank you. Now let's come into the topic return of income, assessment procedures. Two topics are there for today. First, see return of income important. Whatever the important concepts that are there in return of income from examination point of view, all those concepts I will discuss with you. Okay, and same is the case with assessment. First, I will discuss return of income. Sir, what are the concepts that you are going to cover in return of income? I am going to cover who are required to file ITR. That I will cover. Next, I will cover due dates for filing ITR. Next, I will cover loss return, belated return, revised return. Then I will cover cases where PAN is required to be quoted. Very, very important. Many times in MCQs, the question is being asked where PAN is required to be quoted. Next, I will discuss with you about updated ITR. It's also called as ITR-U. So all these topics I will discuss, I will revise from return of income chapter. Next, I will start with assessment procedures. In assessment procedures, I will explain to you first about income tax authorities. Who are income tax authorities? That I will revise. Then we will discuss what are the powers of income tax authorities. Then we will also discuss jurisdiction of income tax authorities. Then I will explain survey and search provisions. Then I will explain to you like 142(1) section. That means like department can ask written information and accounts from S. That I will discuss with you. Afterwards, I will discuss 143(1) intimation. Then I will discuss like there are three types of assessment. I will discuss scrutiny assessment. I will also discuss best judgment assessment. Then I will explain income escaping assessment. I will see if today time is there. I will explain income escaping assessment also, or else I will explain tomorrow. Tomorrow also I reserved my time for assessment procedures because it is lengthy chapter. I cannot rush. I have to revise it in a very cool way. So tomorrow also we have time. If time per income escaping assessment and block assessment. Recent amendment made in Finance Act number 2 of 2024 with effect from 1st September 2020. These two concepts I have to discuss at a stretch. That I will see if time is there today or else tomorrow I will discuss with you. Next 144C is there, dispute resolution panel. Next section 142A is there, special audit. So this much of concepts I will try to cover. If at all any extra time that we have, I will also cover additional concepts. No problem at all. If there is any pending topic in procedures today, like tomorrow also I have time, I will cover balance assessment procedures, then I will cover appeals and review. Okay. So this is just overview. So shall we start quickly with these concepts? First, who are required to file ITR? Every company and partnership firm mandatorily required to file ITR. Company and partnership firm mandatory. Whether they are having income or whether they are having loss, whether there is business, whether there is no business, everything is irrelevant. Every company, every partnership firm, every year mandatorily they are required to file income tax return. Second case, like other persons. Who are other persons? Other persons means like individual, HUF, AOP, BOI, AJP, local authority. So in case of other persons, you will calculate total income. While you are calculating total income, don't take two benefits. What are the benefits that are not to be taken? First benefit that you should not take is like chapter 6A deduction. And second benefit that you should not take is exemptions under capital gains. You know, 54, 54B, 54D, 54EC, 54F. So you will calculate total income. When you are calculating total income, don't claim chapter 6 deductions, don't claim section 54, 54B, 54D, 54C exemption. Okay, don't claim these two benefits. Before claiming these two benefits, if your total income is more than basic exemption limit, then also you are mandatorily required to file ITR. Are you able to understand? See, very simple. While you are calculating total income for the purpose of calculation of tax liability, you will calculate total income normally. But when you are calculating total income to determine whether SSC is required to file ITR or not, for the purpose of determination of filing of ITR or not, when you are calculating total income, don't take two benefits. Don't claim chapter 6 deductions, don't claim exemptions under capital gains. So before you claim, before these two deductions, before these two benefits, if total income is more than basic exemption limit, then SSE is mandatorily required to file ITR. Otherwise, SSE is not mandatorily required to file ITR. Are you able to understand? So, very simple. First, company, partnership firm, mandatorily required. Second, like in case of other persons, they are every time not required to file ITR. When they are required to file ITR, you need to calculate total income. While calculating total income, don't claim two benefits. Don't claim deductions, don't claim exemptions. Before claiming these two benefits, if total income is greater than basic exemption limit, then they are mandatorily required to file ITR. Otherwise, third point, in case of ROR, resident and ordinarily resident. You know ROR, right? Resident and ordinarily resident. So, in case of ROR, if he is beneficial owner or beneficiary of any asset located outside India, including financial interest in any entity located outside India, then they are mandatorily required to file ITR. For suppose Kohli total income is less than basic exemption. It is a very good joke, but that is our example. Kohli total income is 2 lakh rupees, which is less than basic exemption. But Kohli is having one house in Australia. Now, even though Kohli income is less than basic exemption limit, as Kohli is resident and ordinarily resident in India, if Kohli is having any property located outside India, Kohli is mandatorily required to file ITR. Are you able to understand? See, there is difference. Beneficial owner is different, beneficiary is different. Beneficial owner means what? The person who is purchasing the asset. That person we call as beneficial owner. The person who is getting benefit out of the asset, he will be called as beneficiary. Your father purchased a laptop to you. Who purchased a laptop? Your father. Your father is beneficial owner. But who is using the laptop? You are using the laptop. You will be considered as beneficiary. Are you able to understand? So that's the difference. So the thing here is not only beneficial owner of any house property, even beneficiary of house property is also required to file ITR. For example, Virat Kohli gave house property as a gift to his mother. Virat Kohli is beneficial owner, his mother is beneficiary. Now, not only Virat Kohli, his mother is also required to file ITR. Are you able to understand? So, in case of resident and ordinarily resident, if he is either beneficial owner or beneficiary of any asset located outside India, or if he is having financial interest in any entity located outside India. Let's say MS Dhoni is there. He has 0.6% equity shareholding in Apple Inc. For example, MS Dhoni total income is less than basic exemption limit, but he is having shareholding in that Apple Inc. Now he is required to file ITR. So irrespective of total income, if any person is like who is resident and ordinarily resident, if ROR is beneficial owner of any asset located outside India, or if he is having financial interest in any entity located outside India, then they are mandatorily required to file ITR. Are you able to understand? Not only beneficial owner, beneficiary is also required to file ITR. Here I wanted to discuss one note point with you. Virat Kohli gifted house property to his wife Anushka Sharma. Now, Anushka Sharma is there. You know, I think deemed ownership concept, you have an idea. You are final students, yet you should have idea about house property as per section 27 deemed ownership concept. If husband gives house property as gift to spouse, even though rental income is received by spouse, it is not taxable in the hands of spouse because husband will be considered as deemed owner. Now, in this case, Virat Kohli gifted house to Anushka Sharma. Now, rental income from that house, it is not taxable in the hands of Anushka Sharma, it is taxable in the hands of Virat Kohli only. That means what? If rental income from foreign house property, if it is already taxable in the hands of beneficial owner, again beneficiary is not required to file ITR. As income from foreign house property is already taxable in the hands of Kohli, again Anushka Sharma is not required to file ITR. Are you able to understand? So that is the concept. Once income from asset located outside India, already taxed in the hands of beneficial owner. Again, it is not taxable in the hands of beneficiary. ROR is having signing authority in any bank located outside India. Then also he is mandatorily required to file ITR. Let's say Surya Kumar Yadav is there. He is having Swiss bank account. Even though his total income is less than basic exemption limit, Sky is required to file ITR because he is having one foreign bank account. So those persons who are ROR in India and are having bank account outside India, irrespective of their total income, they are mandatorily required to file ITR. Are you able to understand? Next. Other than company and firm, remaining persons. For remaining persons in current account, You know current account, right? Generally, current account will be given for business persons. One or more current accounts. One or more current accounts. If deposits in one previous year, total deposits in previous year are more than 1 crore rupees, then also they are mandatorily required to file ITR. For suppose, like I am Umasankar, I am an individual, I started teaching CA final DT and CMA final DT. Now, down the line, I recorded lectures, I sold all those lectures, I opened two current accounts, one in SBI, another one with HDFC. Two current accounts together, whatever the receipts that I have received, if it is more than 1 crore rupees, then I am mandatorily required to file ITR even though I get losses. Are you able to understand? So other than company form, for remaining persons in one previous year, for all current accounts that are there in that particular person's name, all those current accounts together, if total deposits are more than 1 crore rupees, they are mandatorily required to file ITR. Please don't think I really did not have 1 crore rupees of receipts. Right now it is into huge losses. My investment is more than 7-8 lakhs for this venture. I did not get any amount. Hardly I got some 15,000 rupees till now. I hope in future this will escalate. Let's see. Next. In case of other persons, see, for current account limit is 1 crore rupees. I like, let's say I did not have current account, but I have savings account. If I'm having savings account, in one or more savings account, if total deposit is more than 50 lakh rupees per annum, then also I am mandatorily required to file ITR. Are you able to understand? See, many people, they are going to foreign trips, but they are not filing ITR. If they are able to go to foreign trips, do you really think their total income is less than basic exemption limit? It will be comedy, right? So those who are paying for foreign trips, okay, they are also mandatorily required to file ITR. So those who are incurring foreign travel expense more than 2 lakh rupees, this foreign travel expenditure can be incurred either for that person or for any other person. Those who are paying foreign travel expense of more than 2 lakh rupees, they are mandatorily required to file ITR. Nirmalamma came, see, people are able to pay more electricity bills. Those who are paying electricity bill of more than 1 lakh per annum, do you really think their total income is less than basic exemption limit? So Nirmalamma told those who are paying electricity expenditure more than 1 lakh rupees per annum, they are also mandatorily required to file ITR. Are you able to understand? In case of senior citizen, TDS deducted or TCS collected, if it is more than 50,000 rupees per annum, they are also mandatorily required to file ITR greater than or equal to 50,000. In case of normal citizen means those who are less than 60 years. For them, if TDS deducted or TCS collected is greater than or equal to 25,000 per annum, they are also mandatorily required to file ITR. Are you able to understand? Next, I am doing business. In my business, because of COVID, huge losses are there. Still, in my business, if I make turnover of more than 60 lakh rupees in business, if turnover is more than 60 lakh rupees per annum, they are also mandatorily required to file ITR. Are you able to understand? I am doing profession. Let's say you wrote for January attempt in March, the results came in March, immediately you started practice. Like luckily on first day of your practice, a client came and paid 20 lakh rupees audit fees. Now, like in profession, if gross receipts are more than 10 lakh rupees per annum, then also you are mandatorily required to file ITR. Are you able to understand? So this is the sum. Shall we discuss about ITR due dates? Everybody, ITR due dates. Yesterday only we discussed transfer pricing. So those SSCs for whom transfer pricing provisions are applicable and who are required to submit transfer pricing audit report, for them due date for filing ITR is 30th November of assessment year. For example, for partnership firm, transfer pricing provisions are applicable. Then not only for partnership form, like whoever the partners are there, for partners also due date for filing ITR is 30th November of assessment year. Second point, for every company other than transfer pricing. Because for company, if transfer pricing provisions are applicable, due date is 30th November of assessment year. So every company other than the company for which transfer pricing provisions are applicable, and every other person who are required to get audited under Income Tax Act, audited under section 44AB. For them, due date for filing ITR is 31st October of assessment. Here there is one point. For partnership form, if due date for ITR is 31st October, then not only for partnership form, for partners also due date for filing ITR is 31st October. Because without concluding partnership form accounts, how can you conclude individual partner accounts? So for individual partners also due date for filing ITR is 31st October. For other persons, due date for filing ITR is 31st July of. So are you able to understand three due dates? To whom transfer pricing provisions are applicable, due date is 30th November of assessment year. For partnership firm, if transfer pricing provisions are applicable, due date is 30th November. For every company other than the company to whom transfer pricing provisions are applicable, and for remaining persons who are required to get audited under section 44AB, for these category of persons, due date for filing ITR is 31st October. For a partnership firm, if tax audit is applicable, then due date for partners also for filing ITR is 31st October. For remaining category of persons, due date is 31st July. Sir, what if ITR is not filed within the due date? ITR not filed within due date. Then many consequences are there. First is late fees will be levied under section 234F. If total income is less than or equal to 5 lakhs, late fees is 1000 rupees. If total income is more than 5 lakhs, late fees is 5000 rupees. Able to understand? So this is the. I hope you are clear with who are required to file ITR and what are the due dates. Now shall I proceed further? Next we are going to discuss loss return. 139.3 loss return. Give me 1 second. See, if you want to carry forward losses to subsequent years, you are mandatorily required to file ITR. House property loss, unabsorbed expenses. These two, even though ITR is not filed within due date, still these two losses can be carried forward to subsequent years. But whatever business loss, capital loss, and loss from owning and maintaining resources, these three losses, if you want to carry forward to subsequent years, then mandatorily you should file ITR, and that ITR also to be filed within due date. See, two conditions. You should file ITR. You cannot file ITR after due date. Only if you file ITR within the due date, then only you can carry forward these losses. Otherwise, you cannot carry forward these losses to subsequent years. Are you able to understand? So, whatever the losses, business losses that can be speculative, specified, non-speculative, any type of business loss, capital loss that can be long-term capital loss or short-term capital loss, loss from owning and maintaining resources. If you want to carry forward these losses, mandatorily you are required to file ITR, that too within the due date. Next, restriction is on carry forward but not on set off. What do you mean by this? Let's say you have a house property income 8 lakhs and there is business loss 14 lakhs. You filed ITR after due date. Now, can you do set off? Yes, set off is permitted. After setting off, how much is business loss? Business loss is 6 lakh rupees. Now, can you carry forward this business loss? You cannot carry forward. That means what? Restriction is not there on current year set off. Even though you file ITR after due date, still in current previous year, you can do set off. But if you want to carry forward to subsequent years, then mandatorily you are required to file ITR with the due date. Are you able to understand? Previous year 23-24. Okay, like let's say there is business loss 10 lakhs, ITR filed within due date, filed within. In previous year 24-25 there is business income 25 lakhs but ITR filed after due date. So in 24-25 ITR is filed after due date. Now can you carry forward and set off 10 lakh rupees? Yes, you can carry forward and set off 10 lakh rupees because the year in which loss is incurred, in that year you need to file ITR within the due date. The year in which you are setting off the loss, in which year you are setting off the loss, in 24-25 you are setting off the loss. So in the year in which you are setting off the loss, even though you do not file ITR within the due date, still you can carry forward and set off. So the criteria is the year in which you incur the loss. In that year, you have to file ITR within the due date. In the year of set off, even though you do not file, still you can carry forward and set off. Are you able to understand? Sir, what are the, like, due to unfortunate scenarios, due to health issues or medical issues, or there is a fire in the factory, all books of accounts were burnt, we could not file ITR within the due date, but there are losses. Now, after due date also, can you carry forward these losses? Yes, after due date also, you can carry forward these losses. Are you able to understand? Sir, after due date, how can we carry forward those losses? You have to make application to income tax authority. After you make application to income tax authority, then income tax authority will condone your delay in filing ITR. For example, 31st July is my due date. But before 31st July, I could not file ITR. My factory got fire, entire books of accounts were burnt out, but I filed ITR on let's say 15th September 2025. Now I filed after due date, but there is loss of 125 lakhs. 125 lakhs is very huge, right? I want to carry forward to subsequent years. How can I carry forward to subsequent years? I need to make application to income tax authority. If there is genuine reason, income tax authority can condone the delay and income tax authority will allow you to carry forward the loss to subsequent years. Sir, to which income tax authority we need to make application? Here there is amendment. Listen very carefully. Before 1st October 24, on or after 1st October 24. Before 1st October 24, if your loss is up to 50 lakhs, then you need to make application to CIT or PCIT. If your loss is more than 50 lakhs and up to 2 crore, you need to make application to Chief Commissioner of Income Tax. If your loss is more than 2 crores and up to 3 crores, you need to make application for Principal Chief Commissioner of Income Tax. If your loss is more than 3 crore rupees, then you need to make application to CBDT. However, from 1st October 2024, there is amendment. If your loss is up to 1 crore rupees, you can make application to CIT or PCIT. If your loss is more than 1 crore and up to 3 crore, you need to make application for Chief Commissioner of Income Tax. If your loss is more than 3 crore, then you need to make application for Principal Chief Commissioner of Income Tax. Now from 1st October 24 onwards, there is no concept of application to CBDT. Okay, again CBDT means confusion. In CBDT, many people are there to whom you need to make application. Okay. So I hope you understood loss return. Now shall I explain belated return and revised return? Till here, are you clear? Leave the comment. Not a hurry. Tomorrow also we will discuss assessment procedures. If you want any extra concepts specifically to be taught, comment today at the by the end of the session. I will discuss those concepts also with you in tomorrow's. Shall I proceed further? Are you there, people? Now, section 139(4), belated return. See, you forgot to, you are so busy in your CA final preparation. There is your best friend, you forgot to wish your best friend on his birthday. Now what will you do? You will call him after the birthday is over. You will tell, "Arey mama, I forgot to wish you because I was busy in my CA final," and you will wish him lately. You will tell belated happy birthday. Okay, same is the case. If you do not file ITR within the due date, if you are filing ITR lately after the due date, then that return we call as belated return. Are you able to understand? Sir, we can file ITR lately, but can we file ITR of 2004-5 now? Not possible. Even to file ITR lately, there are time limits. Within those time limits only, you can file ITR lately. Sir, then what is due date for filing belated return? Due date for filing belated return is 3 months before completion of assessment year or date of completion of assessment, whichever is earlier. What do you mean by this? 3 months before completion of assessment means 31st December of assessment year or date of completion of assessment, whichever is earlier. Within that time only, you can file belated ITR. After, after this due date, you cannot file belated return. In that case, you can file ITRU, which we will discuss little later. Okay. So to file ITR lately, there are time limits. Due date is 31st December of assessment year or date of completion of assessment, whichever is earlier. Sir, what if I file belated return? Just now we have discussed. If you file ITR lately, you cannot carry forward business losses. You cannot carry forward capital losses. You cannot carry forward losses from owning and maintaining resource. At the same time, you cannot claim deduction under section 10AA. You cannot claim income based deductions. There are some income based deductions, 80IA to 80RRB. Those deductions also you cannot claim if you file ITR after the due date. Next, late fees we have discussed. If you file ITR after due date, if total income is more than 5 lakh, late fees 5,000. Total income less than 5 lakh, late fees is 1,000 rupees. Now, if you file ITR after the due date, you are required to pay interest under section 234A. That also I will discuss with you. Advance tax and interest one concept is there. In that I am going to discuss with you how to calculate interest under 234A. Next, see, if sometimes department will pay refund to you. If there is refund, then on that refund, interest will also be paid by department. So while calculating the interest, generally interest will be calculated from 1st April of assessment year, but if you file ITR after the due date, your interest on refund will not be calculated from 1st April of assessment year. It will be calculated from actual ITR due date. Okay, so these are all the consequences if you file ITR. Are you able to understand? Next, shall I explain revised return 139.5? See, doctor is there. He need to do surgery for right kidney, but he forgot, like, he had an argument with his wife. After argument with wife, he came to operation theater. Instead of doing operation for right kidney, he did operation for left kidney. Okay, now it is a huge thing. Okay, He is playing with the lives of the patients. Chartered accountant is there. He did some mistake in filing ITR. What will happen? We will file revised return. Okay. So if you make any mistake while filing ITR, okay, all those mistakes you can rectify by filing the revised return. So, sir, how many times a revised return can be filed? Revised return can be filed n number of times. You can file 20 times, 30 times, 40 times. You can revise it as many times as you can. Whatever the latest revised return is there, that will be considered as final return. Sir, can loss return be revised? Yes, loss return can be revised. Sir, whether original return filed under 139(1), can it be revised? Yes, it also can be revised. Sir, belated return was filed. Can belated return be revised? Yes, belated return can also be able to understand. How many times? You can revise it n number of times. Sir, is there any time limit? Yes, there is time limit. Whatever the due dates that are there for belated return, same due dates are applicable for revised return also. Are you able to understand? So same due dates. Same due dates are applicable for revised return also. Like that means revised return can also be filed before 31st December of assessment year or before date of completion of assessment, whichever is here. Are you able to understand? That's the concept relating to revised return. Next, there is one concept intimation which I will discuss with you in this class only. Intimation under section 143(1). Even if you receive intimation under section 143(1), still you can file revised return because intimation is not completion of assessment. It is calculation made by department. So after receiving intimation under 143(1) also, still you can file revised return. Able to understand? Now, we discussed the trust taxation. Do you remember trust can claim exemption under section 11, 12? So total income of trust before section 11 and 12 exemption. 11 and 12 exemption. If the total income is more than basic exemption limit, then trust is mandatorily required to file ITR. If trust do not file ITR, like penalty will be levied 500 rupees per day. Are you able to understand? Similarly, political party is there. Generally, political party will claim exemption under section 13A. So, total income of political party before exemption under section 13A. If the total income is more than basic exemption limit, then political party is also mandatorily required to file ITR. Able to understand? Next, there are certain institutions for whom exemption is given under section 10. Before claiming that exemption, if their total income is more than basic exemption, then also they are mandatorily required. Next, we will discuss cases where PAN is required to be quoted. This is very, very important. So this is you can see quoting of PAN is mandatory. Quoting of PAN is mandatory. When is mandatory? If you are purchasing any motor vehicle other than two-wheeler vehicle, that means what? Auto, three-wheeler, four-wheeler, other than two-wheeler, other than bike, remaining any motor vehicle if you purchase, then you are mandatorily required to give PAN number. Only if you give PAN number, that vehicle will be sold, otherwise vehicle will not be sold. Next, if you are opening any account with bank other than basic savings account and time deposit account, you wanted to open FD, only if you give PAN number, then only FD account will be opened. You wanted to open current account, only if you give PAN number, then only current account will be opened. Next, if you want to make application for debit card or credit card, so if you want any debit card or credit card, mandatorily you are required to give PAN number, otherwise debit card and credit card will not be issued to you. Similarly, if you want to open demat account, you know demat account, right? You can purchase listed shares and securities through demat account. For opening demat account also, PAN is mandatory. Next, you went to hotel or restaurant. In articles you are all going to hotels, right? So for like per bill, if you are making cash payment of more than 50,000 rupees, very 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 important, because students will forget in the examination. They will think any payment more than 50,000 rupees PAN is required to be quoted. That is not correct. Only if cash payment per bill is more than 50,000 rupees, then only they are mandatorily required to give their PAN number. So what will we do? We will split the bill. We will ensure each day bill is less than 50,000 rupees, and we will give it in cash. We do not give PAN. Okay. See, you will purchase foreign currency, right? You will go to foreign exchange dealer. Let's say you went with 40 lakh rupees cash. You gave 40 lakh rupees cash. You wanted dollars. So when you are making cash payment of more than 50,000 rupees for purchase of foreign exchange, foreign currency, then also you are mandatorily required to give PAN number. Similarly, when you are purchasing units of mutual fund and amount paid for units of mutual fund, that can be either cash or in the form of bank. If the amount paid is more than 50,000 rupees, then also you are mandatorily required to give PAN number. Next, when you are purchasing debentures or bonds from a company, if the amount of debentures and bonds is greater than 50,000 rupees, the payment made for purchase of debentures or bonds is more than 50,000, then also you are mandatorily required to give PAN number. Next, if you are purchasing any bonds issued by RBI, then limit is 50,000 rupees. You know, right? If you go to any bank, you wanted to do cash deposit. If you want to do cash deposit of more than 50,000 rupees, they will definitely ask your PAN number. Only if you give PAN number, then only they will accept cash deposit. That's why in public, like in ATMs, there is cash deposit machine also. But in that cash deposit machine, you cannot deposit more than 50,000 rupees because of this reason. Because if bank is accepting more than 50,000 in cash, it should take PAN number. That's why in cash deposit machines also, you cannot deposit more than 50,000 rupees. Similarly, withdrawal, if you want to withdraw more than 50,000 cash from bank, then also you are mandatorily required to give PAN number. What is the loophole? Every day I will withdraw only 49,000 rupees. In that way I can escape. Okay. If you want to deposit, open time deposit with banking company, cooperative bank, post office, Nidhi company or NBFC. Nidhi company is also kind of NBFC only. So if amount of deposit is more than 50,000 per transaction, or for all transactions if amount of deposit is greater than 5 lakhs per annum. So any one of the condition, per transaction more than 50,000 or all transactions together you deposited more than 5 lakhs, then also you are required to give PAN number. Whenever you purchase prepaid instruments, then also like for purchasing prepaid instruments, if you deposit more than 50,000, then also you are mandatorily required to give PAN number. Life insurance premium, this is a generic point. I also pay life insurance premium. If I like, they asked me my PAN number. So whenever you pay life insurance premium of more than 50,000 rupees, then they will definitely ask for PAN number. PAN is required to be quoted. Similarly, like unlisted shares, whenever you are buying and selling unlisted shares, and if the amount is more than 1 lakh per transaction, like you have practical experience of filing ITR, right? So whenever there is buying and selling of shares, you need to file ITR 2. Similarly, for company also, we need to file ITR 6. Okay. So when we are filing ITR for company as well as whenever there are capital gains, we need to give our PAN number if the amount of transaction is more than 1 lakh rupees. Okay. So while you are filing return of company, you need to give information about shareholders. Like whoever the shareholders that got exited from company, whoever the shareholders newly joined, their PAN number is also required to be given. Then only ITR will be processed. In like this is residuary 18. So in any other case, either for buy like for sale of goods or services, let's say you went to gold shop and you purchased gold more than 2 lakh rupees. He will ask your PAN number. then you have to tell divide it into two bills, each bill is less than 1 lakh rupees. Are you able to understand? So in any other case, if you are accepting for any transaction, if the transaction accepted is more than 2 lakh rupees, then also you are mandatorily required to give your PAN number. So another guy came, hi. Sir, what if PAN number is not given? If PAN number is not given, then penalty of 10,000 rupees will be levied. Next, I will discuss with you ITRU. Technically, government made PAN mandatory to everyone these days. Yes, of course. Otherwise, how can income tax department trace? So income, wherever PAN is given, information will be passed on to income tax department, so it can catch you. Okay. Next, see, remaining small concepts are there. You can read. If you have any doubt, ask me, because as we are having less time in revision, to the extent possible, I am doing revision for important concepts. Now, ITRU 139.8A. See, maximum you can file belated return up to 31st December of assessment year. Am I correct? Let's say previous year 24-25 is there. What is the maximum time that is available to file ITR of 24-25, 31st December of assessment year? Sir, after 31st December of assessment year, can you file belated return? You cannot file belated return. Can you file revised return? You cannot file revised return, but you can file ITR updated. So for how much period? Let's say end of assessment year is 31st March of assessment year. From end of assessment year, for next 24 months, you can file ITR. If you file ITRU after 31st December of assessment year and before 12 months from end of assessment year, then penalty of 25% will be levied. If you file ITRU after 12 months from end of assessment year but before 24 months from end of assessment year, then the penalty is 50%. In 25-26, like to file ITRU, 4 years time limit was given. Okay. Sorry, in a flow I told, please don't remember this. For you this is not applicable. For you only 2 years from end of assessment. Okay. Sir, who can file ITRU? See, originally you filed loss return. Now, can you file ITRU? Yes, you can file ITRU, but whatever the ITRU is there, in that ITRU, you should show income. Okay, then only you can file ITRU, otherwise you cannot file ITRU. So, originally, like income is 10 lakh rupees. As per ITRU, income is 8 lakh rupees. Can you file ITRU? Not possible. That means what? And ITRU is entirely in favor of department. Because of ITRU, if your income decreases, or if your loss increases, or if your refund increases, then you cannot file ITRU. Are you able to understand? So your income is 10 lakh rupees. As per ITRU, your income is 15 lakh rupees. Can you file ITRU? Yes, you can file ITRU. Like as per original return, loss is 8 lakh rupees. As per ITRU, there is income of 2 lakh rupees. Can you file ITRU? Yes. Because from loss, you are coming into income. There is decrease of loss. Loss is 8 lakh rupees. Here, loss is 10 lakh rupees. Can you file ITRU? Not possible. Cannot file ITRU. Similarly, as per original return, refund is 6 lakh rupees. Now, refund is 8 lakh rupees. Can you file ITRU? Not possible. Refund is 6 lakhs. As per ITRU, refund is 4 lakhs. Can you file ITRU? Yes, file ITRU. So, very simple. Because of ITRU, if your income increases and tax liability increases, if your loss decreases, if your refund decreases, in all these cases, you can file ITR. Are you able to understand? So this is the simple concept. Next, because of ITRU, if any earlier year income changes, then also you cannot, then also you need to file ITRU of earlier years. Wait, one comment. Original return loss was 20 lakhs, but ITRU loss was reduced to 2 lakhs. Is it possible to file? No, it is not possible to file. See, originally you filed loss return. Now you wanted to file ITRU. Now definitely you should show income. Then only you can file ITRU. I told here na. Definitely you should show income. That means doubt asked is loss here is loss here is 8 lakhs. Now you wanted to show loss of 2 lakhs. Can you file ITRU? You cannot file ITRU. That's how the provision is. Whenever there is loss return, mandatorily you should show income. Then only you can file. Okay. Yeah, refund is also not possible through ITRU. Uh, I will tell one example. In previous year 22-23, your business income is, let's say there is business loss 8 lakh rupees. In 23-24, your business income is 20 lakhs. You have done set off and your income is 12 lakh rupees. In previous year 24-25, you wanted to file ITRU of previous year 22-23, and as per ITRU, you disclosed your income is 3 lakh rupees. That means what? This business loss 8 lakh rupees you are avoiding, and you filed ITRU. As per ITRU, you disclosed total income of 3 lakh rupees. Now, for 22-23, you filed ITRU, you disclosed income of 3 lakh rupees. For 23-24, then this set off is also not allowed. Na? Your income is 20 lakhs. Na? So for this, either you need to file belated return or you need to file ITR. Are you able to understand? Because of filing ITRU of 1 year, if it is having impact on further years, for further years also you need to change the return. Either you need to file ITRU or you need to file belated. Are you able to understand? Sir, can we update ITRU? Let's say I filed ITRU, I disclosed income 8 lakhs. I made mistake in this. Can I revise ITRU by filing another ITRU? That is not possible. ITRU cannot be updated, ITRU cannot be revised. Similarly, like if search is conducted in your place as per section 132, or if your books of accounts are requisitioned from another department of government under section 132A, in that case also you cannot file ITR. Okay. So this is the concept broadly relating to ITRU. So till here we discussed about return of income. Now shall I shift to assessment procedures? Interesting part. This is over. Now we will shift to assessment procedure. So are you clear with return of income? Shall I proceed with assessment procedures? Everybody. Interesting. Whatever the doubts that you are having, please ask, because this is such a chapter. Now, let's start. First of all, we will discuss income tax authorities. Unless we revise income tax authorities, you do not completely understand the assessment. So first, we are going to revise income tax authorities. Now, see, there is Ministry of Finance, right? Under Ministry of Finance, there are two departments: Department of Revenue, Department of Expenditure. Under Department of Revenue, there are two further departments: CBDT, CBIC. You know, for direct taxes, Central Board of Direct Taxes; for indirect taxes, Central Board of Indirect Taxes and Customs. Under CBDT, there are another two wings. Those are Assessment Wing and Investigation Wing. Who are there under Assessment Wing? Under Assessment Wing, like सबसे बड़ा authority is Principal Chief Commissioner of Income Tax. Who is the top-notch authority? Of course, top-notch authority is CBDT, but under Assessment Wing, the top authority is Principal Chief Commissioner of Income Tax and Chief Commissioner of Income Tax. See, Principal Chief Commissioner, both are of equal rank. Both hold same powers, except in one or two cases. We discussed in loss return. Okay, if loss is up to 3 crores, you need to make application to Chief Commissioner. More than 3 crores, you need to make application to Principal Chief Commissioner. Likewise, minor powers difference is there, but more or less, Principal Chief Commissioner, both are of equal rank. Are you able to understand? Next, under them, there will be Principal Commissioner of Income Tax or Commissioner of Income Tax. Okay, under them there will be Additional Commissioner of Income Tax. There will be Joint Commissioner of Income Tax, JCIT. Under them there will be Assistant Commissioner of Income Tax or Deputy Commissioner of Income Tax. Under them there will be Income Tax Officer, we call as ITO. Under them there will be Tax Recovery Officer, we call them as TRO. Under them there will be Inspector of Income. Now, see, Additional Commissioner, Joint Commissioner, Assistant Commissioner, Deputy Commissioner, ITO, all these four, my god, I have drawn rectangle. All these four we call as Assessing Officer. Assessing Officer. Assessing Officer. Okay, these three category of people we call as Similarly, there is investigation wing na. Under investigation wing, सबसे बड़ा authority is Principal Director General of Income Tax and equal authority Director General of Income Tax. Under them there will be Principal Director of Income Tax, Director of Income Tax. Under them there will be yes, Additional Director of Income Tax, Joint Director of Income Tax. Under them there will be Assistant Director of Income Tax. Next, Deputy Director of Income. Even these are also considered as assessing officer. Okay, additional director, joint director, assistant director, deputy director will also be considered. See, I am giving one nickname. These two I call as bosses. These two I call as top bosses. Because down the line we are going to study survey, search, various provisions. We need to take like department is required to take prior approval. So whenever prior approval of commissioner or principal commissioner or director or principal director is required, I will tell boss's permission is required. Whenever the permission of Principal Chief Commissioner, Chief Commissioner, Principal Director General, their permission is required. I will tell the permission of top bosses is required. Okay. See, assessing officer, what assessing officer will do? Assessing officer will do assessment. There are basically three types of assessment. There is 143.3 scrutiny assessment. It is also called as regular assessment. 144 best judgment assessment. 147 income escaping. What they do after doing this assessment, they will pass assessment order. This assessment order can be challenged in CIT appeals. So whatever the assessment order is there, that can be challenged either at CIT appeals or JCIT appeals. CIT appeals, JCIT appeals, they are not outside, they are within income tax department. So CIT appeals, JCIT appeals also we can call as income tax authorities. They are also called as income tax authority. They are also part of department. They are not outsiders. Inside the department only, there is separate one judicial authority that we call as CIT appeals or JCIT appeals. My dear students, please remember CIT appeals, JCIT appeals, they are not assessing officers. Okay, they are income tax authority, but they are not assessing officer. There are some faculties who are telling you wrong in the market. CIT appeals, JCIT appeals, they are not assessing officers. They are income tax authority, but they are not assessing. Okay. Now, all these together, TBDT, assessment wing, investigation wing, all these together, including CIT appeals, JCIT appeals, we call these people as income tax. Okay. Sometimes in MCQ they may ask. Next, see, I file appeal in CIT appeals, JCIT appeals. I will lose. What is next remedy? I will go to ITAT. Okay. In ITAT also I lost. Where will I go? I will go to High Court. In High Court also I lost. Where will I go? I will go to Supreme Court. In Supreme Court also I lost. I will go to international court. Okay, is it possible? I cannot go to international court. If I lose in Supreme Court, I have to come back home and sleep. Okay, I cannot go to international court. So these three people are there na. ITAT, High Court, Supreme Court. These are not income tax authority. Are you able to understand? So I hope you understood the concept of income tax authorities. Did you understand? Next, whoever the income tax authorities is there, for them the jurisdiction will be determined. Jurisdiction. The jurisdiction will be determined either on territory basis. Territory means what? Pin code. Okay. For example, for Amirpet, one assessing officer is there. For Vanastalipuram, another assessing officer is there. That means they are dividing the powers based on, like they are defining the jurisdiction based on pin code, based on territory. That is one type. Or it can be determined based on person or classes of persons. For example, for all companies, one assessing officer is there. For all trusts, one assessing officer is there. That means assessing officer jurisdiction can be defined by CBDT based on persons also. Based on class of income. What do you mean by class of income? For all those who are getting salary income, for them one assessing officer will be there. For all those who are getting profession income, for them one assessing officer is there. For all those who are getting house property income, their cases will be dealt by one assessing officer. That means jurisdiction can also be determined based on class of income. Last one, cases or classes of cases. That means what? In Hyderabad, like real estate is very much. So department wants to target those who are into real estate. For only dealing with real estate, separate assessing officer can be appointed by CBDT. In that way also jurisdiction can be. Okay. See, let's say I am income tax authority. I am commissioner of Amirpet jurisdiction. Those who are residing in Amirpet, for them I can give notices. For them, I can issue summons. I can ask them to come to my office and meet me in person. Those who are having business in Amirpet, okay, against those business, those who are running profession in Amirpet, against those people also, I can issue notices. I can take action. In Amirpet, there is one company, My3 okay, that company is having branches in 3-4 cities. If any company is having principal place of business in my Amirpet jurisdiction, okay, then with regard to that company, whatever the branch offices are there, I can also take action with regard to those branch offices, even though they are not in my jurisdiction, because principal office is there in my jurisdiction. Are you able to understand? So assessing officer can take action against those who are residing in his jurisdiction, those who are doing business or profession in their jurisdiction, those who are having principal place of business in their jurisdiction. Against these people, assessing officer can take action. Next, what are powers of income tax authority? Like income tax authority can do discovery and inspection. That means what? Whatever my jurisdiction is there, in that jurisdiction, I can go to any place, I can do inspection, I can do verification, like subject to approval given by bosses or top bosses. After taking their approval within my jurisdiction, I can do verification, everything. Okay, I can do discovery, I can also inspect various people that are there in my jurisdiction. Second, I can enforce attendance of any person, and I will take him on, I will take oath from him. Okay, that means what? Let's say, like during income tax proceedings, I am suspicious about one person, he is in my jurisdiction. I will call him to my income tax office, I will take oath from him. Okay, whatever he is saying, it is genuine or not, I will take oath. Next, third, I can issue summons. Sir, what is summon? Summon means what? If I issue summon, definitely that person is required to come to my office and he should meet me in person. See, I can give notice, I can also give summon. What is the difference between notice and summon? If I give notice, either SSC will come or SSC's legal representative will also come. But if I give summon, SSC himself, he need to come to my office. So whenever like department has, like assessing officer has power to issue summons, to whom the summons are given, they are mandatorily required to come to the assessing officer and meet him in person. Next, what's the next power? Yeah, next power is impounding books of accounts. That means what? I can go to any premises in my jurisdiction, I can impound books of accounts, but prior approval of joint commissioner is required. Maximum I can impound books of accounts is for 15. So these are all the powers of income tax authority. Next, let's say I am doing as like I am assessing officer of Amirpet jurisdiction. I got shifted from Amirpet jurisdiction to Malkazgiri jurisdiction. Now, what is the scenario? Whenever I go to Malkazgiri jurisdiction, there is another income tax officer with the name Varun. Varun replaced my position. Now, Varun will start again doing assessment from the beginning. Varun will not start doing assessment from the beginning. Wherever I left the assessment, from that point only, Varun will start doing the assessment. But before he start the assessment, he will give opportunity of being heard to the bosses are there na, CIT, PCIT, CCIT, PCCIT. Okay, bosses have power to like change assessing officer from one jurisdiction to another jurisdiction. I am doing I am income tax officer in Amirpet. Boss came to know I am doing I am taking bribes in Amirpet. Boss can immediately shift me from Amirpet jurisdiction to Malkazgiri jurisdiction. Okay, so bosses have power to shift assessing officers from one jurisdiction to another jurisdiction. Okay, So this is the concept relating to income tax authority. Now we will discuss survey. Shall we discuss survey? Everybody, survey and search I will discuss now. Very, very, very important. You cannot ignore survey and search at all. Shall I discuss survey? Everybody, I can understand this chapter is boring, but you have no option. You have to listen, you have to internalize, you have to revise, you have to get marks in the exam. That's the only option. Okay. Naresh is saying hi. Hi, Naresh. మీరు జోక్స్ వేస్తూ చెప్పండి. See, this is not regular class. If it is regular class, we would have had full entertainment. This is revision class. I need to cover plenty of sections. You know assessment procedures, how many sections are. At the same time, I cannot rush. If I bring comedy into this revision series, the class will like anything. Oh, Divya. Okay, let's start. Power of survey. See, if department wants to do search under section 132, then they need to have prior information. Only based on prior information they can do. But to do survey, prior information is not required. If income tax department feels suspicious about any person, that's it. They can go and they can do the. So, like income tax department, income tax authority can go to any place of business or profession, or it can go to any place where charitable activity is going on. And they can do survey. They can go to any place within their jurisdiction. Assessing officer within his jurisdiction, he can go to any place of business or any place of profession or any place where charitable activity is going on, and he can do survey over there. But prior approval of top bosses. Top bosses means chief commissioner, principal chief commissioner, director general, principal director general. Prior approval of top bosses is required. That means only with prior approval of top bosses, like survey can be done. Once upon a time, this prior approval of top bosses, this provision is not there. What happened? Every small income tax officer, he is taking advantage of section 133. Okay, he is misutilizing the section. He went to one shop, like for refrigerator, he purchased a refrigerator 40,000 rupees. He asked shop owner to reduce the price to 22,000 rupees. Okay, shop owner said no. Immediately he started doing survey. So it has become like every income tax officer is taking advantage of 133 survey. So that's why lawmakers made the amendment. They said only with prior approval of top bosses survey can be done. So like income tax authority, nothing but assessing officer, additional commissioner, joint commissioner, assistant deputy commissioner, income tax officer within their jurisdiction. They can go to any place of business or profession, and they can go to any place where charitable activity is going on, not religious activity. That means what? Let's say I am income tax officer of Amirpet. In Amirpet, there is one temple, Gandi Maisamma temple. I wanted to do a survey of Gandi Maisamma temple. Can I do? I cannot do. I can visit only place of business or profession, or I can visit any place where charitable activity is going on. I do not have power to visit place where religious activity is going on. Are you able to understand? Prior approval of top bosses is required. Sir, what they will do in survey, once they come to survey, like they will count the physical cash. After counting physical cash, they will compare physical cash with cash that is there in books of accounts. Next, second point, they will count the stock in trade. They will count the inventory. After counting the stock, they will compare the stock with books of accounts. Next, like if they want any documents, they can go through all the documents, they can take printouts, they can take extracts of all the documents, whatever the documents they wanted, they can take printouts. Next, like suddenly income tax department came to survey for my office. I maintained one cash book. Now after they go back, I will tear off that cash book, I will bring new cash book. Chances are there na. So what department will do when they are doing survey, they will keep identification marks. Whenever department comes again, I should show the same cash book with same identification mark. Okay, so department also have power to keep identification marks during for my books of accounts. Okay, so they will verify cash, they will verify stock, compare with books of accounts, they will take printouts, they will take extracts, they will keep identification marks. They also have power to impound books of accounts. Impound books of accounts means what? My books of accounts will be taken by income tax department, but maximum they can impound books of accounts for 15 working days, not 15 days. Whatever the working days are there, for 15 working days income tax department can impound my books of accounts. And what income tax department will do, it will prepare statement of inventory. Here inventory means not stock, whatever the gold, jewelry, arts, and whatever the costly items that are there in my business, all of them they will prepare list. What are all the jewelry that I am having, what are the gold, whatever the precious metals that I am having, whatever the assets that I am having, whatever the stock that is there, whatever the cash that is there, they will prepare statement of inventory. See, under survey, they do not have any power to impound assets. They have only power to impound books of accounts. Impound means what? Seizing. Okay, taking away the books of accounts, but they do not have any power to take away the assets. Are you able to understand? Even books of accounts also they can impound maximum for 15 working days. After 15 working days, they should give back. Sir, is there any possibility that they can impound after 15 days also? Yes, they can impound after 15 days also, but prior approval of bosses or top bosses is required. That means income tax officer wants to retain books of accounts as per section 133, or even after 15 days he need to take prior approval of bosses or top bosses, then only allowed, otherwise it is not allowed. Sir, survey will be done as per section 133. Now I am teaching class to you, time is 8:20. Now can they come and do survey in my place? Is there any time limit? Yes, there is time limit to do the survey. What is the time limit to do the survey? If they want to do survey at a place of business or profession, then they can enter only during business hours. They can enter only during business hours. Let's say I am into coaching business. I kept my timings as morning 7 to night 9. Now time is 8:20 only. Time is not 9. They can come and do survey of my place of business. Are you able to understand? Five-star hotel is there. It runs all 24/7. They can do survey of five-star hotel at any time. Pub is there. It is not available in the morning. Pub is available after like evening 8 to morning 3 o'clock. Now, if they want to do survey of pub, they can do in between 8 to 3. Are you able to understand? So, whenever the place is open for business or profession, only during business hours, they can enter and do the survey. Very, very important. Restriction is only for entrance. Restriction is not for exit. They can come now. Okay, at 8:20, they can start doing the survey and they can leave at 12 p.m. also. If they leave at 12 p.m., no problem at all. Restriction is there only for entry. Restriction is not there for exit. Are you able to understand? At the same time, like whenever they are doing survey, they cannot do overnight. Okay. At some point of time in the night, they should stop survey. They should go back and tomorrow they should start. They do not have any power to do survey overnight. Power to do proceedings overnight is available only under. Okay. Now, there is one client with the name DLF Limited. Mr. Uma is auditor of DLF Limited. Okay. In fact, I am not the auditor. Now, don't spread buzz rumor about me. Okay, I am not the auditor. But in my example, I can take the way I wanted, right? So let's say Mr. Uma is auditor of DLF Limited. Entire books of accounts of DLF Limited are available in my office. That means what? Like I took management consultancy. I am maintaining entire books of accounts of DLF Limited in my office. Now, income tax authority, they have power to do survey in my office. Able to understand? Or books of accounts of company are there in the home of the director. Can they do survey at the home of the director? Yes, they can do survey at home of the director. But whenever they are doing survey at place other than place of business or profession. See, DLF Limited place of business is Delhi, but I am maintaining books of accounts in Vijayawada. Now, like department wants to do survey at my place. So this is not place of business. So they need to enter my premises only after sunrise, but before sunset. Are you able to understand? So other than, if they want to do survey at other than place of business or profession. Other than place of business or profession means what? At director place or CA office. If they wanted to do survey, then they can do survey. They can enter only after sunrise, but before sunset. For example, like I have studio in one room, I have office in another room. Now they wanted to do survey, office is closed, studio is running. They wanted to do survey of office. Can they do survey? They cannot do survey because like mine is CA office, I am maintaining books of accounts of DLF Limited. My place is not place of business of DLF Limited. So now they cannot do survey. If they wanted to do survey, they should come tomorrow morning after sunrise. Are you able to understand? So other than place of business or profession, if they wanted to do survey, they should come after sunrise but before sunset. Are you able to understand? I hope you are understanding. I believe we both are in sync. Am I correct? Next. Income tax authority also have power to do survey at function. See, you can see so many lavish people. Okay, for function only they will spend crores of rupees. Now, can they do survey at place where function is going on? They can do survey, but only after completion of function. During the course of function, they cannot do survey. If during the course of function, if income tax officer can do the survey, if that power is given to income tax officer, then what will happen? Let's say there is one guy, he got broke up. He is having breakup with his girlfriend. His girlfriend is marrying some other person. Now what this guy will do? This guy will call to income tax officer, sir, their lavish expenditure is being spent on that wedding, and then he will give information to department will go and do the survey, department will stop the marriage. Okay, that is risky na. That is like they will come against income tax department. So it becomes a loophole. That's why that power was not given. Income tax authority can do survey at the function, but during the course of function, they do not have any power to do the survey. Only after the completion of function, they can do the survey. Are you able to understand the concept? Otherwise, you know, you all can use it as a loophole. Next, there is another concept, TDS and TCS survey. Under TDS or TCS survey, department can come to your office. It can verify all books of accounts. Under TDS TCS survey, what they will do, sir? They will check whether you deducted TDS or not. They will check whether deducted TDS is deposited to government or not. They will check whether TDS returns are properly filed or not. They will verify only three aspects: whether TDS deducted or not, whether deducted TDS is deposited to government or not, whether I TDS return was properly filed or not. Under TDS TCS survey, like books of accounts, they do not have any power to, no power to impound books of accounts. They cannot uh, impound books of accounts. They cannot verify assets. They cannot verify cash. They cannot verify inventory. They can only do inspection of TDS and TCS particulars. Gali Niranjan Rao, SAR block assessment. I hope you are there from the beginning. At the beginning of the session, I gave clarity about block assessment. So this is the concept relating to survey under section 133. Now shall we start discussing search under section 132? Interesting part. Section 132, search. Shall we discuss, everybody? First question, sir, when search will be conducted? First of all, in two cases, search will be conducted. Case 1, SSE did not file ITR, ITR not filed. I'm sorry, hold on. Notice under section 142(1) is issued, but SSE is not giving any response, no response. Sir, what is notice under 142(1)? If you do not file ITR within the due date, then department will give notice under 142(1) and it will ask you to file ITR. Or if department wants any extra information and accounts, it can ask that information by giving notice under 142(1). Department gave you notice, but you are not responding to the department. You are not responding to notice given under 142(1). Similarly, department issued summons. Summons means I already said you need to physically go to income tax department. Department already issued summons, but you are not coming to income tax department. You are not complying with those summons. In these two cases, department can do search under section 132. Next, case 2. Department has information. Based on this information, on this basis, department feels you did not disclose such information in ITR. Let's say in 24-25 I purchased 5 lands. I did not actually purchase, I purchased 0 lands. Okay. For example, I purchased 5 lands in 24-25. But my income tax return, I showed only 4 lands. I did not show 1 land. But that information is available with income tax department, and income tax department feels that I did not disclose 5th land in my income tax return. In that case, department has power to do the search. Are you able to understand? So whenever notice under 142(1) is given and it is not complied, department can do search. Whenever summons are given and SSE did not appear in person, then also search can be done. Whenever department is having some information, based on that information, department feels that like that information is not disclosed in ITR, or even if notice is given, department is so confident that information will never be disclosed by SSE in the ITR. In these cases, department has power to do the search. Now, you will get one doubt. Sir, department has this information. Whether this information will be told to SSE? If this information will be told to SSE, then SSE can influence the search. SSE can tell to top-notch officer and he can somehow influence the search. So whatever the information that department is having, that information will never be told to any person. It will not be told to SSE. It will not be told to CIT appeals or JCIT appeals. it will also not be told to iterate. Okay, so whatever the information based on which search is conducted, that will never be disclosed to SSC, CIT appeals, JCIT appeals. It will not be disclosed to iterate also, but it will be like in High Court and Supreme Court, it can be disclosed. That means SSC filed writ petition. High Court asked what is the basis, what is the information based on which you have conducted the search. In that case, like department is required to disclose that information to High Court or Sir, any approval is required for doing search? Yes, approval is required. Only with prior approval, you need to do the without approval, without search warrant. Sir, like only with search warrant, you can do the search. In many movies, you would have seen, okay, search will be conducted whenever department is doing the search. SSC will ask, okay, is there any search warrant, on which basis you are conducting the search. So search warrant is mandatory. Only if you are having search warrant, then only you can do the search, otherwise search cannot be done. Sir, who will issue search warrant? Search warrant will be issued by bosses or top bosses. That means what? It can be issued by commissioner, principal commissioner, chief commissioner, principal chief commissioner. Or it can be issued by director, principal director, director general, principal director general. Any of these can issue search warrant. Okay. So those who are issuing search warrant, they are also called as authorizing officer. Authorizing officer. Those who are conducting search, they will be called as authorized officer. Normally, search will be conducted by additional commissioner, joint commissioner, assistant commissioner, deputy commissioner. Those cadre people will actually conduct the search. They will be called as authorized officer. Sir, can joint commissioner of income tax or additional commissioner of income tax, or can assistant commissioner of income tax, deputy commissioner of income tax, I'm sorry, additional commissioner of income tax, joint commissioner of income tax, additional director of income tax, joint director of income tax. They also generally search warrant will be issued by bosses or top bosses. But whoever as assessing officers are there, additional commissioner, joint commissioner, additional director, joint director, they also can issue search warrant only if empowered by CBDT. Only if they are empowered by CBDT. Let's say all bosses, top bosses are on leave. Search is required to be conducted. Bosses are not available. Then CBDT will authorize joint commissioner to issue search warrant. Then joint commissioner will issue the. Shall we discuss further? Sir, in search warrant, what they will write? In search warrant, they will write name of the SSC. Okay, place where search will be conducted, time and date search will be conducted. All this will be written in the warrant. Next, sir, what they will do in search? What are the presumptions? Powers during search, we will also discuss presumptions. So, whenever they come to search, they have ultimate powers. They can inspect entire building. Okay, so if they are having doubt, plaster of Paris ceiling was done, behind ceiling there is cash. They have doubt. They can break the plaster of Paris. Like whatever the keys of Almira, keys of all, all the things are required to be given. If keys are not given, they have power to break the Almira also. They have power to break the like sofa set, and they have ultimate powers. You have seen Malana movie, right? So in that way, they have power to break even the lockers, and they can do search. They will verify valuable articles, valuable things, whatever that are there. They will verify. They will prepare the statement. They will prepare the they wanted to verify your books of accounts, but your books of accounts are in Tally or in SAP. There is password. you need to give the password. Okay, otherwise they will bring technical consultant. IT guy will also be, IT consultant will also be brought, and he will do something, and he will somehow give access of data to the income tax department. Next, see, when you are going for search, like if department wants help of any other department, because politician's house is required to be raided. Okay, like search is required to be conducted in politician house. Now politician house, there will be gundas, rowdies, they will slap income tax people. That's why, like if they want support of police, they can take help of local police, but prior approval of bosses is required. They will ask bosses for additional police department support. If bosses gives approval, based on that approval, they will take help of police department or CBI or enforcement department. Along with that, they will go, income tax department will go and do the raid. Next, presumptions. Whenever raid is conducted, whatever the assets that are found in that house is there or in that place is there, those assets will be presumed as belonging to that particular person. Let's say raid is conducted in my place, one costly diamond was found. I said that diamond do not belong to me. That diamond belongs to my sister. My sister is living in US. Okay. If I say cock and bull story, they will not believe. They will assume that diamond belongs to me. If that diamond really belongs to my sister, I need to prove to income tax department. Okay. I hope some suspicious guy has come with the name Broken Heart. He's asking irrelevant question apart from this assessment. Now, next, see, if they find any agreement, they will find whatever the agreement that is there, whatever the content that is there in the agreement, that they will believe as true and correct. For example, like I purchased one building. I purchased building for, as per MOU, I purchased it for 5 crores, but out of 5 crores, I paid through bank 3 crores, I paid cash of 2 crore rupees. But in my sale agreement, I disclosed only 3 crore rupees. Now, they came to ride na. When they are doing ride, unfortunately, they came across this memorandum of understanding. Now they will believe whatever that is there in MOU, they will believe, they will think 2 crore rupees. They will think 2 crore rupees, whatever the 2 crore rupees amount is there, the 2 crore rupees I paid in cash, they will believe, and they have power to impose 269 SS, 2690, 269 ST provisions on me. Are you able to understand? So that much powers, like department is, that much presumptions department can take. Okay, so whatever the assets that are there, department will think that assets belong to SSE only. Whatever the books of accounts, whatever the agreements that are there, whatever the content that is there in the agreement, department will believe it is true. Similarly, if any signatures are found on any document, even though those signatures are forged signatures, still department will believe that particular person has signed the document. All these are the presumptions that department will consider while during the course of search. Okay. Next. Sir, do they have power to seize assets during the course of search? Yes, they have power to search, seize the assets during the course of. Under survey, they do not have power to seize the assets. They can only impound books of accounts. They do not have power to impound assets. But under search, they have power to impound books of accounts. They also have power to impound assets also. Second thing, if they could not seize any asset because of any hardship, whatever the assets that they could not impound, they will give the order those assets should not be moved without approval of income tax department. Let's say there is one room, one floor is there. Outside that floor, there is RDX bomb. Now I am the income tax officer who is doing the raid. How can I go into the room crossing that RDX bomb? It is life threat to me. Na? So what I will do, I will give the order like whatever that room is there, that room should not be opened without approval of income tax officer. That we call as deemed seizure or constructive seizure. Are you able to understand? Let's say I am doing ride of Tata Limited. Tata Limited has business across multiple places, right? It has business in Mumbai, it has business in Delhi, it has business in Rajasthan, it has business in Hyderabad, it has business in Chennai. Now, whatever Tata Limited is there, head office is Mumbai. You know, right? Whenever they do ride of all places simultaneously. At a time, they will do the ride. So whenever they do ride simultaneously at a time. In that case, whatever the Essing officer of Delhi, Essing officer of Rajasthan, Essing officer of Hyderabad, Essing officer of Chennai, who is having jurisdiction over that place, they will go, they do the right, and whatever the assets that are seized are there, assets seized or whatever the books of accounts impounded are there, all these will be submitted to AO having jurisdiction over head office. Okay, within 60 days they will submit the books of accounts seized and assets, books of accounts and assets that are seized will be submitted to assessing officer having jurisdiction over head office, so that that assessing officer can proceed further and he can complete the. Able to understand? I will tell one example. There is one guy, Monish. His place of business is being uh, searched. In his place of business, let's say cash, jewelry, and precious articles are found. These can be impounded, na? So these will be seized. Monish is having bank account, demat account, immovable property. Now, can they be seized? They cannot be seized. So what they will do? They will provisionally attach these properties. You're able to understand? What they do is provisionally attach the. Now, yeah, one interesting point. Whenever they do search, like if there is gold per man up to 100 grams of jewelry, they will not seize. For unmarried girl up to 250 grams of jewelry, they will not seize. For married girl up to 500 grams of jewelry, they will not seize. See, after conclusion of search, they will prepare one panchnama. In that panchnama, they will write whatever the assets that are found. They will prepare statement of assets and inventory, right? Every statement of asset and inventory, it is clearly written in panchnama. It is also called as last of authorizations. After writing panchnama, they will take the signature of the SSC. So, like whatever the gold that I am holding, that gold will be disclosed in panchnama, but gold will not be seized. Okay, so there is one stirdan limit. For male, up to 100 grams of jewelry will not be seized. For girls, unmarried 250 grams, married 500 grams. Till that point, jewelry will not be seized. Are you able to understand? Now, books of accounts and assets were seized. Now, when can SSC get those books of accounts and when can SSC get those assets seized? See, after conclusion of search, what department will do? Department will do assessment. Department will give scrutiny notice either under 143.2 or it will give notice under income escaping assessment 148, or block assessment can also be done from 1st September 2024 on. So once the search is conducted, next immediately department will do the assessment. After completion of assessment, SSC can get back the books of accounts from the department. Are you able to understand? Let's say search conducted. After doing search, what they will do? They will do assessment, right? They will complete assessment. They will complete assessment under 143.3 or 144 or 147 income escaping assessment. Whatever the date of completion of assessment is there, from date of completion of assessment within 30 days, within 30 days, like department will hand over books of accounts to assessment. Sir, can department retain books of accounts even after 30 days also? Yes, department can retain even after 30 days also, but prior approval of bosses or top bosses is required. Now your doubt is, sir, after 30 days, why department still wants books of accounts? Because assessment is already completed, demand notice is given. To levy penalties, department may require books of accounts even after 30 days also. Department can retain even after 30 days also, but prior approval of bosses or top level bosses is required. Are you able to understand? There is one concept, explained assets, unexplained assets. Explained assets means those assets which are purchased out of white money. That means whatever the income that is disclosed in ITR, using that income only I purchased assets. Those assets we call as explained assets. If any assets are purchased without white money, that means if any asset is purchased out of income that is not disclosed in ITR, that we call as unexplained assets. Are you able to understand? Sir, why you are discussing about explained assets and unexplained assets? Department conducted search in my place. There are some assets which I truly disclosed in my income tax return. Those assets I can get back from the income tax department. Are you able to understand? Whatever the unexplained assets are there, those unexplained assets I can get only after completion of all proceedings. But whatever the explained assets are there, those explained assets I can get back within certain time limit. Are you able to understand? That's why. Now I will take one example. There is one guy with the name Varun. Search was conducted in Varun place. Let's say cash of 50 lakh rupees was seized, gold of 80 lakh rupees was seized, jewelry of 10 lakh rupees was seized. So total how much of assets were seized? 50 plus 60, 50 plus 10 plus 80, 140 lakhs worth of assets were seized. Out of 140 lakhs worth of assets, out of 50 lakhs, 30 lakhs is white cash. White cash means what? It is explained asset. Whatever gold is there, it is not explained. Okay, entire gold they purchased with cash, not explained. And whatever 10 lakhs is there, the jewelry, this is also purchased officially. This is also explained asset. So how much is my white money? My white money is only 40 lakh rupees. Sir, now department has done search. Out of 140 lakh rupees, 40 lakh rupees is genuinely disclosed in ITR. Now whatever the assets which are genuinely disclosed, can I get back those assets from department? Yes, you can get back those assets from department, but department will calculate the tax liability. After adjusting the tax liability, department will give the explained assets to you. Are you able to understand? For example, I will take one small example. Assets seized. Assets seized on 20 June 2024. When they are seized? 20 June 2024. Search completed. Sorry. Search started on 20 June 2024. Search completed. Completed on 27 June 2024. Now, the month in which search is completed. What is end of month? End of month is 30 June 2024. Na? From 30 June 2024, within next 30 days, I should make application. In that application, I will tell, sir, 140 lakhs assets you have seized. Out of 140 lakhs, 40 lakhs I genuinely disclosed in ITR. Please give me those 40 lakhs assets. I can make application for recovery of explained assets within 30 days from end of month in which search is completed. Next. Then what department will do? 40 lakhs assets I genuinely disclosed. Na? Whatever the tax liability is there. Now, see, when search is conducted, already existing tax liability is there. It will adjust existing tax liability. Balance will be given to me. For example, already existing tax liability is 20 lakh rupees. So how much is explained asset? Explained asset cash is 30 lakh rupees. Asset is 10 lakh rupees. Okay. So department will adjust this liability 20 lakh rupees, balance 20 lakh rupees and asset, balance 10 lakh rupees and asset 20 lakh rupees. Total 20 lakhs will be given to me. Are you able to understand? Sir, I made application within 30 days from end of month in which search is completed. Within how much period department will give the asset back to me? Department will give asset back to me within 120 days from date of completion of search. What is date of completion of search? Date of completion of search is 27 June 2024. From 27 June 2024, 120 days. That means June 3 days, July 31 days, August 31 days, September 30 days, October 31. October 31 means total 126 days minus 6 days. So by October 25, so October 24, 2024. So on or before 24th October 2024, department will give back explained assets to me. Within 120 days from date of completion of search, department will give back the explained assets after existing the existing tax liability. Here existing tax liability means whatever the tax liability for which demand notice was already issued. I did not pay advance tax. Can they reduce advance tax from explained assets? No. Whatever the already existing tax liability for which demand notice was issued, that they can reduce and balance they can give. Balance explained assets will be given to me within 120 days from date of completion of. If can't get back 40 lakh rupees, I did not understand your doubt. Okay, I will tell one scenario. Here, tax liability is 20 lakhs. For example, tax liability is 35 lakhs. Cash 30 lakhs is available. Jewelry 10 lakhs is available. Now, 30 lakhs they will adjust. What about balance 5 lakhs? They cannot break the jewelry, right? What they will do? They will sell the jewelry in open auction. They will get money. They will adjust 5 lakh rupees. Balance 5 lakh rupees will be given to the SSC. Are you able to understand? Yes, I do teach for CA final. What happened? Sir, then what about unexplained assets? There are unexplained assets. Na? How much are unexplained assets? Cash. Like 30 lakhs is explained. Balance 20 lakhs is unexplained. Na? So, cash 20 lakhs unexplained. And gold 80 lakhs was also unexplained. Sir, when unexplained assets will be given, department will complete the assessment. After completion of assessment, department will tell what is the tax liability. For example, department completed assessment after search. Then department determined tax liability is 60 lakh rupees. Whatever the tax liability 60 lakh rupees is there, first 20 lakhs cash will be taken. This will be sold. After selling, 81 lakhs was received. Out of 81 lakhs, 40 lakhs will be adjusted. Balance 41 lakhs will be given to the asset. So explained assets will be given after completion of search if within 30 days application is made. But unexplained assets will be given only after completion of assessment. After completion of assessment, whatever the tax liability is there, the tax liability they will adjust against unexplained assets. Whatever the balance unexplained assets are there, they will be given to the asset. Able to understand? So this is the concept relating to fast track batch. Abhi not possible currently because in the next month I'm having 4 batches for May 2026. I need to teach CA Inter, CMA Inter, CA Final, CMA Final. All those 4 batches are locked in August month. So again, I cannot start fast track batch. That's why in revision only, to the extent possible, important concepts I'm telling in a clear way. Okay. Even though I take extra half an hour class, it is worth. So this is the completion of search. I hope you understood search concept. Very, very important. I did not rush. I took enough time to explain you. Now shall we discuss remaining concepts? Time is already 9. So these concepts are pending. 142 1, 143 1, scrutiny, best judgment assessment, 144C, 142A. Additionally, 147 income escaping assessment, then block assessment, that is also pending. Along with these, I need to discuss appeals and revisions. Equalization levy, small topic, 10 minutes topic, 10 to 15 that we can. So shall I proceed further? Yeah, 142, 158. That's what I have written sections now. Block assessment is 158. I will explain that also. My objective is to explain, revise in a clearer way, even though it takes a bit of time. So, students, shall I continue or shall we continue this tomorrow? Tomorrow, sir. I hope I can understand assessment procedures. Basically, it's a theory chapter. It will be like that only. At a stretch. Okay, for today, I am concluding live here. Please wait. Tomorrow, I will explain remaining section. Tomorrow, can we start our live a bit early at 6:30 p.m. so that we will have time till 9, we can close everything. So are you comfortable at 6:30 p.m. tomorrow? Please comment. 6 p.m. to 9 p.m. that will be heavy, 3 hours at a stretch. Uh, Solve one or two problems. Students, whatever the problems that you wanted, please share in Telegram group that I will discuss in tomorrow's live. Whatever the problem you wanted, where you are having, please share in the group. You ask, sir, please explain this problem in the live. Not at all a problem. My objective, you wanted to qualify. Your success is my success. Today, I will finish balance assessment procedures part. Then I will start appeals and revisions. At the end, in last 10 to 15 minutes, I will also discuss with you equalization. So that's the target for today. Another person joined. So yesterday we finished the survey part and search part. Now I will start with balance assessment. I will discuss with you 142.1. Then I will discuss with you 142 2A special audit. Then I will discuss section 141 intimation. Then I will discuss with you various assessments 143.3, 144 best judgment assessment, 147 we will discuss income escaping assessment. Then we will discuss block assessment, which is recent amendment made in Finance Act number 2 of 2020. So these are the concepts that I will discuss with you with regard to assessment. So shall I start, everybody? First, I will start with section 142. Are you ready? I think still some people are joining. So I will quickly start section 142.1. There are uh, two subsections, 142.1 clause 1 and 142.1 clause 2. See, as per 142.1 clause 1, they will ask you to file return of income. As per 142.1 clause 2, they will ask you to submit information, and generally 142.1 clause 1 will be given on standalone basis, but 142.1 clause 2 will be given along with assessment note, along with assessment notice under section 143 2 or section 148 or best judgment assessment. See, department, if you do not file ITR, then department will issue notice to you under section 142.1 clause 1. It will ask you to file income tax return. Yesterday we discussed the due dates for filing ITR. Maximum I can file ITR up to 31st December of assessment year. After 31st December of assessment year, I cannot file ITR. I can file ITRU. That ITRU also I did not file. Then what department will do? Department will issue notice to me section 142.1 clause 1, and department will ask me to file ITR. Able to understand? So department, what it will ask through 142.1 clause 1, it will ask you to file ITR. 142.1 clause 2 and 142.1 clause 1 can be issued standalone basis. That means it can be issued independently. But 142.1 clause 2, it is not issued independently. Department wants to do assessment, regular assessment, 143 2, or department wants to do best judgment assessment or income escaping assessment. In those cases, along with assessment notice, department will also ask you to submit certain information. Then it will issue along with notice under 143.2, it will ask information under 142.1 clause 2. It will ask you information and accounts. We will discuss about 142.1 clause 1. Sir, there are around 140 crore population in India. Out of 140 crore, maximum 8 crores ITR will be filed. 8 crore people will file ITR. Balance 132 crore people, they will not file ITR. Na? For every person, whether notice will be issued under 142.1 clause 1 to file ITR? No. Department is very intelligent. Department is having risk assessment procedure. Department gets information from various sources. Now, what department will do based on that source? Let's say in 24-25, I purchased 40 lakhs worth of car, but I did not file my income tax return. Now, income tax software will trigger. This guy purchased 40 lakhs worth of car, but he did not file ITR. Then department will issue notice. So department gets various information from various sources. Department will cross check whether you have filed ITR or not. If you do not file ITR, then department will issue notice to you under 142.1 clause 1, and it will ask you to file ITR. Are you able to understand? 142.1 clause 2. Department, along with notice for assessment, it will also ask information under 142.1 clause 2. Sir, what is the information it can ask? It can ask for books of accounts. If department asks books of accounts, you need to submit books of accounts. Sir, for how many years books of accounts can be asked by department? Sir, for 2005-6, department can ask books of accounts as per 142.1 clause 2? No. The year for which they are doing the assessment. Apart from that year, for last 3 years, books of accounts can be asked. What do you mean by this? Let's say assessment notice was given for previous year 22-23. So apart from 22-23, last 3 years, previous year 21-22, previous year 2021, previous year 19-20. For these 3 years, department can ask books of accounts. Previous year 18-19, can it ask books of accounts of previous year 18-19? No. Are you able to understand? So as per 142.1 clause 2, department can ask maximum 3 years books of accounts preceding the previous year for which assessment is being done. Here assessment is done for 23-24. Apart from 23-24, last 3 years books of accounts can also be asked by department by issuing notice under 142.1 clause 2. Are you able to understand? Sir, like I am professional. I am a chartered accountant in practice. I filed my income tax return. I will purchase my personal assets. Na, I purchase costly watches. I purchase costly cars. I purchase jewelry. So all these personal assets will I disclose in my professional balance sheet? I will not disclose in my professional balance sheet. But can department ask? Can department have power to ask personal assets and liabilities? Yes, department can also ask your personal assets and liabilities information, but prior approval of joint commissioner is required. Only with prior approval of joint commissioner, personal assets of SSC can also be asked by income tax. Able to understand? Yes, Niranjan, hi. Sir, what if I do not comply with notice under 142.1? Department asked me to file ITR. I ignored. I did not give reply to that notice. I did not file my income tax return. Department asked me to submit my personal assets and liabilities. I did not submit. Department asked me to submit assets and liabilities of my parents. I did not submit those information. Then, if I do not furnish the information that is required to be furnished under 142.1, then department have power to do best judgment assessment on me. Are you able to understand? Sir, what do you mean by best judgment assessment? I will discuss little later. But the thing is, whenever I do not furnish the information that is required as per 142.1, department have power to do best judgment assessment on me. In addition to that, they will also levy penalty on me. Penalty is 10,000 rupees under section 272. Are you able to understand? So this is the consequence. Okay, till here, are you clear? Next, I will discuss with you 142 to a special audit. See, whom we can call as assessing officer. We can call income tax officer as assessing officer. We can also call assistant commissioner of income tax or deputy commissioner of income tax as assessing officer. We can also call additional commissioner of income tax or joint commissioner of income tax as assessing officer. Am I correct? Now, assessing officer is doing assessment of Niranjan. So he is doing assessment of Niranjan. When assessing officer is doing assessment of Niranjan, like uh, during the assessment, they are verifying books of account. Whatever the books of accounts are there, books of accounts are very complex, or whatever the books of accounts are there, in those books of accounts, multiple entries are there, duplicate entries are there, huge volume of entries, 5 lakh entries are there in that tally, or in that SAP 5 lakh entries are there, or whatever the business that is done by Niranjan, that is very complex. Okay, what Niranjan will do? Niranjan will buy cryptocurrencies. He will buy 1,000 cryptocurrencies and he will sell all those. Like he deals in buying and selling of 1,000 cryptocurrencies. See, hardly we know 10 to 15 cryptocurrencies. How do we know remaining cryptocurrencies? How can we know the value of that cryptocurrency is that particular amount of rupees? We do not know. So whatever the nature of business that Niranjan is there, the nature of business is very, complex. So in this case, what assessing officer will do? Assessing officer will give show cause notice for special audit. Are you able to understand? So in this case, assessing officer will give direction to Niranjan that his books of accounts are required to get special audit. He will give show cause notice why his books of accounts are not required to get special. Then Niranjan, like Niranjan will be given opportunity of being heard after listening to Niranjan. Like if reason is sufficient, well and good. If reason is not sufficient, then assessing officer will give direction to Niranjan that his books of accounts are required to get special audit. You know, right? Audit under section 44AB. Generally, if turnover is more than 1 crore in case of business, in profession, if gross receipts are more than 50 lakhs, they are required to get their books of accounts audited under section 44AB. Whatever the books of accounts of Niranjan are there, they are already audited under section 44AB. Sir, already tax audit was done under 44AB. Again, whether special audit is required to be done? Yes. If department wants, again your books of accounts will be specially audited under section 142 2A. Are you able to understand? So, sir, who will do special audit? Special audit will be done by chartered accountant. Okay. Department also have power. Assessing officer can also issue directions for inventory valuation. For the purpose of inventory valuation, who will do inventory valuation? Inventory valuation will be done by cost accounting in practice. Are you able to understand? So whenever assessing officer finds books of accounts are very complex, multiple entries are there, duplicate entries are there, huge volume of entries are there, nature of business is complex, then assessing officer will give direction to SSE that is books of accounts are required to get special audit done under section 42 2A. Opportunity of being heard will be given to the SSE, thereby directions are given for special audit. Who will conduct special audit? Chartered accountant. Inventory valuation will be conducted by cost accountant. Sir, who will pay fees to chartered accountant and cost accountant? Fees to chartered accountant and cost accountant will be paid by central government. Modi will pay fees of chartered accountant and cost accountant. Now, sir, like whether assessing officer give entire books of accounts for special audit, it is up to the decision of the assessing officer. If assessing officer wants entire books of accounts are required for special audit, he can issue directions for entire books of accounts for special audit. If assessing officer wants only receivables for special audit, then he can issue direction only receivables are required for special audit. If assessing officer wants only P&L account is required for special audit, then he can issue directions for only P&L account. If assessing officer wants special audit for June to November, only for that period he can issue directions for special audit. So it is up to the assessing officer as to what aspects that are required to be required to get special audit. For those aspects, he will issue directions for audit. Are you able to understand? Timelines. Generally, time limit for completion of special audit, whatever 30 days, 40 days, 50 days, that will be determined by assessing officer. Who will determine the time limit? Time limit will be determined by assessing officer. Sir, maximum how much time limit will be? Maximum how much time limit is allowed? Maximum time limit allowed is 180 days. Are you able to understand? Now, so maximum time limit allowed is 180 days. For example, assessing officer gave time limit of 80 days. Now, can this be extended? Yes, it can be extended. Sir, who will make application for extension? Either SSE can request for extension of time limit, or chartered accountant can request for extension of time limit, or assessing officer himself will extend the time limit. Are you able to understand? But original time limit plus extended time limit maximum together cannot be more than 180 days. Next, who will appoint chartered accountant? Chartered accountant and cost accountant will be appointed by Commissioner of Income Tax or Principal Commissioner of Income Tax, Chief Commissioner of Income Tax, Principal Chief Commissioner of. Hi Monish, welcome. See, Special audit is required to be done. For special audit, if chartered accountant is appointed by SSC, then SSC will influence the chartered accountant. That's why chartered accountant will not be appointed by SSC. Chartered accountant will be appointed by like commissioner bosses or top level bosses. Are you able to understand? Sir, special audit was completed. After completion of special audit, audit report will be given. Audit report will be given to both SSC as well as assessing officer. Generally, as per law, audit report will be given to SSC and SSC will give the audit report to assessing officer. But in practice, chartered accountant will give audit report both to SSC as well as assessing officer. Otherwise, like SSC can manipulate the audit report. That's why he will give audit report both to SSC as well as. Now, sir, whatever the audit report given by chartered accountant is there, whether that audit report will it be considered in assessment order? Will it be considered in assessment order passed by AO? That is up to the decision of assessing officer. Like assessing officer will read the audit report given by chartered accountant under special audit. After going through the audit report, whatever the observations in audit report are there, those observations can be considered by assessing officer in his assessment order. But if those observations are prejudicial to the SSC, opportunity of being heard will be given to the. So this is the concept of special audit. Very, very simple. During the course of assessment procedures, assessing officer is feeling tough to do the assessment. Then he will issue directions for special audit. Before that, opportunity of being heard will be given to assessment. Then, like who will appoint chartered accountant? Commissioner, bosses, top bosses. For inventory valuation, he will refer the case to cost account. Are you able to understand? So special audit will be done maximum in 180 days, original time limit plus extended time limit. Fees of chartered accountant will also be paid by central government. Even though your books of accounts are already audited under 44AB, still you are required to get special audit if recommended by, if directions are given by assessing officer. Once like special audit report is given, it will be given to assessing officer as well as SSC. Assessing officer, if he wants, he can consider statutory audit, sorry, he can consider special audit report in his assessment order. But if it is prejudicial to SSC, opportunity of being heard will be. Otherwise, like so it is up to the decision of the assessing officer whether to consider observations of chartered accountant or not. Here, one thing is there, minimum fees that is required to be paid to chartered accountant is 3,750 per hour and maximum up to 7,500 per hour. So this is the concept relating to audit. Now shall I proceed further? Next concept is section 142A, reference to valuation. Now I will ask you one question. We have studied so many provisions under Income Tax Act. Now, tell me the cases where you will come across fair market value. For example, gift concept is there. If you receive gift in the form of movable property, you will consider fair market value of gift received. If it is more than 50,000, then it is taxable under income from other sources. So fair market valuation is required to be calculated when you receive movable asset for without consideration or for inadequate consideration. Tell me the cases where we are required to calculate fair market value. There are many sections under which we need to calculate fair market. Property transfer. Yeah, section 50C. In case of section 50C, there is one provision. Like if SSC feels that stamp duty value is more than actual consideration, like fair market value, like stamp duty value is more than fair market value, then SSC will have two options. First option, he can file case in court or appellate authority, or he can request income tax officer to refer the case to valuation officer for the purpose of recomputation. Next, any other section in which you need to calculate fair market value? So many sections are there, you forgot. Yes, exit tax. We have discussed in trust taxation. Exit tax, like when you are considering movable assets, you need to calculate fair market value. For quoted shares, you need to consider fair market value. Gift taxation. Okay, that's it. So many sections are there. Black Money Act. Okay. Next, when you are purchasing a capital asset, like generally when you purchase capital asset, you will pay in cash. But whenever you sell any capital asset in exchange of another capital asset, then also you are required to calculate fair market value. Similarly, 1st April 2001, if you purchase any capital asset before 1st April 2000, you need to consider actual cost or fair market value, whichever is high. Yes, in case of closely held companies are issuing premium. Closely held companies for issuing for premium, I did not understand. Can you quote the section? Yes, capital gains cost of acquisition. So, okay, slum sale, very good. I appreciate you, Ranjan. Yeah, in case of slum sale, full value of consideration is equal to lump sum consideration or fair market value of capital assets transferred, whichever is here. Section 50 CA, transfer of unlisted shares. If actual consideration is less than fair market value, then fair market value will be taken as full value of consideration. Oh, Varun, you are, I think you are specifying about 56 subsection to clause 7. In case of closely held companies, that provision was deleted in Finance Act number 2 of 2024. That provision is no more there. Okay. 56 subsection to clause 7, that is removed from other source. Okay, let's come into the concept. So there are various sections where you need to calculate fair market value. I got gift from my friend jewelry. I got 10 grams of gold. Let's say each gram of gold is 1000 rupees. Total 10 grams into 6000 rupees, 60,000 rupees. Normally, fair market valuation will be done by registered valuer, or if there is any receipt or tax invoice acknowledgement, that will be considered. So I considered fair market value as 60,000 rupees. Income tax officer doing my assessment, he is feeling fishy. He is feeling that fair market value is 90,000 rupees. In that case, during the course of any assessment, if assessing officer is fictitious or suspicious that whatever the fair market value that is calculated is there, that is not correct. In that case, assessing officer will refer case to valuation officer. Okay. So once the case is referred to valuation officer will do the valuation of that asset, and that valuation report will be submitted to assessing officer. Sir, within how much period? Okay, let's say a case was referred in current previous year. Are you able to understand? For example, what is today's date? Today's date is 28th July 2025. So end of month you need to consider. End of month is 31st July 2025. Starting from 31st July 2025, within next 6 months. That means within 6 months from end of month in which reference was given to valuation officer will do the valuation and give the valuation report to assessing officer. So 31st July, from 31st July, 6 months means 31st August, September, October, November, December, January. So on or before 31st January 2026, valuation officer will give the valuation report. Sir, valuation report was received. Is it mandatory that valuation report should be considered by assessing officer in his assessment? It is optional. It is up to the decision of the assessing officer. If assessing officer wants, he will consider the valuation report of valuation report in his assessment. Otherwise, he will ignore the valuation report. So, like, it is not mandatory. Whatever the valuation report that is given is there. It is not binding on assessing officer. If assessing officer wants to consider, he will consider. Otherwise, he will not. Section 132, in case of search and seizure, where fair market value of immovable property is valued. Yes, yes, Monish, that is also correct. So, did you understand this concept? Reference to valuation officer, section 142A. You need to remember only one thing. Valuation officer is required to give the valuation report within 6 months from end of the month in which reference was made. That's the only point you need to remember. Next, section 143(1). I'm sorry. Initially, I told one mistake. It is not 141. It is 143(1). Intimation. Not getting AC today. Yes, 143(1) intimation. 6 months for valuation report, not 6 months. 6 months from end of the month in which application is made. Important. You should not calculate 6 months from date of reference, but from end of the month in which 143(1) intimation. See, normally when you file income tax return, like you are CA final students, you are no more CA inter students, you have practical experience of filing income tax returns. When you file ITR, automatically income tax return filed will be processed and intimation will be received via mail. I hope you know about 143(1) intimation. Okay, like in our offices, many clients will come. Okay, they will come, they will tell, sir, notice has come, please see, we need to pay any taxes, like that. Okay, we will see and we will ignore it because it is just a intimation. Like clients do not know, right, whether it is notice or intimation. So like they will panic, but we are very happy because we know it's just an intimation. So for every return that is filed, it will be processed by Central Processing Center Bangalore, and like it will process the return and it will send the intimation to us. Sir, what software will consider during the course of processing the income tax return? Basically, 5 types of errors will be rectified by software when it is processing income tax return. After rectifying these 5 types of errors, intimation will be issued by software. See, whatever 143(1) intimation is there, it will not be given by income tax officer. It is auto populated, it is auto generated intimation, and it will be processed by software. That software is located in CPC, Central Processing Center, Bangalore. Sir, what are those 5 types of errors? First, if there are any arithmetical errors. What do you mean by arithmetical error? Let's say I am filing income tax return. 10,000 plus 2,000. It is 12,000 rupees. Na? But in a flow, I entered one extra digit. 10,000 plus 2,000. I have entered 1,20,000 rupees. So there is arithmetical error. Na? So whatever the arithmetical errors are there, those arithmetical errors will be processed by uh, like will be processed by software. But nowadays, when if you have practical experience of filing income tax return, while filing income tax return only, if you enter any amount, it is auto calculated. You need not do calculation on your own. But if at all, in any worst case, if there is any arithmetical error, that arithmetical error will be corrected by software when it is processed. Are you able to understand? Next, incorrect claim. What do you mean by incorrect claim? As per section 180C, maximum deduction I can claim is 1,50,000 rupees, but I claimed 1,80,000 rupees. Whatever the extra deduction that I claim, okay, that will be reduced by software when it is processing. Similarly, under section 80D, maximum deduction allowed for normal citizen is 25,000, for senior citizen is 50,000. I paid medical insurance policy 30,000 rupees. I am normal citizen. For me, maximum deduction allowed is 25,000. But I claimed 30,000 as deduction. That will be eliminated and only 25,000 will be allowed as deduction by software. But this type of incorrect claim is not possible, because nowadays when you are filing income tax return, validation is there at the time of filing only. So when filing IT return only, if I give 30,000 rupees, maximum deduction it will take is 25,000 rupees. So if there are any incorrect claims that I made while filing ITR, that will be rectified during the processing. Next, third one, ITR filed after due date, but I claimed business losses. I claimed business losses, capital losses, losses from owning and maintaining resources. Yesterday only we have discussed, if you want to carry forward business loss, capital loss, loss from owning and maintaining resources, mandatorily you are required to file ITR. That ITR is also required to be filed within the due date. If you file ITR after the due date, still if you carry forward business losses, then whatever the business losses that you have carried forward, those losses will be restricted and they cannot be carried forward. That restriction will be kept by software when it is processing the income tax return. Next, fourth, see this type of error we often see in our offices. In tax audit report, let's say chartered accountant disallowed 80,000 expenditure. Whenever expenditure is disallowed in calculation of total income, whatever the expenditure that is disallowed, that is required to be add back, right? But see, chartered accountant in his tax audit report under section 44AB, he disallowed 80,000 rupees, but client, when he is calculating the total income, he forgot to add back 80,000 rupees. So if there is any discrepancy between tax audit report, observations as per tax audit report, and calculation of total income, those discrepancies will be pointed out and your income will be increased by software when it is processing the return under section 143(1). Are you able to understand? I hope you know this. Practically we will see this type of thing in our offices also. Like uh, we will give tax audit report, articles will file the income tax return, whatever the observations that are there in tax audit report, for those observations effect is required to be given in total income calculation. If there is any particular thing for which effect was not given, it will be identified by software and it will give the intimation. Last one, income based deductions. You know income based deductions, right? ATIA to like ATIA, ATIB, all these sections are income based deductions. So if you want to claim a deduction for income based deductions, mandatorily you are required to file ITR within the due date. If you do not file ITR within the due date, still if you claim deduction under ATIA, ATIB, those deductions will be disallowed and your income will be increased by software when it is processing the return. So basically these are the 5 types of adjustments that will be done by the software when it is processing the return. Another important thing here is, after doing these 5 changes, it will give intimation. After receiving the intimation, you have 30 days time either to accept or reject. If you accept the intimation within 30 days, then you are required to pay tax as per intimation under section 143(1). If you do not accept the intimation as per 143(1), then you have to give your objections. Accordingly, further process will be done. Sir, is there any time limit for issuance of intimation under 143(1)? Yes, there is time limit within 9 months from end of assessment year. So generally, previous year is 24-25 na? Assessment year is 25-26. So within 9 months from end of assessment year. 9 months from end of assessment year means end of assessment year is 31st March 26. 9 months means 31st December 26. So within 9 months from end of assessment year, intimation is required to be given under 143(1). Let's say intimation was generated on like 1st April 2027. Whether that intimation is valid, that intimation is not valid. Are you able to understand? Sir, department forgot to issue intimation. There is software problem. Software did not process the return. In that case, whatever the ITR acknowledgement is there, ITR acknowledgement itself will be considered as intimation under section 143(1). Generally, whenever a department assessing officer passes assessment order, he will issue demand notice. But whenever intimation is given, intimation itself will be deemed as demand notice. Separate demand notice will not be given. So whenever return is processed and intimation is given under 143(1), intimation itself will be deemed as demand notice. Okay. Here, there is one small thing which I need to explain. Scrutiny assessment. Let's say I filed my ITR on, let's say, 15th August of assessment. Next. On 30th September of assessment year, department issued scrutiny notice to me. Okay, scrutiny notice under 143. Sir, even after scrutiny notice also, whether 143(1) intimation is issued? Yes, 143(1) intimation will be issued. Before assessment year 17-18, once the scrutiny notice is received, again intimation will not be issued. But after assessment year 17-18, they made amendment. After assessment year 17-18, even though you receive scrutiny notice under 143(2), still intimation will be generated under 143. So this is the concept of intimation under 143. Now shall I explain further? Now we will discuss assessments. How many assessments are there? There are three types of assessment. Regular assessment, it is also called as scrutiny assessment. Next, best judgment assessment. Next, income escaping assessment. Regular assessment 143.3, best judgment assessment 144, income escaping assessment 140. Now regular assessment under 143, this we are going to discuss. It is also called as scrutiny assessment or regular assessment under 143. So department loves SSC so much, that's why it will do assessment. So if department particularly loves one SSC and gives notice, and it will do assessment, so that's why the section number is also 143. Okay. Scrutiny assessment, generally for scrutiny assessment, notice will be given under section 143(2). Assessment order will be passed under section 143. See, out of, let's say, 8 crore ITRs are filed. Sir, for every ITR, will they do scrutiny assessment? No. Like when Chidambaram was there, less than 3% of ITRs filed were subject to scrutiny. Nowadays, after Nirmalamma came, less than 1% of ITRs filed are subject to scrutiny assessment under section 143(2). So this is the confidence. So many people, many CAs, certain times they will file income tax return ad hocly. Okay. So when they file income tax return ad hocly, they, how, like, are they not scared? They are not scared, they are a bit confident, because hardly any income tax return will get selected for. Sir, how can department select any income tax return for scrutiny? Department is very intelligent. Department has internal information. So it has information from banks, financial institutions, stock exchanges, registration authorities. So like department has some risk assessment procedure within the department. That risk assessment procedure system will select returns randomly based on various criteria. Sir, what is the criteria based on which a return is selected for scrutiny assessment? That criteria only department knows, we do not know. You will understand now. So department, once it selects any income tax return, it will give notice under section 143 to scrutiny. Sir, if we receive scrutiny notice, is it like we have done some fraud? No, Baba, no. Okay, if you receive a scrutiny assessment notice, it does not mean you have done fraud. Department wants to check your books of accounts. Department wants you have not overstated your expenditure. You have not overstated expenditure. You have not underrated your revenue. Because if you overstate your expenditure, your profit decreases. If you understate your revenue, then also profit decreases. So whenever department issues notice under 143.2, department will verify all your books of accounts. Department's only agenda is you should not overstate the expenditure, you should not undermine the revenue income. Okay, it will verify your books of accounts, and if it finds any overstating of expenditure, it will disallow. If it finds any understating of revenue, it will add the income. In that way, department like assessing officer will verify books of accounts and he will assess your total income. Are you able to understand? So that's how scrutiny assessment will be done. The moment you receive scrutiny assessment notice, you need not panic. If you are perfect, okay, you have not done any fraud, department will just verify and will give will do the assessment. Now, time limits. Sir, is there any time limit for issuing notice under 143.2? Yes. Within 3 months from end of assessment year, notice is required to be issued under 143.2. That means what? Let's say previous year is 24-25. What is assessment year? 25-26. When assessment year ends, 31st March 2026. From 31st March 2026, you have time limit of 3 months. 3 months means what? 30th June 2026. So on or before 30th June 2026, it needs to give notice under section 143.2. Last year, when I am when I am closing one audit, not current year because audit season has not started. Last year, client has made some mistakes. I have added, I have done addition of total income. Client asked me not to point out one particular point. Okay. Then I thought of, I ignored that point. But client asked me, sir, what is the risk? I told you should pray to God till 30th June after completion of assessment year. By that time, if you do not receive any notice, you are safe. Hardly you will get income escaping assessment that department should have information on, and based on that income escaping assessment be done. But in majority of the cases, scrutiny assessment will be done. So whenever there is some matlab in the return, like you should tell to the client, pray to the God till 30th June after completion of assessment year. Till that time, if they do not receive notice under 143.2, they are able to understand. So notice can be issued within 3 months from end of assessment year. Let's say notice was received on 10th July 2026. Then is it valid notice? That notice is invalid. See that that is time barred. Time barred means what? Notice was given after the due date. Maximum time limit available for issue of scrutiny notice is up to 30th June, within 3 months from end of assessment year. Now SSE is Niranjan. Niranjan, like he forgot that he need to check whether department issued notice within the time limit or not. Niranjan cooperated to the department. Niranjan is very good guy. He is very punctual. So he gave all the information to department. Department completed the assessment. After department completed the assessment, 2 lakhs tax is required to be paid. Niranjan paid 2 lakh rupees tax. Then Niranjan met me. Okay, Niranjan asked me, sir, department has done assessment, scrutiny assessment. I paid 2 lakh rupees. I asked him to bring the proceedings. He brought me the proceedings. In those proceedings, I came to know that whatever the notice given by department is there, that notice is time barred. Sir, if notice is time barred, can we challenge it? Yes, you can challenge it only before completion of assessment. Once assessment is completed by department, then whatever the notice given by department is there, you cannot challenge. Once assessment is completed, even though it is time barred, that assessment is valid, that assessment order is valid. Okay, so whenever you get any notice, you have to first thing that you need to do is you have to check whether notice was given within the time limit or not. Notice is given within the time limit, okay. If it is time barred, then immediately you should challenge it to higher authority. Able to understand? But once assessment is completed, after completion of assessment, you do not have any power to challenge the time barred notice. Okay. Next, suppose you have received notice under 143.2. Department, will it give notice under 143.2 on standalone basis? No, along with notice under 143.2, department will also issue notice under 142.1 clause 2. Are you able to understand? 142.1 clause 2 today only we have discussed. If department wants, it can ask information and accounts, or it can also ask personal assets and liabilities. And department also have information from other persons. Like let's say scrutiny notice was given to me. Whatever my bank accounts are there, with all the banks that I do transaction, department will take information. Department will get information from outside sources also. Then considering all information, assessing officer will do the assessment. Assessing officer will complete the assessment. After completing the assessment, what assessing officer will do? He will issue assessment order. Along with assessment order, if I am required to pay any tax, demand notice will also be given. So assessment order will be given along with demand notice. Sir, what is time limit for completion of assessment? Assessment should be completed within 12 months from end of assessment year. Are you able to understand? So whatever the assessment year is there, previous year 24-25, like we have discussed here now, they have time limit to issue notice within 3 months. Next, within 12 months. Within 12 months means 31st March 2027. On or before 31st March 2027, like 12 months from end of assessment year, they are required to complete the assessment. So two time limits. Scrutiny notice can be issued within 3 months from end of assessment year. Regular assessment, scrutiny assessment is required to be completed within 12 months from end of assessment year. Those are the time limits. I will tell one point. Listen, as per ITR, my total income is 70 lakhs. As per intimation, 143.1 intimation, my total income is 80 lakhs. And as per 143.3 scrutiny assessment, my total income is 90 lakhs. Can assessing officer increase the income? Yes, he can increase the income. That is why he is doing assessment. Now, what is the objective when assessing officer is doing the assessment? His objective is to increase the income, and thereby he wants to collect the tax liability. So whether this probability is possible? Yes. Uh, as per ITR, total income is 70 lakhs. As per 143.1, intimation, like total income is 80 lakhs. But as per 143.3, total income is 60 lakhs. Sir, is it possible? Students, tell me whether this case is possible or not. That means you filed ITR 70 lakh rupees and intimation is 80 lakh rupees. Scrutiny assessment, total income is 60 lakh rupees. Whether this case is possible or not. Yes, it is possible. See, as per law, during scrutiny assessment, benefit can also be given to the, but in practice, testing officer will not give benefit to the SSC. In this case, if benefit is given to the SSC, then his senior officer will scold him. Okay, so even though benefit is there, testing officer will not give the benefit. In fact, in practice, okay, in practical scenarios, whenever testing officer increases the income, then his senior officers will appreciate him. If he decreases the income, even though it is genuinely okay, like they will scold him. That's why in practice there is no concept of reducing the income as per assessment. Uh, Department does not give refund now. Who said as per scrutiny assessment refund can be issued by department? Refund can be issued. Manish, you are not correct. You can verify also. Refund will be given to the SSC as per scrutiny assessment. Refund will not be given as per ITRU. Okay. As per scrutiny assessment, if there is refund to the SSC, refund will be given to the SSC. Okay. Okay. You can check after the complete. So we have discussed the time limits also. So this is the concept relating to scrutiny assessment under section 143. Next, we will discuss best judgment assessment. 44. Best judgment assessment. It is also called as ex parte assessment. No problem, you can check it. I know today, there will be differences between you and me because assessment procedures is such a chapter. How many times you read, still you have some doubts which are unclarified. Okay. Best judgment assessment, already we have discussed. In 4 cases, best judgment assessment will be done. It is also called as ex parte assessment. Sir, what do you mean by ex parte? Ex parte means what? Without party, without SSC, assessment will be done. Okay. So without SSC means what? Department itself will do the assessment. That's why it's called as best judgment assessment or ex parte assessment. Give any tips to exam focused? My dear student, please ask all these things at the end of the class. Okay, right now let me explain the concept. Last 10-15 minutes are for chit chat. Okay, whatever you wanted, you ask me, I will tell. But in the middle of the class, if you have any doubt relating to concept, ask. Else, general things we will discuss. Because if I miss the flow again, it becomes tough for me to get back into the track. Now, best judgment assessment. It will be done in 4 cases. Case 1, like you have not filed ITR and due date under section 139(1) is over. What is due date? 31st July, 31st October, or in case of transfer pricing 30th November. You did not file ITR within the due date. Then after the completion of due date, department will issue notice to file ITR. If you do not file ITR, if you do not reply, it will send 1 or 2 reminders. Still, if you do not reply, then department itself will do the assessment. That assessment we call as best judgment assessment. Are you able to understand? When SSE not complied with notice under section 142(1), then also department will issue then also department will do best judgment assessment. Today first topic is that only na, when you do not file return as per the notice given under 142(1) clause 1, when you do not submit return of information, accounts, assets and liability statement as per notice under 142(1) clause 2, then penalty of 10,000 will be levied under section 272A. Best judgment assessment will also be done. Next, if SSE do not cooperate with assessing officer or with chartered accountant or cost accountant during the course of special audit. Today we have discussed it now 142 2A special audit. So if SSE do not cooperate during special audit, then also best judgment assessment will be done. Similarly, like scrutiny notice will be issued now under 143(2). If SSE do not respond to scrutiny notice given under section 143(2), then also best judgment assessment will be done. If SSE do not respond to notice under section 143, then also best judgment assessment will be. See, 3 cases, first case, third case, fourth case. In these 3 cases, show cause notice will be given. Why best judgment is not required to be done? So show cause notice will be given by department. So they will wait for SSE to reply to the show cause notice. If SSE do not reply to the show cause notice, then they will proceed further and do the best judgment assessment. But in second case, he did not file ITR and department gave notice under 142(1) to file ITR. That notice was also ignored by SSC. So in this case, no show cause notice will be given. Directly best judgment will be done. Are you able to understand? Sir, best judgment assessment means what? Department itself is doing the assessment. So whether department will do the best judgment assessment on a arbitrary way, on a ad hoc way, on a random way? No. Department will do the best judgment assessment in a scientific and rational manner. Sir, what do you mean by scientific and rational manner? Let's say like you are into hotel business. Your turnover is 1 crore rupees. Department knows your turnover is 1 crore rupees. So if same hotel is getting 20% margin, they will also apply 20% margin for your hotel. 1 crore into 20%, 20 lakhs will be determined as your total income. Are you able to understand? So in that way, in a scientific way only, they will do the assessment. I will tell another example. Let's say you are into cryptocurrencies. Like you are the only one in India who are dealing in cryptocurrencies. There is no other business. And what department will do? You have done transactions in last year also. They will take last year turnover as base. They will increase growth rate 15% or 20%. Thereby, they will increase the turnover and they will apply the profit percentage margin. They will calculate the total income. Sir, department have no information with them. Then department will send income tax inspectors to you nearby your homes, and they will ask those people who are there in and around your home. Okay, they are the better people who will tell. Okay, so let's say Umasankar is there. No information is available to department with regard to Umasankar. Then department will send income tax inspectors to various people who are there in my neighborhood. Okay, they are the people who will tell me, yesterday I have seen one car in Umashankar's house. I feel that car belongs to Umashankar. Okay, so randomly they will get the information, they will check the authenticity, and they are going to calculate the total income, and best judgment assessment will be done. So best judgment assessment will never be done on a ad hoc basis or arbitrary basis. Always it is done on a scientific and rational basis. Able to understand? Sir, is there any time limit to complete best judgment assessment? Yes. Whatever the time limit that we discussed for scrutiny assessment, 143.3, scrutiny assessment is required to be completed within 12 months from end of assessment year. Same time limit is also applicable for best judgment assessment under section 140. Not responding for scrutiny notice, see not cooperate and not filed ITR, then best judgment. I did not understand your question. Sir, it is possible, sir. I guess I confused it with other provision. Yeah, it is possible if scrutiny notice is given under 143.2 and you do not, you know, respond to department. Department initially will wait. It will send 2 to 3 reminders. For those reminders also, if you are not, then directly instead of scrutiny assessment, they will invoke 144 provision. They will do best judgment. Am I audible? Some people are saying there is voice break in the. Monish, whether my voice is clear? Hello, are you there? Next, we will discuss 144A. So, 2 points you got doubt. One point that you got doubt is this point. If SSC do not respond to notice under 143. Another point, whether refund can be issued as per scrutiny assessment. These 2 points you can check later. Section 142A, power of JC to issue direction. See, many times assessing officer will do assessment of SSC. Assessing officer asked bribe. SSC did not give the bribe. Then what assessing officer will do? Assessing officer is very aggressive on. So there is one expenditure A. This expenditure is allowed as per Supreme Court decision. But assessing officer intentionally disallowed the expenditure. Why? Because SSC did not give the bribe to assessing officer. In that case, SSC can request the joint commissioner. So here assessing officer means additional commissioner, sorry, assistant commissioner or deputy commissioner of income tax or ITO. So if these people are doing the assessment, and like if they are disallowing certain expenditure, or if they are committing anything that is to be allowed but they are intentionally disallowing, in that case SSC can request his boss Who is boss to assistant commissioner, next level additional commissioner or joint commissioner? In this case, SSC can request joint commissioner, sir, expenditure A is allowed as per Supreme Court decision, but assistant commissioner is disallowing that expenditure as he is like inferior to you. Please give direction that expenditure A should be allowed as deduction. So in certain cases, like assessing officer will intentionally disallow certain benefits to SSC. In that case, SSC can request joint commissioner to issue directions for allowance of such expenditure. Are you able to understand? Or in certain cases, assessing officer is very new. Like he wrote IAS exams. He did not get IAS, but he got IRS and he became assistant commissioner. He is new to the department. He does not know how assessment will be done. In that case, as like assistant commissioner, deputy commissioner, ITO, they themselves can ask the joint commissioner. Then also joint commissioner will issue the directions. So joint commissioner can issue directions on request made by SSC, on request made by assessing officer. Sometimes joint commissioner can also issue directions on his own motion. Sir, let's say joint commissioner already knows assistant commissioner is corrupt. Okay, so when joint commissioner observes assessing officer, I mean assistant commissioner is intentionally disallowing certain benefits. In that case, joint commissioner on his motion he can give. Are you able to understand? He can give directions to the assistant commissioner, deputy commissioner, or ITO. Next question is, sir, whatever the directions given by joint commissioner, are they binding on below assessing officer? Yes, they are binding on below assessing officer because joint commissioner is of higher rank. Are you able to understand? Next, 144C, dispute resolution panel. I'm sorry, 144A, but I have written 144, 42. Section 144C, dispute resolution. See, generally, when AO do assessment, in case of SSC, generally after assessment, AO will give assessment order. But in two cases, AO should not give final assessment order. AO should give draft assessment order. Okay. See, normally in our audit office, when I was an article, I went for one audit. I went for BSNL audit. Okay. So we have done BSNL audit. We have found certain observations. I have prepared all the observations and I gave to my principal. Okay. Generally, what will we do in our offices? We will issue draft audit report. Okay. Client will go through the entire draft audit report. Then he will sit with our boss. He will discuss with our boss that certain points are to be removed from audit report. Okay, some negotiations will happen, some agreements will happen, some exchanges will happen. Then certain points will be removed from audit report. Are you able to understand? So, like some important points will be removed. Whatever the bakwas points are there, unimportant points, those will be included and audit report will be given. Okay, that audit report we call as final audit report. Am I correct? So similarly, whenever assessing officer is doing the assessment, generally he will give final assessment order. But in two cases, he should not give final assessment order. He should give draft assessment order. Sir, what are those two cases? Case one, whenever he is giving assessment order in case of non-resident. So, in case of non-resident or foreign company, if there is increase in income or if there is decrease in losses because of assessment, if there is any harmful to SSC, if SSC is non-resident or foreign company, because of assessment, if there is any harm to SSC, so when can we tell there is harmfulness to the SSC? Whenever income increases or losses decreases. Or case 2, whenever in case of transfer pricing. Okay, so whether in case of resident or non-resident, case transferred to transfer pricing officer. Case transferred to TPO, transfer pricing. So in this case also, if there is any increase in income or decrease in losses, then what assessing officer will do? Assessing officer will not straight away give final assessment order. Assessing officer will give draft assessment order. Monish is saying 100%. Yes. See how much hard work we will keep. We will go to client place. We will sit there for 2 to 3 days. We will do investigation. We do not do audit. We will find so many observations. But at the end, if we see final audit report, it's like our entire hard work is gone. Okay. So AO has issued draft assessment order. See, once SSC, here SSC means either non-resident or foreign company or any person in whose case was transferred to transfer pricing officer. So what after receiving draft assessment order, SSC is having time limit 30 days. Within 30 days, he can give acceptance. If he accepts a draft assessment order, then final assessment order will be given by assessing officer, not a problem. But if SSC has any objections, within 30 days, he can file objections with dispute resolution. Are you able to understand? Now you will get another doubt. Sir, what if you do not respond within 30 days? If 30 days is over, but he did not accept, he did not file objections with DRP. In that case, it will be deemed as acceptance. So, like once a draft assessment order is given, he will be given 30 days. Within 30 days, either he should accept or uh, he should file objections with DRP. If you do not respond within 30 days, then whatever the draft assessment order is there, that will be made as final assessment order and issued by. Are you able to understand? So within 30 days, if he gives acceptance, then like within 1 month from end of month in which acceptance is given, final assessment order will be given by the officer. Are you able to understand? Or else, if he files objections with DRP, sir, who is called as DRP? Dispute Resolution Panel is a collegium of 3 commissioners of income tax, 3 CITs together. We call as who will appoint DRP, CBDT. Okay, so CBDT will pick 3 commissioners. CBDT will make all 3 commissioners as collegium. Okay, so whoever the DRP is their dispute resolution panel, they will ask entire information. They will ask information from SSC. They will also ask information from department. They will go through entire information. Like if they want any extra information, they will also ask that information. Finally, DRP will give issue directions to assessing officer. Based on these directions, sir, whether directions given by DRP, are they binding on assessing officer? Yes, they are binding on assessing officer because DRP consists of commissioner. Commissioner is superior rank of assessing officer. That's why whatever the directions given by DRP, they are binding on assessing officer, and assessing officer should consider those directions. As per those directions, assessing officer will give final assessment order. Final assessment order will be issued by. Next, you will get another doubt. Sir, what is the time limit for issuing directions? Within 9 months from end of month. From end of month in which draft assessment order was issued. See, assessing officer will give a draft assessment order na the month in which a draft assessment order is issued. From end of such month, within next 9 months, DRP will give his directions to the assessing officer. Based on those directions, assessing officer will complete the. Now, SSE is not satisfied with direction. The question is, can he challenge directions? Students, you need to answer. If SSE is not satisfied with directions given by DRP, can he challenge those directions? If SSC is not responding, then what is the situation? In that case, it will be considered as deemed act. So my question here is, dispute resolution panel gave some directions. With those directions, SSC is not happy. SSC is not satisfied. Now, can SSC challenge those directions? Two people gave answer. Your answer is not correct. SSC cannot challenge. See, he cannot challenge the directions. Final assessment order is given na. This can be challenged. Are you able to understand? In one attempt, one question was asked. Dispute resolution panel, whatever the directions that were given by DRP are there, those directions cannot be challenged by SST. But whatever the final assessment order is given, that final assessment order can be challenged by SST. Are you able to understand? Can move to iterate. Okay, he cannot challenge directions. He can challenge only assessment order. Yes, Niranjan, what you said is correct. See, he can challenge assessment order. Na, can he challenge at CIT or JCIT level? CIT appeals or JCIT appeals? He cannot challenge. He can challenge only at ITAT level. Sir, why sir? DRP consists of 3 commissioners. So commissioner of income tax appeals, both are of equal rank. Na? So whatever the judgment given by commissioner as a DRP, that cannot be challenged with another commissioner, that can be challenged with higher authority being ITAT. Are you able to understand? So Monish, it cannot be challenged. Okay, it cannot, directions cannot be challenged, but only final assessment order can be challenged. So I think I have explained most of the concept. Yeah, another important point, DRP, he can increase or he can confirm or he can reduce the income. So DRP have all the powers. Whatever the draft assessment order is there, he can confirm the draft assessment order, or he can increase income compared with the draft assessment order, or he can decrease income compared with the draft assessment order. For that purpose only SSC made application to DRP, right? He is expecting DRP will reduce the income. So DRP have power to reduce the income that is stated in draft assessment. Voice break made. Yeah, one last point. Whenever search is conducted from 1st September 2024 onwards, if search is conducted, then 144C provisions are not applicable. Generally, if case is referred to transfer pricing officer, or in case of non-resident or foreign company, let's say in case of non-resident or foreign company, search was conducted and block assessment was done. Sir, after block assessment, will he directly give final assessment order or will he give draft assessment order? He will give final assessment order. 144C provisions are not applicable. Draft assessment order is not able to understand. Anyhow, I will explain block assessment. So this is the concept relating to DRP. Now, hero, income escaping assessment, section 147. So till here, are you clear? Everybody? I know it's little bit boring, but I can't help you. Assessment procedures is. Are you able to listen my voice clearly? Sir, what do you mean by income escaping assessment? Escaping assessment means you have secreted the income. Secreted the income. or you earned income, but that income was escaped from assessment. Let's say 40 lakh rupees cash, 40 lakh rupees cash I earned in 24-20. Entirely earned in cash na. I did not disclose in my ITR. I filed my ITR with whatever the information that is available in my bank transaction. So this 40 lakh rupees income that I earned in cash, this has escaped assessment. This 40 lakh rupees I have secreted. Okay. Department gave scrutiny notice under 143(3). Department has done scrutiny assessment. In scrutiny assessment also, how can it find 40 lakh rupees that is there in cash? Like I received 40 lakh rupees income, I also spent 40 lakh rupees income. Now department cannot know na. So in that way, department could not find that 40 lakh rupees in a scrutiny assessment. But later on, with those 40 lakh rupees, I purchased one land. Through registration office, information was known to income tax department. Then income tax department have power to do income escaping assessment. Able to understand? So I hope with this example you got clarity. Now, sir, already assessment was done under 143(3). Again, whether assessment will be done under 143(3), again, is it possible? No. See, once already assessment is done, again they will not touch that previous year. Sir, already assessment was done under 143(3). Again, can they do best judgment assessment? No, they cannot do best judgment. Sir, already 143(3) scrutiny assessment was done. Again, they wanted to do best judgment assessment. Sir, can they do best judgment assessment? Sorry. They wanted to do income escaping assessment. Whether department has power to do income escaping assessment? Yes. Sir, already first time income escaping assessment was done. Again, second time also they wanted to do income escaping assessment. Can they do? Yes. Sir, two times income escaping assessment was done. Third time they wanted to do income escaping assessment. Can they do? Yes. So department like 147 gives huge power to department. They can do income escaping assessment as many times as they wanted under section 147. My vlogs, one person is there. Please check your mobile. Nobody is complaining except you. Next. Sir, best judgment assessment was done. Again, will they do best judgment assessment? No. Again, will they do scrutiny assessment? No. Again, can they do income escaping assessment? Are you able to understand? ITR filed under section 139(1). Intimation was given under 143(1). Scrutiny assessment under 143(3). It was not done. They wanted to directly initiate proceedings of section 147, income escaping assessment. Can they do? Yes, they can do. Are you able to understand? No ITR filed, but they wanted to do income escaping assessment. Can they do? Yes, they can do income escaping. Again, they wanted to do second time income escaping assessment. Can they do? Yes, they can do for multiple number of. Whenever they do scrutiny assessment, in that case, first of all, whenever they do income escaping assessment, they have to follow procedure given under 148A. First of all, notice for income escaping assessment. Notice will be given under section 148. Assessment order will be given under section 147. Before issuing notice under section 148, what they will do? They need to follow procedure given under 148A. Sir, what is the procedure given under section 148A? Let's say department has information. Umashankar purchased 40 lakhs worth of land using cash. They will directly not give notice under section 148. What they will do, first of all, they will give show cause notice to me, giving opportunity of being heard. We have information with us that you purchased 40 lakhs worth of land using cash. Is it correct or not? They will give show cause notice to me. Okay, so I need to give response to that show cause notice. I gave response, yes, it is true. I purchased 40 lakhs worth of land using cash. Now they will officially give notice to me under section 148. Otherwise, what happens? Like in many cases, like rumor comes. Based on rumor, if they issue notice under section 148, then department is becoming full. So whenever they get any rumor, like they will speak with SSC. They will give show cause notice. They will follow procedure under 148A. They will ask whether it is correct or not. Okay, so they will give first notice under 148A that so and so information is available. Is it correct or not? Tell me the reason why we should not give notice under section 148. In that case, show cause notice will be given to the SSC. Now, SSC needs to give reply. I gave reply, sir, I am M. Umashankar. There is another person, A. Umashankar. This notice is for A. Umashankar, but you have given notice to me. That means notice was given to wrong person. In that case, what they will do? They will cancel. They will not issue notice under section 148. So, what is the first step that they will do? First step that they will do is they will issue notice under section 148A. Once they issue notice under section 148A, they will wait for the reply from SSC. Based on reply from the SSC, they will come to conclusion whether case is fit case or not. If case is fit case, then they will issue notice under section 148. If case is not a fit case, then they will drop the proceedings. They will not go further. But if it is a fit case, really I accepted, I have done a transaction, like I earned 40 lakhs income, with those 40 lakhs I purchased the land, then they will issue notice to me under section 48. After issuing notice to me under section 148, they will ask me to file income tax return. Sir, I already filed income tax return under section 139(1). Already ITR was filed. Already ITR under section 139 was filed. Again, in response to notice, under section 148, am I required to file ITR for the second time? Yes, I am required to file ITR for the time. So even though you file ITR already, still in response to notice under section 148, you are required to file ITR. Are you able to understand? So that is the concept. Now what I will do, I will file my ITR. Now I will ask you some interesting stuff. Let's say I earn incomes A, B, C, D, E. A, B, C were disclosed in ITR. I received notice under section 148A that D income got escaped from. Now you are a chartered accountant. I am your client. I came to you. I told, sir, I disclosed A, B, C incomes in my ITR. Now I got notice from department 148A that income D got escaped from assessment. I accepted for it. They asked me to file ITR. Now anyhow, I need to disclose income D in my ITR. The real question is, am I required to disclose income E as well? As a chartered accountant, what will you suggest? Will you suggest me disclosing income E as well in response to notice under section 148, or you will suggest me not to disclose income E under section response to notice under 148? Disclose or not to disclose? See, generally it is advisable to disclose income E also, because after you file income tax return in response to notice under section 148, they will issue notice under 143 to scrutiny assessment. They will do scrutiny of entire your books of accounts. At that point of time also, they will come to know that you have earned income E. So it is ideal, it is advisable to disclose all the incomes so that you will at least escape from levy of penalty. Otherwise, they will also levy penalty. Understand? Yeah, need to disclose, otherwise one more 147. So Niranjan is brilliant. For example, Monish said, sir, let's give a try, let's give luck. Income is, let's not disclose income E. So I followed Monish. I did not disclose income E. Already ABC were disclosed in ITR. D was disclosed in the return I filed in response to notice under section 148. But during the course of proceedings, department finally found income E. Department found income E. My question is, whenever department finds income E, whether department is required to follow procedure under 148A from the beginning, or is it sufficient department will consider income E also in the income escaping right away? Answer. See, I did not disclose income E, but during the scrutiny, department found income E. The question here is whether department is required to follow procedure from the beginning, or the point where it found income E, when can they consider that income E and do the assessment? That is the question. Yes, from point where it found, it will do the assessment. They are not required to follow procedure under section 148A from the beginning. But if income, like let's say income A to D, this belongs to previous year 23-24. Income E belongs to previous year 22-23. So during the course of income escaping assessment, if they find any new income, if that new income belongs to the year for which they are doing assessment, they need not follow procedure from the beginning. From the point where they found new income, from there they can do the assessment. But if new income belongs to another previous year, they need to follow procedure given under section 148. Able to understand? Next, you filed ITR under section 148, but there is some mistake in ITR filed under section 148. Now, can you file revised return? You filed ITR under in response to notice under section 148, but there is mistake in it. You wanted to file revised return. Can you file revised return? No, revised return cannot be filed once you file ITR under. Sir, are there any time limits to complete the assessment? Yes. Here there is amendment. Before 1st September 2024, the treatment was different. On or after 1st September 2024, treatment was different. So, first, notice under section 148A. Whatever the notice under section 148A is there now, that notice is required to be given, like that is optional before 1st September 2024. Like department can conduct inquiry, department will issue notice and opportunity of being heard. So how much period? Minimum 7 days, maximum 30 days. So order will be passed under section 148A whether case is fit case or not a fit case. So before 1st September or after 1st September, before issuing notice under section 148 for income escaping assessment, first they will cross confirm. They will follow procedure given under 148A. They will issue show cause notice. They will give opportunity of being heard. Why notice under 148 is not to be issued. Minimum 7 days, maximum 30 days will be given to the SSC to respond to it. After receiving response from SSC, they will take decision whether it is fit case or not a fit case. If it is fit case, well and good. If it is not a fit case, if it is fit case, then they will issue notice under section 148. If it is not a fit case, they will drop the proceedings. Notice under section 148. AO shall serve notice, may also give order passed under 148A. SSC is required to file ITR within 3 months from end of the month in which notice was served. So before 1st September 2024, sir, if SSC not responding properly, then whatever the information that is there with the department, based on that, testing officer will pass assessment order for income escaping section 147. Still, if you do not respond, then income tax office, tax recovery officer will be there. He will go to his house. He will attach all his property. Now, SSC is required to file ITR within 3 months from end of the month in which notice was served. After 1st September 2012 also, after 1st September 24 also, AO will issue notice. He is mandatorily required to give order under 148A. SSC is required to ITR within 3 months from end of the month in which notice was issued. AO can issue notice with a time limit of less than 3 months as specified in the notice, but overall original time limit plus extended time limit to file written in response notice under section 148 cannot be more than 3 months. See, this point is very important. Time limit for giving notices under section 148A, 148. Till here, whether you listened or not, I do not know. But here there is amendment. From 1st September 2024 onwards, amendment is there. Please listen carefully. Sir, is there any time limit for issuing notice under section 148A? Yes, there is time limit. Before 1st September 2024, for notice under section 148A, like no time limit was prescribed. No time limit was prescribed. But after 1st September 2024, you can see here notice under section 148. Before 1st September 24, if tax effect, okay, if income escaped is less than or equal to 50 lakhs, in that case, notice should be issued within 3 months from end of assessment year. If income escaped is more than 50 lakhs, department have huge time limit. They can give notice up to 10 years from end of assessment year. That means what? 2015-16 income also can be assessment can also be done for 2015-16 also. Very simple. Like 1st September 24 is criteria. Before 1st September 2024, like no time limit is prescribed for 148A, no time limit given. But time limit is given for 148. If income escaped is less than or equal to 50 lakhs, like notice under section 148 is to be issued within 3 years from end of assessment year. End of assessment. Next, if income escaped is more than 50 lakh rupees, then 148 is to be issued within 10 years from end of assessment year. That means higher time limit is available. If your income escaped is less than 50 lakhs, 3 years. If your income escaped is more than 50 lakhs, department can do assessment up to 10 years from the end of the assessment year. But on or after 1st September 2024, for 148A notice also. Time limits are given. See, before 1st September 24 for 148A, no time limits are prescribed. After 1st September 24, time limits are prescribed. What are time limits? If income escaped is less than or equal to 50 lakhs within 3 years. If income escaped is more than 50 lakh rupees, then notice is required to be given within 5 years. Very, very important. That means from 1st September 24 onwards, if your income escaped is more than 50 lakhs, maximum time limit available for department to give notice to you under 148A is within 5 years from the end of the assessment year. Sir, what is time limit for notice under section 148? You need to add 3 months. Generally, for notice under section 148A, time limit is 3 years. So here if income escaped is less than or equal to 50 lakhs, notice is required to be given under section 148 within 3 years, 3 months from end of the assessment year. 3 years, 3 months from end of assessment. If income escaped is more than 50 lakh rupees, then notice is required to be given within 5 years, 3 months from end of assessment. So those are the time limit. Before 1st September 24, no time limit for 148A, but time limit is there for 148. Time limit is within 3 years from end of assessment year if income escaped is less than or equal to 50 lakhs. If income escaped is more than 50 lakhs, then time limit is within 10 years before 1st September 24. After 1st September 24, for 148A notice within 3 years, if income escaped is less than or equal to 50 lakhs, if income escaped is more than 50 lakhs, then within 5 years from end of assessment year. Time limit for notice under section 148, 5 years, 3 years, 3 months, 5 years, 3 months. Very simple. After 1st September 24, whatever the time limit for 148A is there, to that you need to add 3 months to arrive at time limit for issue of notice under section 148. Are you able to understand? Next. Sir, whether prior approval is required for conducting income escaping assessment? Yes. Before 1st September 2024, you need to take, if income escaped is less than or equal to 50 lakhs, you need to take prior approval of bosses. Bosses means commissioner or principal commissioner, director or principal director. If income escaped is more than 50 lakhs, you need to take approval of top level bosses. Top level bosses means chief commissioner, principal chief commissioner, director, principal director. Okay. But from 1st September 24 onwards, to do income escaping assessment, power is given to additional commissioner or joint commissioner, additional director or joint director. That means additional commissioner or above level, the additional director or above level, joint commissioner, joint director or above level officers, they can do income escaping assessment. Able to understand? Time limit for completion of income escaping assessment. I can understand you will get some doubts. After listening to my explanation, open any other book or even ICA material, read income escaping assessment, then you will get complete clarity. Okay, because you would have listened income escaping assessment lot before. Okay, before 3-4 months you have listened, again you are listening now. Okay, clumsy confusion will be there, but once you read the material you are going to get the class. Yeah, here one small mistake is there. See, if income is greater than or equal to 50 lakhs. That means even it is 50 lakh rupees, then also 5 years time limit is available. So the thing is here, if income escaped is less than 50 lakhs, if income escaped is greater than or equal to 50 lakhs, that means even if it is 50 lakh rupees, then also 10 years time limit is available before 1st September. After 1st September, even though income escaped is exactly equal to 50 lakhs, then also 5 years time limit is available. Please change this. I made this small mistake. If income escaped is less than, if income escaped is greater than or equal to 50 lakhs. Thank you, Monish. In a flow, I made that mistake, but please correct. Very simple. If income escaped is less than 50 lakhs, lower time limit. If income escaped is either equal to 50 lakhs or more than 50 lakhs, higher time limit is available for department to issue the next time limit for completion. Let's say today income escaping assessment notice was issued 28th July 2025. You need to take end of month. End of month is 31st July 2025. From 31st July 2025, 12 months. That means within 12 months from end of the month in which notice was issued under section 148, assessment is required to be completed. That means on or before 31st July 2026, income escaping assessment is required to be completed and assessment order is required to be passed by the assessment officer. Able to understand? So time limit for completion of assessment is within 12 months from end of the month in which notice is issued under section 48. You can see here within 1 year, okay, 1 year or 12 months from end of financial year in which notice is issued under section. So this is all about income escaping assessment. Now, shall I explain block assessment? Everybody, today also it's taking time even though we start early. No problem. I think after today is Monday, na? After Wednesday, there is no class for CA final. On Wednesday, I will take remaining part. Today also it is assessment procedures only. On Wednesday, I will take appeals and revisions equalization. Okay. Niranjan saying tomorrow, sir, block assessment. At least let us complete assessment appeals and revisions. Today for YouTube channel thumbnail, I used appeals and revisions and equalization levy thumbnail. I need to change. Yes, it is lengthy. What can we do? We do not have any option. Leave it for it. So tell me, block assessment is very, very important. If you want, I will explain now. Or else we can think. One person said, okay, block assessment. About other. We will do one thing. Block assessment I will explain now because we will finish assessment. Tomorrow we can start fresh. Niranjan, uh, like if you are not able to listen now, then try to listen or else the video is again available on YouTube channel. Later on also you can watch that blog. Now block assessment, very, very, very important. See, this is recent amendment made in Finance Act number 2 of 2024. So high chances block assessment can be asked in the examination. So don't take lightly. We discussed search yesterday. In case of search, they will seize the assets. They will seize books of accounts. They will take assets with them. They will freeze the assets, deemed seizure and all. Once they seize the assets as per search, we have discussed after completion of search, they will do assessment. That assessment is block assessment. See, 1st September 2024 is criteria. Before 1st September 2024, after search, they will issue notice under section 148. Just now we have discussed whenever any notice is required to be given for income escaping assessment under section 148, before that they are required to follow procedure under section 148. Correct? 148A. Listen very carefully. In case of search before 1st September 2024, if department is issuing notice under section 148, they are not required to follow procedure given under section 148A. So other than such cases, if they wanted to issue income escaping assessment notice, then they are required to follow procedure given under 148A. But in case of search, in search cases, then if they want to issue income escaping assessment notice, they are not required to follow procedure given under section 48A. Directly they will issue income escaping assessment notice and they will complete income escaping assessment and they will issue assessment order under section 147. But on or after 1st September 2024, if they have done search, if they have done raid, then they will not issue notice under section 148A or 148. Okay, they are not required to issue notice under section, like they will not do income escaping assessment from 1st September 24 onwards. If any search is conducted, they will do block assessment under section 158BA to 158BI. So till here you are clear. Did you understand when block assessment will be conducted? In every case, block assessment will not be conducted. Only in search case, block assessment will be conducted. That too, if search is initiated on or after 1st September 2024. Not search completion. If search is conducted either on 1st September or after 1st September, then like after completion of search, whatever the assessment that they do, that is not income escaping assessment, that is block assessment. Okay. Now, sir, what do you mean by block assessment? Block assessment means the year in which they are doing the raid, the year in which they are doing the search. Along with that year, for last 6 years, they will also ask you to file ITR. That's called block assessment. See, block assessment concept was also there when I am studying my CA final. I am studying in Finance Act 2020. In up to Finance Act 2021, block assessment is there. Later on, Nirmalamma removed block assessment. Again, she introduced block assessment after elections, after 1st September, like through Finance Act number 2 of 2024. So this is not new concept for me, but for you it is new concept. Okay. So the thing is, let's say search initiated on 10th June 2024. After they initiate search, they will complete the search. They will prepare Panchnama, last of authorizations. Let's say search completed on 14th June 2024. Now what they will say, 10th June 2024 to 14th June 2024. Along with this, last 6 years. Last 6 years means previous year 23-24, 22-23, 21-22, 20-21 1920, 1819. Entire this period they will call as block period. Now they will give notice under section 158 and they will ask you to file income tax returns of last 6 years. They will also ask you to file income tax return of current previous year from 1st April 24 to up to date of completion of search up to 14th June 2024. So from 1st April 24 to 14th June 2024, they will ask you to file ITRs. Okay, so this is called block period. That means whenever search is conducted on or after 1st September 2024, whatever the assessment that they will do, that assessment is block assessment. What do you mean by block? In current previous year, 1st April up to date of completion of search plus last 6 years. For this entire period, for this entire block period, you are required to file ITR. They will issue notice under section 158 and they will ask you to file ITR for block period. You are required to file ITR for entire block period. Are you able to understand? Sir, you already filed ITR under section 139(1). Already filed. Again, are you required to file ITR for block period? Yes, you are required to file ITR for block period. Are you able to understand? Let's say your total income is 100 lakhs. This is disclosed in ITR. Next. You got notice under section 148. As per 148, total income is 250 lakhs. After you file return, sorry, why 148? Notice was given under 158 block assessment. In response to block assessment notice, you have filed ITR. ITR income is 250 lakhs. Now, along with this block assessment notice, after you file ITR, he will issue notice under 143(2) and he will do scrutiny assessment. As per scrutiny assessment, total income is 340 lakhs. See, you were asked to file income tax return in response to block assessment notice. At that time, you should disclose everything fairly. Then also, you have secreted some income. Whatever the income that you have secreted, hidden income is there, 90 lakh rupees. This 90 lakh rupees, they will call as undisclosed income. Are you able to understand? So, whatever the income that is not disclosed in ITR is there, that got escaped from ITR is there, that we call as undisclosed income. On this undisclosed income, straight away they will levy tax at the rate of 60% plus penalty at the rate of 30% on tax. That means what? Tax at the rate of 60% means 90 lakhs into 60%. 54 lakhs. 54 lakhs into 50%. Sorry, penalty at the rate of 50% on tax. 54 lakhs into 50% means 27 lakhs. That means you need to pay tax liability of 81 lakh rupees. Simply 90% of undisclosed income you are required to pay tax. Sir, again whether surcharge is calculated? No. Again whether health and education cess will be levied? No. Again whether interest under 234 ABC will be levied? No. Already you are paying 90% of undisclosed income as tax. Again they do not levy surcharge. They do not levy health and education cess. They do not levy interest under section 234A. You will understand. So this is the concept. Shall I proceed? Shall I explain further? You know block period, right? This is block period. See, when notice was given for block assessment for previous year 2021, assessment is pending under section 143. Now, Will they continue that assessment? They will not continue that assessment. They will abate that assessment. That means they will stop that assessment and they will do assessment under only block assessment. Are you able to understand? That means what? Whatever the block period is there, in that block period, for any previous year, if any assessment is already continuing under 143.2 or 147, they will stop that assessment and they will do assessment under block assessment. Are you able to understand? Let's say for previous year 23-24, scrutiny assessment is pending. What they will do? They will abate. They will stop that assessment and they will do assessment under block assessment. For previous year 1920, ITAT already appeal was filed. ITAT order was passed. Now they will not touch. For this, whatever the matter that is already concluded in ITAT is there, for that block assessment they will not do, they will not touch, because that matter is already concluded in income tax appellate tribunal. Let's say there is one guy, Arvind Kejriwal. Against Arvind Kejriwal, search was conducted. After conducting search on Arvind Kejriwal, notice was given, block assessment notice was given. Now Arvind Kejriwal went to Supreme Court. He told elections are coming because of political vendetta. The opposition, like the ruling party, has done raid on me. Other than that, I do not have any income in my home. I do not have any assets in my home, he said. Supreme Court said whatever the search that is conducted on Arvind Kejriwal is there, that search is not valid, that search is not correct. And Supreme Court cancelled the search operations done by Income Tax Department. Once Supreme Court cancels the search operations, then whatever the assessments that were already abated are there, again they will be started. Are you able to understand? Again they will start. Again they will start. Are you able to understand? So generally, once block assessment proceedings are initiated, regular assessments will be stopped and block assessment will only be done. However, if block assessment is considered invalid by any court, in that case whatever the stopped proceedings are there, again they will revive. Are you able to understand? That is the next. Now there are two persons, Monish and Varun. Both are best friends, basically, Monish and Varun. So what they have done so many transactions. Whatever the transactions that they have done, only they knows, nobody knows. So they have maintained that information in such a secret way. On Monish, department has done search after 1st September 2024. I think I said one mistake previously. Monish, correct me. In case of income escaping assessment, time limit available is within 12 months from end of financial year, right? Income escaping assessment. Time limit for income escaping assessment. Yeah, 12 months from end of financial year, not end of month. I have made mistake here. Please rectify. End of financial year. End of financial year is 31st March 2026. From here, 12 months means 31st March 2027. Please make this change. Time limit for completion of income escaping assessment within 1 year or within 12 months from end of financial year in which notice is issued under section 48. Please make this. What, Monish? What are you doing when I'm saying this? So again, let's come back to block assessment. On Monish, raid was conducted by Income Tax Department after 1st September 2020. Now, so when they are doing search in Monish house, there are some assets belonging to Varun found. Both are best friends, na? So assets belonging to Varun were found in Monish house. Now, Monish resides in Chennai. Varun, let's say, resides in Bangalore. Now, what happened? Whoever the assessing officer of Monish is there, assessing officer of Monish will hand over these assets, hands over those assets to assessing officer of Varun. Then what assessing officer of Varun will do? He will issue like a notice under section 158. Block assessment notice under section 158 to Varun also. Like again, like uh, block assessment proceedings will be initiated against Varun as well. Are you able to understand? Time limit for completion of assessment. Completion of block assessment. Time limit for completion of block assessment is within 12 months from end of the month in which block assessment notice was issued. So whatever I said earlier, that is correct now. For income escaping assessment, 12 months from end of financial year. For block assessment, time limit for completion of is within 12 months from end of the month. Due to a lot of time limits, it's getting difficult, sir. No worries. I have planned to prepare one summary of time limit. I will try to do. So time limit for completion of block assessment. Let's say today, 28th July 25, block assessment notice was given. You have to take end of month. What is end of month? 31st July 25. From 31st July 25, again you need to consider 12 months. That means on or before 31st July 2020, block assessment order is required. Confusing. That's what DT is. Why many students feel tough DT is because of this. You are under stress also. See, 12 months from end of financial year, that is for income escaping assessment. 12 months from end of the month is for block assessment. Okay. I will give for you time limit for completion of assessment. For income escaping assessment, 12 months from end of financial year in which 148 notice is given. For block assessment, within 12 months from end of month in which notice under section 158 was given. I hope now you understood the difference. For income escaping assessment, end of financial year. For block assessment, end of the month. I hope now you understood the difference. This is why even in revision class also for assessment procedures, I am not rushing. If I rush, it will be like a Tamil movie. So this is the concept of block assessment. With this, shall we conclude for today? Now, last 5 minutes, some people are asking in the middle how to prepare. First of all, you all took regular coaching, right? For CA final or CMA final, mandatorily you should have regular coaching. I see many students who are relying on marathons and revision classes. Trust me, take any marathon, take any revision class, 100% explanation of concept is not possible. So, like definitely you should take like regular coaching. Once you take regular coaching, I am not saying just because I am DT faculty, I am not saying to make money from you. Okay, right now I am not making any money. You can inquire also, but really there are such like you need to have entire overview of DT. For that, you need to take regular coaching. Then you can rely on revision videos or marathons. Thereby, you can plan your study. Next, when you are studying, don't study at a stretch. When I use it to study, I will tell you maximum time I will study at a stretch is 2 hours. For every 2 hours, I will take break. There is no point. I cannot once I have my dinner, I cannot read. I will go to sleep. That's the norm. But I wake up very early. I use it to wake up at 4 o'clock, 4:30. And I use it to sit for my studies at 5 o'clock. 5 to 7 slot 1, 7 to 7:45 break. Like 7 to 7:45 I will bath, I will do some puja, I will eat breakfast. Next, from 7:45 to 9:45 slot 2. After 2 hours our mind cannot take the input. So for every 2 hours we need to give rest to our mind. So 7:45 to 9:45 slot 2. From 9:45 to 10, 15 minutes break. I will drink tea or I will do some casual walk. Again at 10, I will sit. 10 to 12, slot 3, 2 hours. After 12, I will take lunch break because I had early breakfast at 7 o'clock. At 12, I will have lunch. 12 to 12:45, I will have lunch. I will take some small nap. Again at 12:45, I will start. 12:45 to 2:45, slot 4. During afternoon, I will do only practical papers. Early in the morning, I will do auditing because that is theory. If I read it in the afternoon, I will sleep. So whatever theory chapters are there, that I will do in the morning. Afternoon, after 12, I will start doing practicals, FR, AFM, like that. Okay. Now, 12:45 to 2:45, slot 4. Again, 2:45 to 3:15, I will sleep in the afternoon. Sleep is mandatory. I will wake up at 3:15. I will fresh. I will start at 3:30. 3:30 to 5:30, slot 5. Again 5:30 to 6 break. 6 to 8, slot 6. That means from morning 5 to evening 8 I have covered 12 hours with enough breaks. Are you able to understand? So you can plan your studies like this. So study in a planned way. Next, you are giving slot for 2 hours now. In those 2 hours, what you have studied, you also plan how to study in those 2 hours. First 5 minutes or 10 minutes, plan how much you wanted to study in those 2 hours. That too, study for 40 minutes. In those 2 hours, first 10 minutes, like 2 hours, first 10 minutes is allocated for planning. Next 40 minutes, study. After that, 10 minutes revision. So with this, 1 hour completes. Next, for second hour, study for 45 minutes. Last 15 minutes revision. This is how you need to plan your study. Okay, if you plan this much scientifically, trust me, follow this 12-hour schedule, read it in a planned way, scientific way, definitely you will get rank, high chances. Sir, you said after Wednesday no revision. I hope Niranjan Rao, you saw the schedule, revised schedule. In revised schedule from 26 to 28, there were no. I'm sorry. In revised schedule on Thursday, Friday, Saturday, there are no classes. You see. So after Wednesday, Thursday also I will make it possible. On Thursday, I will do revision of appeals and revisions and equalization. Next, sir, I know that sometimes you will take sleeping time some more when you are getting it. I did not understand. And one more thing, 6 hours of sleep is mandatory. Every day, you should ensure 6 hours of proper sleep. If you skip the sleep, it will affect your preparation. Definitely. So plan your sleep schedule in such a way that you will get proper sleep of 6 hours. Along with that 6 hours, you will have some nap in between also afternoon and whenever breaks are there. Niranjan, sir, NR tax instead of appeals. Actually, you know, right? My relative died who is very close to me to attend for 10th, 11th, and 12th day. That's why I scheduled NR. Okay. Again, NR taxation is a bit of complex topic. I'm preparing running notes. I wanted to explain it in a better way. That's why I'm taking time. Other than that, so any more questions? That's it. What are the areas need to focus in this chapter? Assessment procedures. Survey, search, scrutiny assessment, income escaping assessment, block assessment, very, very, very important. And you also need to cover special audit 142 2A. These are highlights, important points. You also need to cover 144C dispute resolution. It's also important. 40 days lo DT and IDT can I finish? That depends. I hope Niranjan you took proper regular coaching for DT and IDT. If you took proper regular coaching for DT and IDT, definitely possible. Within 40 days, you can prepare DT and IDT. Actually, there is one staff. Actually, he is brother to me. He works for me for all these thumbnail designing. And he is also studying CA final. For him, I prepared one schedule. Okay. So I prepared a schedule of 35 days for DT and IDT. First revision. After 35 days, I will keep one exam for him. Mock exam 1. 2 days break on one, like first day DT, second day IDT. Thereby first revision gets completed. Second revision is for 15 days. After, like for that also I gave schedule to him. After second revision, I will keep mock exam. Then at last, revision 3. Revision 3 is for 6 to 7 days. no mock exam, 2 mock exams. After third revision, he will directly go to the final. So minimum you need to revise DT for 3 times. So if you do revision for 3 times, at least you can go to exam confident. How paper came in the examination, that will not determine whether you will qualify or not. How confidently you went to the examination, that determines. Kindly mention in the notes. See, okay, I will mention. Survey, search, next 142 2A special audit, 144C dispute resolution panel, 143.3 scrutiny assessment, next 147 income escaping assessment, block assessment. These are very, very important. CMA final results official date, I do not know. Yes, DT and audit, these two require a lot of review. Not that easy as you think. Some people, I have seen some people, DT, Telega, some important chapters I will study, I will get 40 marks. Not that simple. You will go to the examination, you will see DT paper, you will see stars in the, okay. Please don't think DT is easy. If DT is easy, see, IDT will be taught by many faculties. DT will be taught by only limited faculty because it's not that easy to handle the student in DT class. And don't take DT lightly. It will play with you. Okay, that's it. Shall we wind up for today? It's 9. We had long 2.5 hours session. Thank you. Good night. Bye. So tomorrow, tell me one thing. Shall we do appeals and revisions so that it will be in continuation? Or as per schedule, if you want me to do TDS and TCS, I will do TDS and TCS. At your option, what you wanted. Continuation. Okay. Better to continue. Okay, I think like tomorrow we will continue with appeals and revisions. Schedule will get postponed by 1 day. Don't worry, tomorrow also I will be. Tomorrow at 7 p.m. Okay. 30. Yeah, TDS TCS 8 marks I will discuss with you on day after, Wednesday. On Thursday, I will discuss with you advanced tax and investment securitization. So today's topic is appeals and revision. And I will also discuss with you equalization. These two topics we are going to discuss. Always appeal will be first preferred by SSC only. Normally, like assessment will be done regular assessment, scrutiny assessment, or best judgment assessment, or income assessment, or block assessment. Once assessment is completed, then what assessing officer will do? Assessing officer will give assessment order. Along with the assessment order, if any tax is payable or if any interest is payable, along with assessment order, demand notice will also be. So the point here is, once you receive assessment order, within 30 days, you need to pay the tax to the department. But whatever the assessment order that you have received, with the assessment order, SSC is not satisfied. Then what SSC can do? SSC can file appeal to CIT appeals or JCIT. If he is not satisfied, then he has an option. Two options. Within 30 days, make payment, or within 30 days, he can file appeal to CIT appeals or JCIT appeals. So always remember, first the appeal will be filed by SSC only. Department will never file. Once department issues assessment order and demand notice, if SSC is not happy, if SSC is not satisfied, if he wants to dispute any matter that is concluded by department, then SSC can file appeal with CIT appeals or JCIT appeals within 30 days from date of receipt of assessment order. Now, next question is, sir, when can they file appeal to CIT appeals? When can they file appeal to JCIT appeals? If assessment order, if this is passed by joint commissioner or with approval of joint commissioner. See, who passed the assessment order? Joint commissioner. Or assessment order was passed with the approval of joint commissioner. Whenever assessment order is passed with the approval of joint commissioner, it is to be challenged with higher authority. So whenever any assessment order is passed by JC or with the approval of JC, then it will be challenged with CIT appeal. CIT. If any assessment order is passed by income tax authority below rank of JCIT, below rank of JC. That means below joint commissioner, assessment order was passed by assistant commissioner or deputy commissioner, or assessment order was passed by income tax officer. In this case, it can be challenged with CIT appeals. Sorry, it can be challenged with JCIT. Logic is very simple. Who is passing the assessment order? The person, the income tax authority who passed the assessment order, above his authority, it will be challenged. If it is passed by JC, above JC, who is the authority? Commissioner. So it will be challenged with CIT appeals. If assessment order is passed by officer below the rank of JC, assistant deputy commissioner or ITO, it will be challenged with JCIT. I hope now you understood when appeal is to be filed with JCIT and when appeal is to be filed with CIT. Are you clear? Next. Assessment order passed. Now, SSC not satisfied. He will file appeal with CIT appeals or JCIT. Now, CIT or JCIT will give their order, right? Against this order, either SSC or department can file appeal. Are you able to understand? Always first appeal will be filed by SSC. To whom SSC will file appeal? CIT appeals or JCIT appeals. Next, once the matter is concluded by CIT appeals or JCIT appeals, CIT appeals or JCIT appeals will pass their order. Whatever the order passed by CIT appeals or JCIT appeals is there, it can be challenged either by SSC or by department. Let's say CIT appeals passed order in favor of SSC. Then what department will do? Department will challenge it at ITAT. Are you able to understand? Or CIT appeals passed order in favor of the department. Then what SSC will do? SSC will challenge the order of CIT appeals or JCIT appeals at ITAT level. Are you able to understand? So against this order, either SSC or department, they can challenge it at ITAT, income tax appellate tribunal. At ITAT, this is the ITAT is the last fact finding authority. What do you mean by this? See, there are 2 points: question of law, question of fact. question of fact. Against question of fact, maximum you can file appeal till ITAT level. Against question of fact, you can file appeal to CIT appeals or JCIT appeals. You can file appeal to ITAT, but you cannot file appeal to High Court. You cannot file appeal to Supreme Court. So against question of fact, maximum you can file appeal up to income tax appellate tribunal. Beyond income tax appellate tribunal, you cannot file appeal with regard to question of fact. With regard to question of law, you can file appeal to CIT appeals or JCIT appeals. You can file appeal to ITAT. You can file appeal to High Court. You can also file appeal to Supreme Court. Are you able to understand? Sir, what do you mean by question of law? What do you mean by question of fact? Question of fact means something which is which requires evidence. Let's say, like, income tax officer came to office for doing assessment. Income tax officer is saying bogus expenditure. SSC is saying he incurred expenditure really. So whether expenditure was really incurred or not, we need to examine the documents. We need to find out the evidence. We need to find out the fact whether expenditure was actually incurred or not. So this is question of fact. Are you able to understand? Next, SSC is saying he did not do sales, but income tax officer is saying sales was done, but sales were not recorded in books of accounts. So now we need to do investigation whether sales were actually done or not. So that is question of fact, whether it really happened or not, whether it is really in existence or not. That we call as question of fact. Next, sir, what do you mean by question of law? Expenditure P is there. SSC is saying revenue expenditure. Department is saying capital expenditure. Now it is question of law whether that expenditure is revenue expenditure or capital expenditure, that need to be determined based on law. So this type of question we call as question of law. Are you able to understand? So difference is there: question of law, question of fact. Question of fact means what? Whether that particular thing is really there or not, whether particular transaction is really happened or not, whether any transaction is in existence or not. That we call as question of fact. Question of law means what? Something like we need to interpret. So if there is question of law, like that means what? Two plausible interpretations are there. Department is interpreting in one way, SSC is interpreting in another way. So with regard to this, the ITAT or like appellate level is required to give the judgment. So this we call as question of law. With regard to question of law, you can file appeal up to Supreme Court, but with regard to question of fact, maximum you can file appeal up to income tax appellate tribunal. After income tax appellate tribunal, you cannot file appeal to High Court. However, you can file writ petition with regard to question of fact in High Court. Are you able to understand? How to file appeal to CIT appeals or JCIT appeals? You have to file appeal in form number 35. In form 35 along with fees. You need to make application for appeal in form number 35 along with appeal. Sir, what are required to be given in form number 35? In form number 35, we need to give four items. First, we will give assessment order. Whatever the assessment order that we are challenging, that should be given. Second, we need to give statement of facts. Statement of facts means what? For example, I incurred expenditure P. That expenditure is disallowed by income tax officer. My contention is expenditure should be allowed. It is revenue expenditure. Now, assessing officer disallowed it. Now, I am filing appeal to CIT appeals or JCIT appeals. I will write the facts. So, my company name is ABC and Co. I am doing so and so business. In this business, I incurred expenditure P, which is to be allowed as deduction. Okay, but income tax officer disallowed that expenditure. I will write what actually happened? What is the point that I actually wanted to challenge? That I will write in the form of statement of facts. And I will also write grounds of appeal. Sir, what do you mean by grounds of appeal? That means grounds of appeal means what? On which basis I am challenging the assessment order. As per so and so Supreme Court, expenditure P is allowed as deduction. So in my case also, expenditure P should be allowed as deduction. So on which basis I am saying expenditure P is revenue expenditure? On which basis I am asking department that expenditure P should be allowed as deduction? I can give reference of case laws in grounds of appeal. Along with that, I need to also submit challan. See, whenever you wanted to file appeal with CIT appeals or JCIT appeals, you need to pay some fees. Okay, only after payment of fees that appeal will be accepted. Are you able to understand? Sir, how much is the fees? If assessed income is up to 1 lakh, assessed income up to 1 lakh, fees for CIT appeals or JCIT appeals. How much is the fees? Fees is 250 rupees. If assessed income is more than 1 lakh and up to 2 lakh, then fees for filing appeal is 500 rupees. If assessed income is more than 2 lakh rupees, then fees for filing appeal is 1000 rupees. Are you able to understand? So we need to pay the challan. If we want to challenge it at CIT appeals or JCIT appeals, we also need to pay fees. Assessed income up to 1 lakh, fees is 250. More than 1 lakh up to 2 lakh, fees is 500 rupees. Above 2 lakhs, fees is 1000 rupees. We need to pay fees, and along with that we also need to file the appeal. In which form we will file appeal to CIT appeals or JCIT appeals? In form number 35. 4 items. What are they? Assessment order that we are challenging, statement of facts, grounds of appeal, challan. Okay, all these 4 are required to be given. Arlon. I'm sorry. So where am I? Yeah, I'm speaking with regard to fees. Now, what will happen? I will file. So I will file appeal along with. I will file appeal to CIT appeals or JCIT appeals along with 4 documents. Then what CIT appeals will do? CIT appeals or JCIT appeals will pass their order. Once such order is passed, now this is the problem. I will lose the flow. Yeah, CIT appeals or JCIT appeals will pass the order. Next, sir, is there any time limit for CIT appeals or JCIT appeals to pass the judgment to give the order? Yes, there is time limit within 1 year. Within 1 year from end of the financial year, in which appeal is filed with CIT appeals or JCIT. What do you mean by this? And this time limit is not mandatory time limit, it is advisory time limit. That means CIT appeals are so busy, they could not give judgment within 1 year from end of financial year in which appeal is received. Then also it is fine. General, basically, if you file appeal with CIT appeals or JCIT appeals, sometimes it becomes early, sometimes judgment will also come after 2 years or 3 years. So whatever this time limit within 1 year from end of financial year in which appeal was filed, that is only advisory time limit. Okay, that is not mandatory time limit. Next, see, CIT appeals or JCIT appeals will pass order. Na, this order can be challenged. by department or SSC. Okay. Now, what is the time limit for filing appeal with ITAT? With regard to this, there is an amendment. From 1st October 2024, amendment was there. So, like department or SSC can file appeal with ITAT. What is the time limit? Before 1st October 2024, appeal is to be filed within 60 days. Is to be filed within 60 days from date of receipt of order. But on or after 1st October 24, there is an amendment. Like within 2 months from end of the month in which order is. That means what? I will tell one example. Before 1st October 24, let's say CIT appeals or JCIT appeals order. Order was received today, 29th July 2020. Now within 60 days, I need to file appeal to ITAT. However, on or after 1st October 2024, I am getting 2 months time limit. That 2 months time limit is not to be calculated from date of receipt of order, but it should be calculated from, like 2 months is to be calculated from end of the month in which order is received. Let's say 29 July 2025, end of the month means 31st July 2025. From here 2 months, that means 31st August, 30th September 2025. Are you able to understand? So this is the variance. There is an amendment. Probably you would have taken coaching for earlier Finance Act. If you take coaching like that, please get updated. Okay. So from 1st October 2024 onwards, if you want to file appeal to ITAT, what is the time limit? Within 2 months from end of the month in which order CIT appeals order is received. Before 1st October 24, within 60 days from date of receipt of CIT appeals or JCIT appeals order. You will understand. See, generally in CIT appeals or JCIT appeals, judgment will be given by one person. Judgment by. But in ITAT, judgment is not given by single person. Judgment will be given by 2 or more persons who are called as bench. So when you see some case laws or when you read some case laws, you can observe like special bench of ITAT has given decision like this. So like in CIT appeals, JCIT appeals, only one person will hear the argument. But in case of ITAT, the argument will be heard by bench consisting of either 2 judges or more than 2 judges. But if assessed income, if total income is less than or equal to 50 lakhs, even in ITAT also, matter will be heard by single judge. Matter heard by single member. But if total income is more than 50 lakhs, okay, total income is more than 50 lakhs, then in ITAT, the matter will be heard by bench. Bench means what? Group of 2 or more members. Matter will be heard by bench. Bench consists of minimum 2 members and it will be enhanced either 2, 3, 4, 5 like that members can be there. Like generally bench consists of 2 members. Out of 2 members, one is accountant member, another one is technical member. Accountant member, technical member. Okay. Generally, accountant member will be a chartered accountant in practice who is having more than 25 years of experience. A technical member can be, lawyer, advocate who is having more than 10 years of experience. He will be appointed as technical member. He is also called as judicial member. Accountant member, judicial. Now you will get one doubt. Sir, with regard to one matter, accountant member is saying expenditure is to be allowed. Technical member is saying expenditure is to be disallowed. That means what? Here there is tie. One member is saying allowed, another member is saying disallowed. In this case, this matter will be referred to ITAT president. Then ITAT president will include another member, one more member. Then that member is required to give his judgment based on majority. That judgment will be passed by it. Are you able to understand? Next, if bench consists of 3 judges or like 5 judges or 7 judges, like that odd number, then there is no problem. Obviously, there will be majority opinion. Based on that majority opinion, ITAT order will be. Are you able to understand? Next thing is memorandum of cross objection. Sir, in shortcut, I call this as MOCO, memorandum of cross objection. Sir, what do you mean by memorandum of cross objection? Let's say CIT appeals passed order. Now I have time now to file appeal to ITAT. So SSC filed appeal with ITAT. Within 60 days only, he filed the appeal. Now, what ITAT will do? ITAT will give notice to department. What it will tell? Like ITAT will tell, so and so Umasankar SSC, he challenged the order of CIT appeals or JCIT appeals. This communication will be sent to income tax department. Now what income tax department can do? Within 30 days, income tax department can file memorandum of cross objection. So in that memorandum of cross objections, whatever the appeal that I filed, against that department can file memorandum of cross objections, or vice versa. Vice versa means what? Department challenged. CIT judgment, CIT appeals judgment came in favor of SSC. Now department filed appeal in ITAT. Whenever department files appeals at ITAT, ITAT will give notice to the SSC that department has filed like appeal to ITAT. Then within 30 days, I can challenge the department by filing a memorandum of cross objection. Sir, what do you mean by this? I will tell one point. Listen very carefully. Let's say expenditure A is there. This is to be allowed. This is to be allowed as per Supreme Court judgment. But a assessing officer disallowed it. Assessing officer asked me bribe. I did not give the bribe. The assessing officer disallowed it. Then what I did, I challenged this assessment order. When I challenged this assessment order, CIT appeals gave judgment in favor of me. It gave judgment in favor of SSC. Because that expenditure is to be allowed as per Supreme Court judgment. So CIT appeals gave judgment in favor of the SSC. Now, whatever the order passed by CIT appeals is there, this order is challenged by department with ITAT. Now, what ITAT will do? ITAT will give notice to me. ITAT give notice to SSC. What it will tell in the notice? Sir, like department challenged the order passed by CIT appeals or JCIT appeals with regard to expenditure A, it will tell. Now what I will do? I will file memorandum of cross objections. I will tell, sir, dear sir, who are there in ITAT, like department is wasting your prime time. Already Supreme Court judgment is there. Expenditure A is to be allowed as deduction. So that is the reason I won case in CIT appeals or JCIT appeals. Like department have some grudge on me. That's why department is again filing the appeal at ITAT level. Now I will tell entire this information to ITAT. I will file memorandum of cross objections. If you see movies relating to court, okay, memorandum of cross objections means what? If like opposition lawyer files anything, I can counter it by filing memorandum of cross objection. So here what is happening? Department is challenging expenditure A, which is allowed as deduction as per Supreme Court judgment, which is also allowed in CIT appeals order. Now it is wasting court's prime time. It is having grudge on me. That's why it filed appeal at ITET. Now I will tell to appeal. I will file memorandum of cross objections. In that I will tell department intentionally wasting ITET time. That expenditure is allowed as deduction as Supreme Court judgment. Then in such case, if it is valid, ITET may dismiss the appeal filed by department. Are you able to understand? Same, vice versa. Like if I file any appeal to waste ITET's time, then also department can file memorandum of cross objection. Are you able to understand? So I hope you understood the concept of memorandum of cross objection. Did you understand? Of course, these are theory chapters. For these theory chapters, you cannot expect so much of interesting stuff. These are like this only. Stay of demand. You will get another doubt. Sir, are we required to pay any fees for filing memorandum of cross objections? No, you are not required to pay any fees. Without paying any fees, you can file memorandum of cross objection. Is it clear? Stay of demand. What do you mean by stay of demand? Now, assessing officer passed assessment order. Along with assessment order, if I am required to pay any tax or interest, what assessing officer will do? He will also issue demand notice. Whatever the demand notice that is given, within 30 days from date of receipt of demand notice, within 30 days I have to make payment. Now I am not happy with the assessment order. What can I do? If I am not happy with the assessment order, then what I will do? I will file appeal with CIT appeals or JCIT. Now I can file appeal within 30 days. Now CIT appeals or JCIT appeals, they will take 1 year or more than that to give their judgment. Now department will run after me. Department will call me continuously. 30 days is over. You need to make payment of taxes. So now what can I do? I can apply for stay of demand with CIT appeals or JCIT appeals. So I will apply to CIT appeals. Sir, actually I need to pay 30 lakh rupees tax, but I challenged the order passed by assessing officer as the matter is pending with CIT appeals or JCIT appeals. See, if you give the judgment that I need to pay 30 lakhs, on that day I will pay 30 lakhs. But at present, department is calling me continuously. Department is running after me to pay 30 lakh rupees. Kindly give stay of demand. I will request with CIT appeals or JCIT appeals. When I request like that, CIT appeals or JCIT appeals, they can give stay of demand for 30 lakh rupees. That means like actually I need to pay tax within 30 days from date of receipt of assessment order. But if I get stay of demand from CIT appeals or JCIT appeals, I can wait. Okay. So like he will tell up to what time the demand is stayed. Till that time, department will not ask me to pay taxes. Are you able to understand? Generally, CIT appeals or JCIT appeals also have power to grant stay, but that is not there in our syllabus. What is there in our syllabus is ITET has power to grant stay of demand. Are you able to understand? I will tell another point. CIT appeals or JCIT appeals passed order in favor of department. Now, what SSC will do? SSC challenges this order. Where he challenges this order? SSC challenges this order at ITET level. Now, judgment came in favor of department. Immediately department will start calling me. It will ask me to pay taxes as 30 days is over. Now I challenged it. Within 60 days I challenged the matter with ITET. Now I will request ITET to give stay of demand. Stay of demand means what? Whatever the taxes that I need to pay, I am not required to pay immediately. Once the court gives judgment, once the ITET gives judgment, then based on that judgment, if I am required to pay, on that day I am required to pay. So till the time matter is concluded, I will be temporarily exempted from payment of taxes. That concept we call as stay of demand. So what I will do, I will request stay of demand from ITET. Okay, so whenever I request stay of demand from Income Tax Appellate Tribunal, then Income Tax Appellate Tribunal will grant stay only if I pay minimum 20% of tax plus interest. So whatever the assessment order is there, in that assessment order, I will be required to pay tax and interest, right? If I minimum pay 20% of tax plus interest, then ITET will grant stay of demand from me. That means balance 80%, even though I do not pay now, fine. Once the judgment comes at that time, if judgment came in favor of department, then I am required to pay balance 80%. Are you able to understand? So ITET has power to grant stay of demand, but SSC should minimum pay 20% of tax plus interest, or SSC should give security for minimum 20% amount of tax plus interest. Then department can grant stay of demand. Are you able to understand? Sir, maximum how much period department can grant? Department can grant stay for 180 days. That means once, sorry, not a department, ITET can grant stay of demand for 180 days. So once I get stay of demand from ITET for next 180 days, department will not call me. Department will not ask me to pay tax liability. But after 180 days, like whether whenever there is hearing, I am going, or my chartered accountant is going, but department is not coming, or there is COVID-19, all courts were closed. So that's why the hearing was not happening. So like genuinely I am coming to the court, but department is not coming, or I wanted to come to the court, but court is closed, ITET appellate tribunal is closed. Then even after 180 days also, whatever the stay of demand is there, it will not be vacated, it will be continued. So it will be continued, but maximum stay that can be granted is 365 days. Maximum stay allowed is 365. See, whatever generally stay will be granted for stay of demand will be given for 180 days. But if there is no mistake on part of the SSC, it can be further extended and up to maximum 365 days. Sir, you all know about Indian judiciary system. It will take longer years for a matter to get concluded, for a judgment to come. So, like 365 days also over. But no judgment was given by ITET. Now the question is, after 365 days, whether stay of demand gets vacated. Vacated means what? Gets completed, or still it will be continued. Actually, as per income tax law, maximum grant of stay of demand that ITET can grant is 365 days. But there is one Supreme Court case law. In that Supreme Court case law, Supreme Court held that even after 365 days also, if there is no mistake on part of the SSC, then stay of demand will be continued even after 365 days. Are you able to understand? So it will be continued as per Supreme Court case law if there is no mistake apparent on record on part of SSC. Then even after 365 days also, stay of demand will be continued. Let's say like I am the SSC. Every time there is hearing, I am going to the income tax appellate tribunal, but department is not coming. Sometimes department is coming, but COVID-19 due to various issues, that day session is getting closed. Now what can I do? Like see, if judgment came in favor of department, I am ready to pay tax. But 365 days is over, but the matter is not concluded. In this case, Supreme Court held that even after 365 days also, stay will continue if there is no mistake apparent on record on part of the SEC. Able to understand the concept of stay of demand. Now we are going to discuss our another point. What is the time limit for to give judgment for CIT appeals or JCIT appeals? Within 1 year from end of the financial year in which appeal is filed. Am I correct? For ITET, the time limit available is 4 years. Are you able to understand? So ITET has to give judgment within 4 years from end of financial year in which appeal is filed. Sir, whatever this 4 years time limit is there, is it mandatory time limit? It is only advisory time limit. That means ITET should try to give judgment within 4 years from end of financial year in which appeal is filed. Even if it gives judgment after 4 years, still it is valid, because whatever the time limit is there, that is not mandatory time limit. It is just the advisory time limit. Is it clear? Next, we are going to discuss powers of CIT appeals and JCIT appeals and powers of ITET. CIT appeals or JCIT appeals and power of C. CIT appeals can confirm assessment order. ITET also can confirm assessment order. CIT appeals can reduce assessment order. ITET can also reduce assessment order. CIT appeals can enhance assessment order, but ITET cannot enhance. What do you mean by this? I will tell one example. As per assessment order, total income is 50 lakh rupees. CIT appeals or JCIT appeals, ITET. Sir, can CIT appeals keep the income as 50 lakh rupees? Yes, possible. Can ITET keep the income as 50 lakh rupees? Possible. Can CIT appeals reduce income to 40 lakhs? Possible. Can ITET reduce income to 40 lakhs? Possible. Can CIT appeals increase the income compared with assessment order 60 lakhs? Possible. Can ITET increase the income up to 60 lakh rupees? Not possible. Are you able to understand? That means CIT appeals or JCIT appeals, they have power to enhance the assessed income, but ITET do not have any power to enhance the income. Are you able to understand? So CIT appeals, JCIT appeals, either they can increase the income or confirm the income or decrease the income, but ITET cannot do any harm to the SSC. Either ITET will tell income is as per assessment order, or ITET can reduce the income, but ITET do not have any power to enhance the assessed income. Are you able to understand? Second power. Sir, whether CIT appeals or JCIT appeals have power to set aside assessment order? Power to set aside assessment order? Sir, what do you mean by power to set aside assessment order? Assessing officer completed assessment, assessing officer passed assessment order. Now, CIT appeals, JCIT appeals, they wanted to tell whatever the assessment that you have done, it is wrong, and they wanted to order for fresh assessment. Can they order for fresh assessment? CIT appeals, JCIT appeals, they cannot order for fresh assessment. Are you able to understand? They cannot order for fresh assessment. So if there is any problem, CIT appeals, JCIT appeals, they have to do the assessment and they need to give the judgment. They do not have any power to set aside the assessment order, except in case of best judgment assessment. That is also amendment as per Finance Act number 2 of 2024. Are you able to understand? So generally CIT appeals, JCIT appeals, they do not have any power to set aside the assessment order. They cannot order for fresh assessment except only in case of best judgment assessment. Are you able to understand? But ITET has that power. ITET has power to set aside the assessment. Let's say Assing officer name is Monish. Monish has done the assessment. But ITET was not happy with the assessment order passed by assessment done by Monish. ITET can give the judgment, like ITET can pass the order, whatever the assessment order that is passed by Monish that is set aside, ITET can order for fresh assessment by another assessing officer, Varun. Are you able to understand? In this way, ITET has power to give the judgment, but CIT appeals, JCIT appeals, they do not have such power. Okay, except in case of best judgment. That means in case of best judgment assessment, CIT appeals, JCIT appeals, they have power to set aside the best judgment assessment. They can order for fresh assessment. Is it clear? Power to condone delay. Condone delay means what? Let's say I need to file appeal to CIT appeals or JCIT appeals within 30 days. But like let's say due to medical issues, I could not file. If I tell the reason, even after 30 days also, if reason is valid, they can admit application for CIT appeals or JCIT appeals. The same is the case with ITET. You need to file appeal within 60 days. But due to medical grounds, you could not file. Then it can entertain the appeal even if it is filed after 360 days, or even if it is filed after 60 days if reason is valid. Are you able to understand? Power to make inquiries. What do you mean by power to make inquiries? Let's say assessment order passed and the matter came before CIT appeals or JCIT appeals. If CIT appeals, JCIT appeals, if they want any extra information to pass the judgment, can they get that extra information? Yes, they can get that extra information. They have power to do inquiry of SSC as well as department. Same is the case with ITET. ITET also have power to do the inquiry if it is necessary before passing the judgment. Next. Power to grant stay of demand. CIT appeals can grant stay of demand. ITET also can grant stay of demand. Next. Power to reject appeal. That means like it is already evident. We discussed memorandum of cross objections. So because of silly reasons, if any appeal is filed with CIT appeals or ITET to get the grudge done, if any appeal is filed, they have power to cancel the appeal also. So whatever the appeal filed, that will be rejected. They have power to reject the appeal. Next, power to admit additional evidence. Do they have power to admit additional evidence? Yes. CIT appeals have power to admit additional evidence. ITET has also power to admit additional evidence. I will tell one example. Like income tax officer, he has written the observation, sales, dummy sales were done by Mr. Umasankar. Now, like I forgot to enter that bill in my GST return. For that sake, department has written, like Essing officer has written, I have done dummy sales. Now I requested, sir, please listen. I have raised e-way bill also. Goods are transported from Vijayawada to Hyderabad. Please look at this e-way bill. That is the mistake done by my accountant. He forgot to enter that in my GST return. That does not mean I have not done sales. I have done sales. Please look at the evidence. E-way bill is also there. I wanted to show to income tax officer, but income tax officer did not listen to me, did not even hear me. He straight away wrote the point. He passed the assessment order. I have made dummy sales. Now, like he did not give me opportunity of being heard. Now I will challenge this with CIT appeals or JCIT appeals. I will request CIT appeals or JCIT appeals to give me opportunity of being heard. When they give me opportunity of being heard, at that time I will show the actual e-way bill. So they have power to admit additional evidence from the SEC. Are you able to understand? So CIT appeals, ITET, they have power to admit additional evidence from the SEC as well. Are you able to understand? So these are the various powers. Next. ITET passed the assessment order. Sir, income tax appellate tribunal passed assessment order na. SSE, like let's say, can this be challenged? Yes, this can be challenged only if it is question of law. It can be challenged at High Court. Okay, if it is question of fact, it cannot be appealed. Cannot be appealed at High Court. See, even though it cannot be appealed at High Court, however, writ petition can be filed. With regard to question of fact, writ petition can be filed by. Sir, against ITET order, I can file appeal against High Court, either SSC or department. Any one of them can file appeal against order passed by income tax appellate tribunal. What is time limit? The time limit to file appeal is within 120 days from date of receipt of order order of income tax appellate tribunal. Let's say today I received order of ITET. From today onwards, within next 120 days, I have to make appeal to High Court against the order of ITET. Are you able to understand? Power to review. Power to review. Sir, what do you mean by power to review? We are discussing with regard to expenditure A, debate is going on. SSE saying expenditure A to be allowed as deduction, department saying expenditure A is to be disallowed. CIT appeals or JCIT appeals, they also disallowed the expenditure. Next, ITET. ITET also disallowed the expenditure. Now, you can see in some cases, even though judgment is given by Supreme Court, you can request Supreme Court to review its judgment. Reviewing its judgment means what? Already judgment that is passed. If there is any new evidence that they came to know after judgment is passed, then Supreme Court can review its judgment. Supreme Court can pass modified judgment or it can give altered judgment. But that power is not there with CIT appeals or JCIT appeals or ITET. See, CIT appeals passed order. Whatever the order passed by CIT appeals is there, it is final. You cannot request CIT appeals to review its judgment. Power to review their own judgment is not possible in case of CIT appeals or JCIT appeals. Power to review judgment is possible only with High Court or Supreme Court. That means what? Only High Court or Supreme Court has power to review their own judgment, but CIT appeals, JCIT appeals, ITET appeals, if they pass any order, that order is final. They do not have any power to review their own judgment. Are you able to understand? So that is the concept. Now, what High Court will do? High Court will give its order only with regard to question of law. Whatever the order that is passed by High Court is there. With this order, SSC or department are not satisfied. Then can it be further appealed? Yes, it can be. They can file appeal to Supreme Court. Within how many days? Within 90 days, they should file appeal to Supreme Court. Are you able to understand? So that is the, and Supreme Court also have power to review its own. Is it clear? I hope till here you are clear. This is the part relating to appeals. Next, I will discuss with you revision. So, with regard to appeals part, are you clear? I think today only few viewers are there considering this entirely theoretical concept. Should we remember powers of all departments? No, you need to remember powers of only CIT appeals. Very easy. You can remember. Shall I start with the revisions part? Now, revision. There is revision under section 263 and there is also revision under section 3. Now, first I will discuss revision under section 3. Assessing officer. Who is assessing officer? Additional Commissioner of Income Tax or Joint Commissioner of Income, Assistant Commissioner of Income Tax, Deputy Commissioner of Income Tax, Income Tax Officer. Now, these people, they can pass, they pass assessment order. Whatever the assessment order passed by like assessing officer is there, this assessment order can further be reviewed by bosses or top bosses. Bosses means CIT or PCIT. Top bosses means CCIT or principal chief commissioner. Or like the assessing officer means CIT appeals, JCIT appeals, and assessing officer means additional commissioner, joint commissioner, assistant commissioner, deputy commissioner, income tax officer. Like we discussed the income tax authorities concept. In income tax authorities concept, I have given you one table. In the table, we have discussed very clearly. You can see this table. Who are assessing officer? Additional commissioner, joint commissioner, assistant commissioner, deputy commissioner, income tax officer, additional director, joint director, and assistant director, deputy director can also be considered as officer. Bosses means CIT, PCIT. Top bosses means CCIT, PCCIT. Okay. Now, what happened? Like there is SSE. From SSE, AO took bribe. After taking bribe, AO like reduced total income and AO also reduced tax liability. So AO gave benefit to SSC. AO gave benefit to SSC by taking bribe. Who is superior to AO? Superior to AO is CIT or PCIT or top boss is chief commissioner or principal chief commissioner. Now AO passed assessment order na. Whatever the assessment order that is passed by AO is there, it can be reviewed. It can be reviewed by bosses, CIT or TCIT or Chief Commissioner of Income Tax or Principal Chief Commissioner of. Now, when bosses are reviewing, they came to conclusion whatever the assessment order that is passed is erroneous. Erroneous means what? Actually, it is clearly evident. Total income of SSC is 10 lakh rupees. But assessing officer took bribe from SSC and he reduced 1 lakh rupees. He decided total income as 9 lakh rupees. Or if we speak in lakhs, it is low. Let's speak in crores. Actually, total income of SSC is 10 crore rupees. But AO, while doing assessment, he reduced income. He reduced income to only 7 crore rupees. 3 crores income is reduced. So on 3 crore rupees, taxes were not paid to income tax department. So like whatever the assessment order passed is there, it can be reviewed by bosses or top bosses. When they are reviewing, bosses or top bosses, they came to conclusion whatever the assessment order that is passed is there, that is erroneous. Erroneous means what? Like it was given in favor of the SSC, which should not be given. Okay, so whenever assessing officer has passed the assessment order, then bosses have power to order for fresh assessment. Bosses have power to order for fresh assessment. Now, whenever they order for fresh assessment, it is harmful to SSC. As it is harmful to SSC, opportunity of being heard will be given to the SSC. So, before they order for fresh assessment, they will give opportunity of being heard to the SSC. So, they will give opportunity. If SSC wants to tell something, he can tell that to the department before they do fresh assessment. Able to understand? Sir, is there any time limit to pass revision order under section 263? Now, department like bosses can pass revision order under section 263. What do you mean by this? Then bosses will do the assessment. Bosses will increase the assessment. Bosses will tell total income is 10 crores and bosses will increase the tax liability. Whatever the increased tax liability is there, that is to be payable by the SSC. But before passing revisionary order under section 263, opportunity of being heard will be given to the SSC. Are you able to understand? Sir, is there any time limit? Yes. Bosses can do revision within 2 years from end of assessment year in which order is passed. What do you mean by this? Let's say assessment order passed on today. Let's say assessment order passed on 29th July 2025. What is end of assessment year? End of assessment year is 31st March 2026. From 31st March 2026, 2 years. That means up to 31st March 2028, bosses have power to pass the revisionary order under section 263. That's why normally in our offices, if assessment is completed, we will do party. Hammaya, happy, assessment got completed. Okay, client will also do celebration. But we should tell client, you don't celebrate. Whatever the order passed by assessing officer is there, that is not final. It can be revised by bosses or top level bosses within 2 years from the end of the year in which assessment order was passed. So once assessment order is passed, most 95% of the times it is safe. Balance 5%, bosses have power. They can review the file. Okay, they can review the file and they have power to revise the assessment order within 2 years from the end of the assessment year. And before revising the assessment order, they will give opportunity of being heard to the. Are you able to understand? So till here, did you understand? Next, I will explain you doctrine of partial merger and total merger. No parties till 2 years gets passed. Not 2 years, 2 years from the end of the year in which assessment order is passed. I can understand the topic is very boring to you. I can help, kindly bear with me. That's all I can tell. I can't keep explaining the topic. Now, I will explain you doctrine of partial merger. Sir, what do you mean by doctrine of partial merger? Doctrine of partial, let's say assessment order was passed with regard to matter A, matter B, matter C and matter D. Now, with regard to matter A and B, already appeal filed and it is pending at ITET. With regard to appeal C and D, there is no appeal was filed. Now, bosses, they wants to do revision. Wanted to do pass revision order under section 263. Now, can they pass revision order against matter A and B? They cannot pass. They cannot pass because they are already pending with CIT appeals or JCIT appeals. They wanted to pass revisionary order against matter C and D. Can they pass? Yes, they can pass. Are you able to understand? So why they can pass? Revisionary order. Revisionary order can be, but they cannot pass revision order against matter that is already pending with income tax, appellate tribunal or CIT appeals. Are you able to understand? So this concept we call as doctrine of partial merger. That means with regard to any assessment order that is passed, whatever the matters which are pending with CIT appeals or ITAT or High Court or Supreme Court are there, those matters will merge with higher authority. With regard to those matters, like CIT, like with regard to those matters, bosses have no power to pass revised assessment order. Bosses have power to pass revised assessment order only against those matters which are not challenged at any appellate level. Are you able to understand this concept, doctrine of partial merger? Sir, what partial merger? Whatever the matters that are pending with appellate authority is there, those matters will merge with appellate authority against balance matters, as like bosses can pass revisionary order. Are you able to understand this concept we call as doctrine of partial merger? Is it clear? Shall I explain section 264? Revision of other order. Generally, section 263 is in favor of department. Section 264 is in favor of S. Sir, what section 264 says? See, many times AO will pass the assessment order without listening to SSC. In that case, once assessment order is passed, AO, like SSC can file, SSC can request bosses, sir, AO passed the assessment order without listening to me. Please give some benefit to me. Please review this and please pass the revisionary assessment order. That income, like now, let's say section. Give me 1 second. What can I do? There is lot of disturbance. Like assessing officer passed assessment order. He disallowed expenditure B. Actually, expenditure B is allowed as per High Court. But so, what is the option that is available with me? I can file appeal to CIT appeals or JCIT appeals within 30 days. But I have so many things. I have classes, I have practice to handle. So many things are there. I forgot to file appeal with department with CIT appeals or JCIT appeals within 30 days. Now, after 30 days, can I file appeal to CIT appeals or JCIT appeals? Not possible, na. I cannot file appeal with CIT appeals or JCIT appeals. Then what I will do, I will request bosses, bosses or top bosses to review assessment order passed by assessing officer, because expenditure B is allowed as per Supreme Court decision, but assessing officer disallowed it and he passed the assessment order. Now I do not have time to challenge the same at CIT appeals or JCIT appeals. Then last option that is available to me is I can request bosses to review the assessment order passed by assessing officer. Now bosses it's up to their decision. If bosses wants to review the assessment order, they will review the assessment order, or they may ignore my application also. So it is not mandatory on part of bosses to review the assessment. Next. So if bosses review the assessment order, they cannot harm SSC. They cannot harm SSC means what? Like as per assessment order, total income is 80 lakhs. But whenever they review, they will pass revision order under section 264, right? As per revision order under section 264, total income is 90 lakhs. Can they increase total income when they pass revision order under section 264? They cannot increase the total income. Are you able to understand? Either they will keep total income as 80 lakhs, or they can reduce the total income. Like they can reduce the total income to 60 lakhs or 65 lakhs. They can reduce. That means as per revision order under section 264, bosses, they cannot do any harm to the SSC. Either they will keep the income as it is, or they will reduce the income. They do not have any power to enhance the income as per revision order under section 264. Practically 264 revision order, hardly it will be passed, okay, because why income tax officer will show interest in giving favor to the SSC? He will not show. So but that provision was written in the act. What can we do? We need to learn. That power is available with bosses or top bosses. Are you able to understand? So generally, after assessment order is passed, within 30 days, I have power. I can make appeal with CIT appeals or JCIT appeals. For example, if I do not file appeal within 30 days, afterwards, last remedy available to me is I can request income tax like commissioners, bosses or top bosses to review the judgment passed by, to review the order passed by assessing officer. In that case, if they show interest, they will review, otherwise they will not review. Now they will pass revision order. Now whatever the revision order that is passed under section 264, sir, can it be challenged? It cannot be challenged. Whatever this order passed is there, that cannot be. Are you able to understand? Let's say assessment order was passed for 4 matters: matter 1, matter 2, matter 3, matter 4. Sir, with regard to matter 1 and 2, I filed appeal with ITET. With regard to matter 3 and 4, I wanted to make application for revision order under section 264. Can I do? I cannot do. Are you able to understand? This concept we call as doctrine of total merger. That means with regard to any assessment order on any one matter, if I file any appeal with ITET or CIT appeals or High Court or Supreme Court on that entire assessment order, I will lose the power to make application for revision order under section 264. That means with regard to any one matter, I file appeal with ITET, High Court or Supreme Court, all matters will get merged with higher authority. I cannot make revision application under 264. This concept we call as doctrine of total merger. Are you able to understand? So this is revision under section 260. Now, one practical doubt many students ask, sir, judgment came in favor of the SSC. Then department will file appeal with ITET, High Court or Supreme Court, right? For every judgment that came against department, will it file appeal with ITET, High Court or Supreme Court? No. Generally, if tax effect is more than 50 lakh rupees, then department will file appeal with ITET. If tax effect is more than 1 crore rupees, then department will file appeal with High Court. If tax effect is more than 2 CR, then department will file appeal with Supreme Court. See, judgment came in favor of SSC and against department. Whenever judgment comes against department, then department will file the application, like department will file the appeal, right? So normally in every case, department will not file the appeal based on monetary limits. If tax dispute is up to 50 lakh rupees, Okay, it will not file any appeal. If tax dispute is more than 50 lakh rupees, then department will file appeal with ITET. If tax dispute is more than 1 crore rupees, then department will file appeal with High Court. If tax dispute is more than 2 crore rupees, then department will file appeal to Supreme Court. There is one amendment, there is one circular with effect from 17th September 2024. This is also recent amendment which was made in Finance Act, not in Finance Act. It was issued by way of circular, but relevant to your attempt. Before your attempt, this amendment was not there. Okay, so with effect from 17 September 24, if tax effect is more than 60 lakhs, then department will file appeal with ITET. If tax effect is more than 2 crore rupees, department will file appeal to High Court. If tax effect is more than 5 crore rupees, then department will file appeal to Supreme Court. Are you able to understand? This is the now. This is the concept relating to appeals and revisions. Now, shall we start discussing about equalization levy? Everybody, are you clear till here? Equalization. See, you know one concept we discussed in DTAA, double taxation avoidance agreement. Only in case of foreign company, is it required to pay tax in India? Yes, it is required to pay. కొంచెం మంచి ఫన్నీ ఎగ్జాంపుల్స్తో చెప్పండి. దిస్ ఈజ్ నాట్ రెగ్యులర్ క్లాస్, దిస్ ఈజ్ రివిజన్ క్లాస్. ఓకే, సో ఇన్ రెగ్యులర్ క్లాస్ వీ కెన్ హ్యావ్ ఫన్, బట్ ప్లీజ్ డోంట్ ఎక్స్పెక్ట్ ఇన్ రివిజన్. I have less time to revise all concepts. In this less time, you are expected to do comment. Equalization levy. See, foreign company is required to pay tax in India only if it has permanent establishment in India. So, when foreign company is required to pay tax in India only if foreign company is having permanent establishment in India. See, if you remember in DTAA, we discussed one concept. Business with foreign country, business in foreign country. If I make exports to USA, I am not required to pay any tax in USA because I am doing transaction with USA. Second point, like second case, I started a branch in USA. I am exporting goods to my branch. My branch is selling goods in USA. So whenever I open any branch in USA, I am having permanent establishment in USA. Whenever I have permanent establishment in USA, I will become taxable in USA. Are you able to understand? So only if foreign company is having permanent establishment in India, they are required to pay tax in India. Many times what happening, there are big giants na, let's say Google, Microsoft, Meta, all these companies, they are making money in India, but they are not paying taxes in India. Let's say there is my brand Phoenix by Uma. Now subscribers are very low initial stage. I wanted to give advertisement in YouTube, or I wanted to give advertisement in Instagram. So what I did, I gave advertisement. I gave advertisement in Google, Microsoft or Meta platform. Whenever I give advertisement, I need to make payment. Now, let's say I made payment 3 lakh rupees. Please don't think I made 3 lakh rupees. Definitely I will not make payment because that will be very huge. For example, I made payment of 3 lakh rupees. This 3 lakh rupees, like Google, Microsoft, Meta, they are earning from Mr. Umasankar, who is located in India. That means these platforms are making money from India, but like Google, Microsoft, Meta, they do not have any offices in India. Okay, they have offices in Hyderabad, but whatever the offices that are there in India, they are just preparatory offices. They do not provide any services in India. Let's say with regard to my YouTube channel, I got any problem. I need to mail this problem to YouTube located in USA, YouTube office located in USA. That means which office is helping me? YouTube office located outside India. It is helping me to resolve my YouTube problems or Gmail problems. Are you able to understand? So these problems are not addressed. Service is not provided by Google Office or Meta Office situated in India. Whatever the Google Office, Microsoft Office that is there in India, it is only providing auxiliary service. It is not providing any services in India. So all these big companies, what they are doing, like they are not having permanent establishment in India. What they are providing all the services from outside India, but they are making money from India. Now what I will do, I will prepare my P&L account. In my P&L account, I will claim advertisement expenditure 3 lakh rupees, but in P&L account of Microsoft, Meta and Google, whether 3 lakhs will be there, 3 lakhs will not be there because they do not have any permanent establishment in India. So what's happening? See, they are making money out of India, and the person who is making payment to these platforms, they are claiming expenditure, but they are not taxable in India because of double taxation avoidance agreement, there is no permanent establishment in India. We have discussed as per DTAA, only if there is permanent establishment in India, then only like outsider, foreigner is required to pay tax in India, otherwise he is not required to pay tax in India. Are you able to understand? So it has become a loophole. Everybody who is doing, like all these big platforms, they are making money out of India. Loophole is they do not have any permanent establishment in India. They are not paying any taxes in India. It has become a loophole. So there is OECD, Organization for Economic Cooperation and Development. So OECD observed that this loophole is there. Using this loophole, big giant companies, they are making huge margins in various countries. So they are, what they are doing, base erosion and profit shifting. They are not keeping permanent establishment in India. They kept permanent establishment in USA. So they eroded the base and they are shifting profits to outside India, and they are not paying taxes in India. So to counter base erosion and profit shifting, they come up with action plan. Okay, so OECD countries, they come up with action plan. One of the action plan is levying of equalization levy. Are you able to understand? So India is one of the countries to introduce the concept of equalization levy. Okay. So India is one of the countries to introduce the concept of equalization. Sir, what do you mean by equalization levy? Non-resident who is not having PE in India, not having PE in, if he provides any online advertisement service, if he provides any online advertisement service to any person in India, or to any non-resident having PE in India, then this non-resident or any person in India, they will make payment to NR having P, NR not having PE in India, right? From this payment, equalization levy is required to be deducted at the rate of 6%. It is just like TDS. See, whenever you are making payment to non-resident, you will deduct TDS at the rate of 6%, right? Same way, whenever any person who is in India or any foreign company who is having PE in India, whenever they are making any payment to non-resident who is not having PE in India, from that payment, why payment was made for receiving online advertisement services, if they make any payment, from such payment, equalization levy is required to be deducted at the rate of percent. Are you able to understand? Now, for example, like I received online advertisement services, I made payment of 3 lakh rupees. I should not pay 3 lakh rupees. From 3 lakh rupees, I am required to deduct equalization levy at the rate of percent. 3 lakh into 6%, 18,000, right? 18,000 I will deduct. Balance 2 lakh 82,000 rupees. This I will pay to Instagram. This I will pay to YouTube, Instagram, or Google, or Microsoft. Are you able to understand? This is the concept. But in practical, what happens? Like Google, Microsoft, they are located in USA. They do not know about equalization levy. They will provide me online advertisement services only if I pay 3 lakh rupees. They will say, boss, I do not know about equalization levy. Pay 3 lakh rupees. We will provide you online advertisement. Otherwise, they will not provide you online advertisement. In this case, what I will do? I will pay 3 lakh rupees. I will assume like actually if I want to pay 100 rupees, I need to deduct 6 rupees equalization levy. I need to pay only 94 rupees. Na? So I will assume 3 lakh rupees at 94. 100% means how much? 3 lakh divided by 94 into 100. Are you able to understand how much? 3 lakh divided by 94 into 100. 3 lakh 19,148 rupees. So 6% means 19,148. From my pocket itself, I will pay 19,148 as equalization. Able to understand? Sir, what if I do not deduct equalization levy? If I fail to deduct equalization levy, entire equalization levy amount I need to pay as penalty. For suppose, in this case, I did not deduct equalization levy, then I need to pay 18,000 equalization levy. In addition to that, I need to pay penalty of another 18,000 rupees. So equal amount will be levied as P. Is it clear? And this provision of equalization levy is applicable only if payment in a financial year is more than 1 lakh rupees. Then only equalization levy concept is applicable. Otherwise, equalization levy concept is not applicable. Is it clear? Are you able to understand? Uh, hmm. Now, there is Varun. Varun is very interested in marriage. Am I correct, Monish? Varun is there? So Varun is very interested in marriage. Varun has some specific desires. He wants his wife to be in a particular way. He wants his wife to be a chartered accountant. He wants his wife to be fair. He wants his wife to be of certain size, certain height. Okay. He wants his wife to be from south. Okay. He has some, some special desires that he wanted in his wife. So Varun is so rich guy. So what Varun did? So Varun gave advertisement in Instagram. Okay, in Instagram he said requirements of wife. He has written chartered accountant. She should be from south. Okay, she should be having some special height. She should look fair. So all these qualities he has written, and he gave advertisement, and he made payment 5 lakh rupees. Okay, so Varun wants to find one nice girl to get married. So he gave one Instagram post with 5 lakh rupees advertisement. So whatever this advertisement is given, it is completely personal in nature, na. Fantasies and dreams of Varun. Yes. So it is entirely personal in nature, na. So whenever this is personal in nature, even the payment made is more than 1 lakh rupees, still no equalization levy is required to be deducted. Are you able to understand? I did not see Varun. I wanted to see Varun. Only send the pic of Varun once. Okay. So So the ultimate concept is, if any payment is made for online advertisement and if the amount of payment made is more than 1 lakh rupees, still if payment is made for online advertisement and such online advertisement is completely personal in nature, then no equalization levy is required to be. Is it clear? So this is the concept relating to equalization. So I hope you are clear with today's session. I can understand today's session is a bit boring because the chapters that we have discussed are like that. Can't help you. If you have any further doubts with regard to concept, please ask in Telegram group. One more thing, uh, like those questions which you feel tough, which you wanted me to discuss in this live session, please bring those questions. Please add those questions in Telegram group. I will discuss in live class. Okay. So let's conclude for today. Tomorrow we are going to discuss with regard to TDS and TC. First, today's topic is trust taxation. Very important chapter in CA final. At least 8 to 10 marks can be expected from this chapter. Definitely one question will come from. So I request everyone to listen carefully till the end of this live session. Okay. Sir, what are the sections that we are going to discuss in this revision series of trust? We will discuss section 11, 12, 13, 115 BBC anonymous donations, 115 BBI and 1023C related section. All these sections will be discussed in this class. First, I will start with section 11. I will take a fresh page. What section 11 says? First of all, section 11 says income derived from property held under trust. Whatever the income derived from property held under trust is there. For that, certain exemptions are given under section 11 and 12. The income derived from property held under trust of charitable or religious trust. Whatever that income is there, out of that income, 15% standard deduction is allowed. That means 15% of such income is not at all taxable and only balance 85% is taxable. Sir, what do you mean by charitable or religious trust? Charitable trust means any trust that is formed for to help poor or for the relief of poor or for the upliftment of poor. So the trust we call as charitable trust. Religious trust means any trust whose main objective is promotion of that particular religion. The trust we call as religious trust. So what section 11 says, whatever the income received by, whatever the income derived from property held under trust of charitable or religious trust is there. From that income, you can claim exemption under section 11 and 12. Now the question is, sir, what do you mean by income derived from property held under trust? Income derived from property held under trust means we can say rental income. For example, trust is having a function hall. Function hall is given on rent for marriage. So by giving function hall on rent, you are getting rental income. That rental income you can call as income derived from property held under. See, big trusts are there like TTD and Shirdi Sai Trust, Sri Sailam Trust. So many trusts are there. All these trusts, whatever the income that they receive, all that income they are going to claim exemption under section 11. So what section 11 says, income derived from property held under trust is eligible for exemption under section 11. Income derived includes rental income. Not only rental income. See, what is the main income of trust? Donations. If you go to Tirupati, you will deposit some money in the hundi. Okay, so even whatever the donation income is there, even donation income is also considered as income derived from property held under trust. These donations are classified into two types: general donations, corpus donation. General donations are like treated as income derived from property held under trust. And whatever the corpus donation is there, corpus donation is not at all taxable. Corpus donation is fully exempt, subject to the condition whatever the amount received for corpus fund is there, that is to be deposited in safe modes as per section 11.5. Okay, what are those safe modes? I will discuss little later, but for the time being, please remember, like general donations are treated as income derived from property held under trust. Corpus donation is fully exempt. Sir, what do you mean by corpus trust? If any donation is given with specific direction, the donation should be used as a corpus fund of the trust, then that donation we call as corpus fund, okay, or corpus donation. Let's say I went to Tirumala Tirupati Devasthanam, I gave 10 lakh rupees donation, I gave instruction this 10 lakh rupees should be form part of corpus fund of TTD, then that type of donation we call as corpus donation. So corpus donation is like capital receipt which is not used generally unless in exceptional situations. Income derived from property held under trust also includes income from movable assets. Let's say on shares and securities, you will get interest income and dividend income. Even that income is also considered as income derived from property held under trust. So income from movable property. Anyhow, income from immovable properties is also treated as income derived from property held under trust. Next. Whatever the business income is there, see, Tirumala Tirupati Devasthanam is there, it is selling laddus, it is selling agarbattis, that is also business na. So if business is incidental to attainment of main objectives of the trust, then even that business income is also considered as income derived from property held under trust. Are you able to understand? Give me 1 second. ISKCON temple is there, it sell Bhagavad Gita books. Selling of Bhagavad Gita books is incidental to main objectives of ISKCON. So even that business income is also considered as income derived from property held under trust. But the only thing is, whatever the business income is there, for that separate books of accounts are to be maintained and are required to get audited. Then only business income will be included in income derived from property held under trust. Whatever the income that forms part of income derived from property held under trust is there, from that you can claim section 11 and 12 exemption. Capital gains. See, trust will have capital assets, right? On sale of capital assets, whatever the capital gains that are received are there. Even capital gains are also considered as income derived from property held under trust. Next, if there are any other receipts, even other receipts will also be considered as income derived from property held under trust. Let's say you wanted to do charity, you got some amount out of the donation, that will be included as income derived from property held under. Now what I said, whatever income derived from property held under trust is there, out of that 15% is straight away not at all taxable. 15% will be set aside, 15% standard deduction will be allowed, and only balance remaining 85% is taxable. So income derived from property held under trust. So out of this, 15% standard deduction is allowed. 15% standard deduction allowed. Balance 85% is there, right? Remaining 85%. Out of remaining 85%, whatever the amount that is applied for charitable or religious purposes is there, that is eligible for deduction. What do you mean by this? Let's say, for example, income derived from property held under trust is 80 lakh rupees. Out of 80 lakh rupees, 15% standard deduction is allowed. 80 lakhs into 15%, how much? 12 lakhs is standard deduction. How much is balance? 80 lakhs minus 12 lakhs, 68 lakhs. So out of 68 lakhs, whatever the amount that I have applied for charitable or religious purpose is there, that is allowed as deduction. Whatever the amount applied for charitable or religious purpose is there, that is allowed as deduction. Let's take an assumption, I applied 20 lakh rupees for charitable or religious purpose, that will be allowed as deduction. Sir, you are saying 20%, like you are saying applied for charitable or religious purpose is allowed as deduction. What do you mean by applied? Applied means any expenditure incurred by trust for attaining its main objectives. whatever the expenditure, TTD is incurring expenditure of salaries of employees and like daily Annadanam expenditure. So whatever the expenditure incurred by trust to achieve its main objectives is there, that expenditure we can consider as applied for charitable or religious purpose. Another important point, applied means both revenue expenditure and capital expenditure. Let's say there is Umasankar trust. Okay, I constructed a temple in that trust. In that temple, there is also a function hall. I wanted to give that function hall on rent. From that function hall, whatever the rental income that I receive, that rental income will be considered income derived from property held under trust. Now the thing is, in that function hall, it is normal function hall. I wanted to convert it into AC function hall. So I installed 8 ACs. Each air conditioner cost is 50,000 rupees. 50,000 into 8, 4 lakh rupees. It is capital expenditure na. Still total 4 lakhs will be allowed as deduction, because whatever the amount that I spent for charitable or religious purpose is there, whether it is revenue expenditure or capital expenditure, total expenditure will be treated as applied. Are you able to understand? So both revenue expenditure and capital expenditure will be allowed as deduction. Another important point, you will get doubt, sir, 4 lakh rupees air conditioners I claimed as expenditure, I treated it as applied. Again on that 4 lakhs, will depreciation is allowed? No. Once you claim 100% of the capital expenditure, again depreciation is not allowed. So the thing is, once you claim capital expenditure, again depreciation in second year is not allowed. Who said? As per section 11.6. Okay. So the thing is, whatever the amount that you have applied for charitable or religious purpose is there, entire amount, whether it is revenue or capital expenditure, is treated as applied. But if you claim capital expenditure as applied, depreciation on such capital expenditure is not eligible for deduction from second year onwards as per section 11.6. So out of 68 lakh rupees, I claimed 20 lakhs. How much is balance? Balance is 48 lakhs. Sir, is there any way that I can reduce this 48 lakhs also? Before that, let me tell one point. Generally, whatever the income derived from property held under trust is there, 15% set aside, standard deduction is allowed, balance 85% is taxable. Out of that 85%, whatever the amount applied for charitable or religious purpose is there, that is allowed as deduction, balance is taxable as per slab rates. Trust is AOP na, so for AOP slab rates are applicable, right? So whatever the income that is left after charitable or religious purpose is there, that is taxable at the rate of slab rates. If trust follows default tax regime, those slab rates are applicable, otherwise normal slab rates are applicable. Now next point is, sir, is there any way that we can reduce this 48 lakhs also? Here we need to pay tax on 48 lakhs. Can we reduce our income? Is there any possibility? Yes, there is possibility. What is that possibility? Explanation 1 of section 11.1. So as per explanation 1 of section 11.1, there are two ways further you can reduce your income. First option available is outstanding amount. Sir, what do you mean by this? I have function hall na. On 20th March 2025, I gave function hall on rent. Rent amount is 5 lakh rupees. I took advance of 1 lakh rupees, balance 4 lakh rupees I did not receive. How much is rent? Rent is 5 lakhs. I received advance of 1 lakh, balance 4 lakh was not received. Trustee is following accrual basis of accounting. If trustee is following accrual basis of accounting, then 5 lakhs will be included in the 68 lakhs, right? 5 lakhs will be included in 68 lakhs. In the 68 lakhs, 5 lakhs will be included. But how much I received? I received only 1 lakh rupees. On 20th marriage, there is On 20th March, there is marriage, but marriage got cancelled. Okay, so like there is disturbance and marriage got cancelled. Those people did not give money to the trust. Now what happened? I received only 1 lakh rupees advance, but as per accrual basis of accounting, I need to include 5 lakh rupees in my total income. Na? So now the thing is, whatever the amount that I did not receive, 4 lakh rupees, for those 4 lakh rupees, I will file declaration to assessing officer. Sir, whatever the outstanding amount is there, that outstanding amount I will apply in the previous year in which it is received or in the immediately next financial year. Are you able to understand? And now itself I will take that deduction. So here I will claim 4 lakhs as deduction. So 5 lakhs is rent, 1 lakh rupees I have received, balance 4 lakh rupees I did not get. In future I may get. So in future, whenever I receive that 4 lakh rupees, either in that year or in immediately next financial year, I will apply that 4 lakh rupees. Stating all this, I will file declaration to assessing officer. Then by filing declaration, I can claim it as deduction. But this declaration should be filed within 2 months before the ITR due date. Then only this deduction is available. Now, next year, the same girl came. Okay, so the marriage got cancelled. The same girl with another bridegroom, he came and got marriage done in our temple trust. At the time, she said, sir, earlier year marriage got cancelled. We were not able to give you the money, but right now I am getting married. So she paid balance arrears 4 lakh rupees also. 4 lakh rupees received in 25-26. So in 25-26, I should apply 4 lakh rupees for my charitable or religious purpose. Or in the immediately next financial year, in 26-27, I should apply 4 lakhs for my charitable or religious purpose. If I fail to apply, then whatever the amount that I did not apply, it is taxable under section 115 BBI at the rate of 30%. Let's say this is the story of previous year 24-25. In previous year 26-27, this 4 lakh rupees was received. So whatever 4 lakhs received is there, that I should apply either in 26-27 or what is immediately next financial year 27-28. So out of 4 lakh rupees, I applied 2.5 lakhs. I did not applied till 31st March 2028. That means before 27-28, I could apply only 2.5 lakhs. 1.5 lakh was not applied. As it is not applied, this is taxable under section 115 BBI at the rate of 30%. Are you able to understand? So as per explanation 1 of section 11.1, if there is any outstanding amount, if you are following accrual basis of accounting and if entire amount is included in income derived from property held under trust, whatever the amount that you could not receive in current year is there, that you can claim as deduction. But the year in which you receive that amount, in that year you should apply, or in the immediately next financial year you should apply. If you fail to apply, whatever the amount that you did not apply is there, that amount is taxable under section 115 BBI at the rate of 30%. Are you able to understand? Second option, bumper donation. Sir, what do you mean by bumper donation? On 31st March, I got 8 lakh rupees. How much I got? Bumper donation 8 lakh rupees. If I get on 31st March, how can I apply it in one day, enter 8 lakh rupees? That is not possible, na? So, if I get any bumper donation at the end of the previous year or for any other reason, whatever the amount that is there, I can file again declaration to assessing officer. Sir, like I can file declaration to income tax authority. What is the time limit? Within 2 months before ITR due date, I should file application to assessing officer, and whatever the amount is there, bumper donation, like I will file declaration, I will spend this amount in the immediately next financial year. So in 24-25, I got bumper donation of 8 lakh rupees. I could not apply in 24-25. So what I will do, I will give declaration 8 lakh rupees I will apply in 25-26, for which AO will grant acceptance. Okay, so in 25-26, I should definitely apply 8 lakh rupees. If I fail to apply 8 lakh rupees, then whatever the amount that I could not apply in 25-26 is there, that is taxable under section 115 BBI at the rate of 30%. So what I will do in current previous year on 31st March, I got 8 lakh rupees bumper donation. Total 8 lakh rupees I will claim as deduction. So whatever 8 lakh rupees is there, that I should apply in 25-26. But out of 8 lakh rupees, 5 lakh rupees I applied, 3 lakh rupees was not applied. Whatever the amount that was not applied is there, that amount is taxable under section 115 BBI at the rate of 30%. Next, shall I explain further? Sir, out of 48 lakhs, we have reduced our income by 12 lakhs. 48 minus 12, 36 lakhs. Now, are we required to pay tax on 36 lakhs or is there any further choice? Yes, further choice is available. If one trust gives donation to another trust, whatever the donation given to another trust is there, that is also eligible for deduction. So, like general donation by one trust to another registered trust, one trust to another registered trust. But total donation given is not eligible, not treated as applied. Only 85% of donation given is treated as applied. Let's say Umasankar Trust gave 2 lakh rupees donation to Monish Trust. Now, how much is donation given? Donation given is 2 lakh rupees. Total 2 lakhs is not treated as applied. Out of 2 lakhs, 85% is treated as applied, 1.7 lakhs. So very important, only 85% of donation given is treated as applied. Another important point, if one trust gives corpus donation to another trust, that is not treated as applied. Only if general donation is given, then only it will be treated as applied. Whatever the general donation given, total general donation is not treated as applied. Only 85% of general donation given will be treated as. If I borrow any loan, whatever the loan amount that I have borrowed, that loan amount I will incur in current previous year. Let's say like trust is charitable, I am not getting much income. So I took 1 lakh rupees loan. 1 lakh rupees, using this 1 lakh rupees loan, I paid salaries of all employees of the trust. The year in which I took loan and I paid salaries, in this year that will not be treated as applied. Let's say in 24-25 I took loan. In 24-25 I took loan of rupees 1 lakh. Using this 1 lakh I paid salaries. Out of this 1 lakh rupees I paid salaries in 24-25. Whether it is treated as applied in 24-25, no, it is not treated as applied in 24-25. This 1 lakh rupees, like I repaid loan along with interest, loan plus interest, 1,20,000 rupees in 25-26. In 25-26, it is treated as applied. That means what? The year in which you took the loan for the purpose of salaries, in that year it will not be allowed as deduction. In that year it will not be treated as applied. But whatever the loan that you have taken, that loan you will repay na. The year in which you repay the loan along with interest, both loan repayment, interest expenditure, both are allowed as deduction in the year of repayment. Are you able to understand? So how much is the loan that I took? I took loan of rupees 1 lakh rupees. Whether in 24-25 is it allowed as deduction? No. The year in which you took the loan, that is not the criteria. The year in which you repay the loan, that is the criteria. Okay. So loan or borrowing repaid along with interest. So the year in which you repay the loan along with interest, in that year it is allowed as deduction. Are you able to understand? Accumulation under section 11.2. Sir, what do you mean by accumulation under section 11.2? There is a temple under my trust. For that temple, I wanted to build another function hall. Already one function hall is there that is congested. I wanted to build second function hall with bigger area. See, I am getting donations. I am not denying it. With 1 year donations, can I build function hall? That is not possible. So what I will do, like I will accumulate the amount every year. After accumulating the amount, I will use this amount for the purpose of construction of another function. So like this is the thing that is used in many offices. Whatever the income is there on which tax is payable, like they will create some specific purpose. Let's say I wanted to build a function hall, that is specific purpose. For that, I will accumulate the money. So I should give declaration to assessing officer under section 11.2 before 2 months before ITR due date. In the declaration, I will tell specified purpose. What is specified purpose? Specified purpose is construction of function hall. I will tell how many years that I will accumulate. Maximum I can accumulate is 5 years. See, this is 24-25 na. Ignore current previous year. Other than current previous year, in next 5 years, I can accumulate the money. I can build the function hall. I can utilize all this money for the purpose of construction of this function hall. And in current previous year, I can claim it as applied. Are you able to understand? So, till here, how much is there? Like 36 minus 1.7. 34.3 lakhs is there. So out of 34.3 lakhs, I wanted to accumulate 10 lakh rupees. Let's say to construct function hall, it will cost me 50 lakh rupees. I wanted to accumulate every year 10 lakh rupees. So what I will do every year, like I will accumulate. I will tell the specified period. I can tell period 2 years, 3 years, 4 years, like that. Maximum I can tell 5 years. Maximum period allowed is 5 years other than current previous year. Other than current previous year, maximum I can accumulate for 5 years. Next, third point, whatever the accumulation that I have done, what I am doing, I am accumulating 10 lakh rupees for the purpose of construction of function hall. This 10 lakh rupees I should deposit in safe modes. Then only deduction is allowed, otherwise deduction is not allowed. So you should deposit in safe mode. That is next point. Last point, whatever the amount 10 lakh rupees that you deposit in safe mode is there, that should not be given as donation to another trust. Okay, should not be given as donation to another trust. If all these 4 conditions are satisfied, then you can accumulate the money for specific purpose for specified period, and whatever the money that you have accumulated, that you can claim as deduction. Are you able to understand? So I hope you are all following. I think there is delay that's going on. So yeah, 4 conditions. If you want to accumulate money for specific purpose, 4 conditions. You should give declaration to assessing officer before 2 months before ITR due date. In that declaration, you should tell specific purpose, you should tell specific period, you should deposit that money in safe mode, and you should not use that money for any donation to any other trust. If all these 4 conditions are satisfied, and if you have given declaration to income tax authority before 2 months, then whatever the amount that you have accumulated, that you can claim as deduction. Now there are chances now you can violate these conditions. In current year you will claim 10 lakhs as applied, but in future year you may violate the condition. You may treat this money for other purpose, or you will after 5 years, like you said you will construct function hall in 5 years. After 5 years, out of 10 lakh rupees, only 9 lakh rupees was used, 1 lakh rupees was unutilized. So whatever the unutilized money is there after expiry, and Like you said, you will deposit in safe modes, but you have deposited in other modes. You said you will not give donation to any other trust, but you have given donation. All these are violations, na? So whatever the violation is there, all these are violations. So whatever the violation is there in the year of violation, these are taxable under section 115 BBI at the rate of 30%. Year of violation, taxable under section 115 BBI at the rate of. So that is the concept relating to section 11.2. Here, one important point is there. Maximum accumulation allowed is 5 years other than current previous year. So, like I gave declaration, I specified 5 years. Now, I wanted to buy land for the purpose of construction of function hall. But I gave advance for land also. After 1 year, that land was under litigation and court gave stay on that land. Whatever the time that I lost because of stay by court, okay, that period is to be excluded while calculating this 5 years. Are you able to understand? We discussed corpus fund, right? Initially, corpus fund. Generally, there is Trust Act as per Indian laws. As per that Trust Act, you should not use corpus fund. Only in emergency cases, you can use corpus fund. Let's say Tirumal Tirupati Devasthanam is there. COVID has come, no devotees are coming, no deposit, no devotees are giving donations. So TTD has to pay salaries to all its staff. It has to pay electricity expenditure and all expenses are there. Donations are not coming, but it needs to pay expenses. So there is no income, but expenditure is there, outflow is there. To incur that expenditure, TTD is not having money. Then what TTD will do? TTD will take some amount out of corpus fund and use this amount for the purpose of payment of expenses. So, like the year in which you take amount out of corpus fund in 21-22. In previous year 21-22, 15 lakhs, let's say, like we are discussing about Umasankar Trust, 15 lakhs was taken out of Umasankar Trust corpus fund, okay, corpus fund, and this amount is used for payment of all expense. In 24-25, what I have done, I got income 15 lakh rupees. This 15 lakh rupees, like I have used it for repaying to corpus fund. That means what? I repaid back of 15 lakh. I took 15 lakhs from corpus fund in 21-22. Now, whatever 15 lakhs that I took and paid salaries in 21-22, that amount I repaid back to corpus fund in 24-25. In 24-25, it is allowed as applied. See, here observe. In 21-22, I took 15 lakh rupees. I paid salaries in 21-22, but the year in which I paid salaries, in that year it is not treated as applied. It is treated as applied in the year in which I repaid back that amount to corpus fund. Are you able to understand? So another deduction allowed is income used for deposit back to corpus fund. Deposit back to corpus fund. 15 lakh rupees. Here there is one important point. I took money from corpus fund. I spent this amount for salaries. The year in which I took out the money, when I took out the money, I took out the money in 21-22. So previous year 21-22, ignore. Next 5 years. Next 5 years means 22-23, 23-24, 24-25, 25-26, 26-27. So on or before 26-27, I should repay back to corpus fund. Then only it is treated as applied. If I repay back in 27-28, it is not treated as applied. So whatever the amount that is taken out of corpus fund is there, that you should repay it back to corpus fund within 5 years from the end of the year in which you withdraw that money. Then only it will be treated as applied. Otherwise, it will not be treated as applied. Are you able to understand? So most of the points I have covered. After reducing this 15 lakhs, how much is balance available? Balance available is 34.3 minus 10 lakhs minus 15 lakhs. Balance 9.3 lakhs is available. This 9.3 lakhs is taxable at slab rate. Do you remember 40A3 in PGBP? Per person per day, you should not make cash payment of more than 10,000 rupees. 40A3 provisions are also applicable for charitable or religious trust. That means whenever you are incurring revenue expenditure or capital expenditure per person per day, if you make cash payment of more than 10,000 rupees, it will not be treated as applied. Are you able to understand? Next, 40A3. Next, 40A1A. When you are making payment to resident, two conditions are there. You should deduct TDS before 31st March of previous year, and deducted TDS you should deposit to government before ITR due date. If both these conditions are satisfied, then 100% of the expenditure is allowed. Otherwise, 30% of the expenditure is disallowed. Same provisions are applicable for trust as well. Are you able to understand? So, 2 points. If you make cash payment of more than 10,000 rupees per person per day, that will not be treated as applied. When you are making payment, you forgot to deduct TDS, or you deducted TDS but you did not deposit to government, that will also not to be treated as applied. Are you able to understand? So whatever 40A3, 40A3A and 40A1A provisions are there, 40A3A, earlier year you have claimed as deduction on accrual basis, but in current previous year you paid in cash more than 10,000 rupees per person per day. In current year it will be disallowed and it will be treated as income. So 40A3, 40A3A, 40A1A, all these three provisions which we have studied in PGBP, same are applicable for trust taxation also. Okay, so this is how we are going to calculate income of charitable or religious trust as per section 11.1. Section 11. I hope you understood it. So quickly I will revise. Whatever the income derived from property held under trust is there, 15% is not taxable. Standard deduction is allowed. We will set aside. Out of balance 85%, whatever the amount applied for charitable or religious purpose is there, it is allowed, whether it is revenue expenditure or capital expenditure. Next. Yeah, explanation 1 of section 11.1. If there is any outstanding amount, you will give declaration. That outstanding amount you will claim as deduction. If you get any bumper donation, that also you will give declaration and you will claim as deduction. But outstanding amount, bumper donation. Outstanding amount you should apply in the year of receipt or in the immediately next financial year. Otherwise, whatever the amount that you did not apply, taxable under 115 BBI at the rate of 30%. Next, bumper donation you should apply in immediately next financial year. If you fail to apply, whatever the amount that is not applied, taxable under 115 BBI at the rate of 30%. If one trust gives donation to another trust, total donation given, general donation given not allowed, only 85% of donation given will be treated as applied. So if you take any loan or borrowing, the year in which you use that money, in that year it is not treated as applied, but the year in which you repay the loan, then in that only it will be treated as applied. Otherwise it is loophole. You will take loan, you will claim expenditure, you will never repay the loan. Okay, so it's like understanding, for the purpose of claiming expenditure you are intentionally taking loan, that's why it was counted. The year in which you repay the loan along with interest, in that year it will be treated as applied. Next, accumulation under section 11.2. Like if you want to accumulate your money which we normally use in our offices, you can give declaration. In the declaration, 4 points: specified purpose, specified period, maximum 5 years other than current previous year, deposit in safe modes. You should not give that money as donation to any other trust. If any of these 4 conditions are violated, in the year of violation, whatever the amount violated is there, that is taxable under 115 BBI at the rate of 30%. So what is ITR due date? 31st October. 2 months before ITR due date means on or before 31st August, you should give declaration and you can claim it as deduction. Next, if you take any money from corpus fund and use that money, in the year of usage, it is not treated as applied, but in the year in which you are actually repaying it back to corpus fund, in that year it will be treated as applied. Whatever the balance income is there, that is taxable as per slab rate. And provisions of 40A3, 40A3A, 40A1A are applicable. Now, explanation 5 of section 11.1. See, If current year expenditure is more than the income, then excess expenditure you cannot set off and you cannot carry forward. What do you mean by this? Income derived from property held under trust is 200 lakhs. You applied for charitable purpose 190 lakhs. Now, how it will be, whatever the income derived from property held under trust is there, 15% set aside na. So how much is 15%? 200 lakhs into 50%, 15%, 30 lakhs. 13 lakhs is fully exempted. It is not at all taxable. How much is remaining? 85%. Remaining 85% is 170 lakhs. Out of 170 lakhs, how much you have applied? You have applied 190 lakhs. Whether 190 lakhs is allowed? No. So here there is deficit of 20 lakhs. Na? There is deficit of 20 lakhs. Can you carry forward to next year? Answer is no. You cannot carry forward to next year. It cannot be carried forward and it cannot be set off. Are you able to understand? So excess application in current previous year, you cannot carry forward and you cannot set off with any other income. As per Finance Act 2022, general explanation added for whole section 11. For whole section. What is the general explanation? As per the general explanation, accrual based expense. Accrual based expense only treated as applied. Treated as applied. Sorry. Accrual based expenditure is not treated as applied. Cash based expense only treated as applied. What do you mean by this? See, at the end of previous year, my salaries are 6 lakh rupees. Out of 6 lakh rupees, I paid 4 lakhs, unpaid 2 lakhs. For example, this salary was not considered. I am following accrual basis of accounting. Can I claim 6 lakhs as deduction? Not allowed. Only 4 lakhs will be allowed as. That means what? In case of trust, whatever the expenditure that is incurred by trust, that expenditure is allowed only if it is paid in current previous year. Otherwise, it is not allowed as deduction. Now you will get one doubt. Sir, you said outstanding amount and you also said accumulation as per section 11.2. You said bumper donation. See, if you file declaration, then you can claim it as deduction. For example, salaries is there. 4 lakhs I paid in current previous year. Remaining 2 lakhs I did not pay in current previous year. I gave declaration to assessing officer within 2 months before ITR due date. Then I can claim 2 lakhs as deduction. If I do not give declaration, to assessing officer, whatever the accrual based expenditure is there, as able to understand. So for whole section 11, whatever the expenses are there, those expenses are treated as applied only if they are actually paid in current previous year. Otherwise, they are not allowed as deduction on accrual basis. They will not be treated as applied on accrual basis unless you give declaration to as able to understand. Sir, till now you are saying safe mode under section 11.5. What do you mean by, like, what are all the various modes that are covered under section 11.5? That we will discuss. So, safe modes under section 11.5. See, government certificates. Trust can invest its money in government certificates. It is allowed investment. Okay. So government certificates means nothing but national savings certificates or any other certificates issued by government. If you invest, if trust invests its money in national savings certificates, that will be treated as applied only. It is safe mode. Next, post office savings bank account. Next, if you deposit your money in scheduled bank, deposit in scheduled bank, that is also allowed. For accumulation under section 11.2, we discussed it na, whatever the amount that is accumulated, that should be deposited in safe modes. What are those safe modes? Government securities, post office savings bank account, deposit in scheduled bank, deposit in cooperative society bank. Next, investments in units of UTI. You know UTI, right? Unit Trust of India. So trust can purchase units of UTI. That is safe mode of investment only. That is allowed. Next, investment in central government or state government securities. That is also permitted. Trust can invest its money in central government or state government securities. That is also treated as a safe mode of investment. It is also allowed. Next. Next point, a bit tricky, but listen, you will understand. Debentures of company or corporation which are guaranteed by central government or state government. Let's say there is Reliance Limited. It issued debentures. Whatever debentures issued by Reliance Limited are there, repayment of those debentures along with interest, that is guaranteed by central government. You can invest those deposits. Trust can invest in those debentures. That will be treated as safe mode of investment in public sector company bonds. Public sector company bonds. Next, deposits in public financial institutions. Investment in public sector company shares. Investment in public sector company. Investment in immovable property. The renowned educational institution, you all know, okay, they are taking benefit like this only. Whatever the fees collected from students is there, it will be treated as income derived from property held under trust. They will take benefit of section 11 to accumulation. They will invest that money in immovable properties. That's how they are purchasing so many immovable properties in their locality. Okay, that's the loophole. So investment in immovable property is safe mode of investment as per section 11.2, investment in movable property. I hope you understood the way how they are getting so much of income, how they are building so much of assets through this point. If you understand, leave some comment. Okay. Now, investment in housing financial corporations and investment in HUDCO, Housing Development Corporation, investment in NABARD bonds. All these are safe modes of investment. So if trust invest in all these safe modes of investments, then it is all right. It will be treated as applied. Otherwise, whatever the amount that is misutilized or misinvested is there, that will be treated as income and it is taxable under section 115 BBI. For example, like 10 lakh rupees, the example which we took for purpose of construction of function hall, how much I accumulated? I accumulated 10 lakh rupees. Out of 10 lakh rupees, with 9 lakhs, I purchased land. Land is safe mode of investment, na? It will be treated as applied. With 1 lakh rupees, I purchased cryptocurrency. Whether cryptocurrency is safe mode of investment? No. 1 lakh will not be treated as applied. Are you able to understand? So this is the concept relating to safe mode of investment under section Next, we will discuss section 13(1). Certain cases, whatever the exemption under section 11 are there, exemption under section 11, 12, exemption under section 11 and 12 is not available in 4 cases. What are those 4 cases? First case, if you create any trust for private religious purposes, then in such case, you cannot claim exemption under section 11, 12. For example, I created one trust, Maganti trust. In that trust, like I build one Shiva temple. For that Shiva temple, I can enter, only my family members can enter, my friends can enter. So if I create any such type of trust only for private religious purpose, the trust is not eligible for section 11 and 12 exemption. If you establish any trust for particular religion, caste, particular religion or caste or community, even that trust is also not eligible for exemption under section 11, 12. Let's say I built one temple. Okay, I told for that temple only Hindus are allowed, others are not allowed. Okay, that's why you will never see in any temple only Hindus are allowed. If such type of placard or notice is given, that trust is not eligible for 11 and 12 exemption. In TTD, can you see anywhere only Hindus are allowed? No, they will not give that disclosure. If such disclosure is given, it will lose status of section 11 and 12 exemption. So if you create any trust for particular religion, particular caste, particular community, the trust is not eligible for section 11 and 12 exemption. But if you create any trust for orphans or widows or for particular backward people, then the trust is eligible for 11 and 12 exemption. Now, Varun is asking, sir, only for widows, those who are suffering with marriage, or those who are suffering with wives, for them also if we create any trust, is it also eligible for 11 and 12 exemption? Yes, that is also eligible for 11 and 12 exemption. So those who are suffering with breakup, those who are suffering with all the nuisance in the house with marriage, for those husbands also, if you create any trust, the trust is also eligible for section 11 and 12 exemption. Okay, so you need not worry if you have any such kind of people. Create one trust and you can claim 11 and 12 exemption. Third point, if any amount of trust is used for benefit of specified person. Okay, so benefit of income or assets given to a specified person, then not total amount, whatever the benefit that is given to specified person is there, that amount will be treated as income, and such income is taxable, and such income is taxable under section 115 BBI at the rate of 30%. What do you mean by this? Let's say I established one education institution. In that education institution, my sister is studying. How I charge fees for outsider, in the same way I should charge fees for my sister as well. If I do not charge fees for my sister, whatever the benefit that my sister has received, that benefit will be treated as income of the trust. On such income, trust is required to pay tax under section 115 BBI at the rate of 30%. Are you able to understand? So whatever the benefit that trust gives to its specified person, on that benefit will be treated as income of trust. On that income, trust is required to pay tax under section 115 BBI at the rate of 30%. Are you able to understand? Sir, who are called as specified persons? Whoever the founder or author of trust is there, or whoever the manager or trustee of the trust is there, they will be treated as specified person. Similarly, if any person gives donation of more than 50,000 rupees, why will he give more than 50,000 donation? He might have some specified interest. Na? So those who have given donation more than 50,000 rupees, for that person also, if trust gives any favor, if trust provides any benefit, that benefit will be treated as income of the trust. So those who have given donation more than 50,000, they will also be treated as specified persons, and their relatives, whoever founder, author, manager, trustee is there, their relatives will also be treated as specified person. Similarly, if trustee is Hindu undivided family, if you know Simhachalam temple trustee is one Hindu undivided family. Okay, so if trustee of the trustees Hindu undivided family, whoever the members in the trustees are there, all the members will be treated as specified persons. Okay, so members of HUF, if HUF is trustee, are you able to understand? So all these will be treated as specified persons. For specified persons, if any benefit is provided, such benefit is taxable under section 115 BBI at the rate of 30%. Another important point, whatever the amount that is taxable under section 115 BBI is there na, from such income, you cannot claim any expenditure, you cannot claim any deduction, you cannot set off any losses. Whatever the income taxable under 115 BBI is there, that is taxable at flat rate of 30%. When I say flat, no deduction, no expenditure is allowed, straight away 30% tax is payable on that income. Are you able to understand? Next, fourth case. If funds of trust are deposited in any mode other than section 11.5, other than 11.5. In that case also, whatever the amount that is deposited in modes other than 11.5, cryptocurrency, whatever the amount that is misutilized, that is not invested in safe mode, to the extent of that amount, it is taxable under 115 BBI at the rate of 30%. Able to understand? Why trust can be formed? Can someone tell? Trust can be formed for charitable purpose, or it can be formed for relief of poor, or it can be formed for yoga, or it can be formed for education, or it can be formed for providing health facilities, or it can be formed for preservation of environment, or monuments. For all these purposes, like trust is formed for purpose of education. I created Umasankar educational institutions, and I created one trust. In the trust, I am running a school. Through school, I am getting income. Na? So in all these cases, if you do business, and in business, if business receipts are more than 20% of total receipts, then also still section 11 and 12 exemption is available. Still section 11 and 12 exemption is available. But if I create any trust for advancement of any other object, yes, Monish said sports. Even for promotion of sports also, you can create one trust, education, sports, games, you can create one trust, and that trust, in the trust, whatever the business income is there, even if business income is more than 20% of total receipts, still you can claim section 11 and 12 exemption. But if you create any trust for advancement of any other object of general public utility, in this case, if you create a trust for this purpose, and for that trust, if business receipts are less than or equal to 20% of total receipts, then 11 and 12 exemption is allowed. But if business receipts are more than 20% of total receipts, in that case, 11 and 12 exemption is not allowed. See, registration will not be cancelled. I created one trust for the purpose of helping poor. Okay, so helping poor trust. So that is no object was there. That is for upliftment of general public or to help the poor. Now, using that, what I am doing, I am purchasing bottles at 10 rupees. Intentionally, I am selling it at 40 rupees. I gave notice. Whatever the amount that I receive by selling these bottles, I will distribute this money to poor. Now, what am I doing? I am doing business. So, in my business, if my business receipts are more than 20% of total receipts, my trust registration under 12AB it will not be cancelled. But in current previous year, section 11 and 12 exemption is not available. Are you able to understand? Further, trustee is required to maintain books of accounts and trustee is required to get its books of accounts audited if total income of trustee is more than basic exemption. So there are certain cases if books of accounts are not maintained or if books of accounts are not audited, trustee is required to file ITR before on or before 31st October. If trust do not file ITR within due date, do not file ITR within due date, or if business receipts are more than 20% of total receipts in case of advancement of any other object of general public utility. Okay, this particular case, advancement of any other object of general public utility and business receipts are more than 20% of total receipts. So in all these three cases, if books of accounts are not maintained, if they are not audited, or if ITR is not filed within the due date, or in case of trust is formed for advancement of any other object of general public utility, and if business receipts are more than 20% of total receipt. In all these cases, only revenue expenditure is treated as applied. Capital expenditure is not treated as applied. See what I said, income derived from property held under trust, 15% standard deduction, balance 85%. Out of balance 85%, whatever you apply for charitable or religious purpose, application means both revenue expenditure and capital expenditure. Both expenses are treated as applied. But in these four cases, capital expenditure is not treated as applied. Only revenue expenditure will be treated as applied. Are you able to understand? Because violated na, books of accounts are not maintaining, they are not getting audit done, they are not filing ITR within due date, business receipts are more than 20% of receipts, conditions given are violated. So only revenue expenditure will be allowed as deduction. Even this revenue expenditure should not be from corpus fund. This revenue expenditure should not be from corpus. So if revenue expenditure is from corpus fund, again it will not be allowed as deduction. And this revenue expenditure should not be from any loan or borrowing, because if revenue expenditure is from any loan or borrowing, it will not be allowed in current year. It will be allowed in the year in which you repay the loan. So it should not be from loan or borrowing. And it should not be depreciation for which 100% deduction is allowed in earlier years, for which 100% deduction allowed in earlier years. So this is the thing. In all these four cases, as you have violated the condition, revenue expenditure will not be allowed as capital expenditure will not be allowed as deduction. Only revenue expenditure will be treated as applied. Even in that revenue expenditure also, if you incur any revenue expenditure out of corpus fund, that will not be treated as applied. If you incur any revenue expenditure out of loan or borrowing, that is not treated as applied. Earlier year you have claimed 100% capital expenditure. For that asset you want to claim depreciation now. That is also not allowed. Are you able to understand? Capital gains. This will be interesting. Listen. Section 11(1)(a). See, trust will have assets na. Whenever trust sell assets, on sale of capital assets, trust is also required to calculate capital gains. Whatever the capital gain is there, that capital gain will be considered as income derived from property held under trust. Do you remember? Initially, I told even capital gain is also considered as income derived from property under trust. Got. Okay, so trust is having one land. It sold that land for 14 crores. Let's say transfer expenses are 1 crore. How much is net consideration? Net consideration is 13 crores. Cost of acquisition. Cost of acquisition is 8 crores. Now how much is capital gain? Capital gain is 5 crores. Sir, can we claim any exemption from capital gain? Yes, you can claim exemption from capital gain, but you need to do reinvestment. Okay, the formula is if total net consideration is reinvested, total net consideration is reinvested, then total capital gain is exempted. Total capital gain is if part of net consideration is reinvested, part of net consideration is, then exemption is equal to cost of new asset minus cost of old asset. Cost of new asset. Did you understand? Now, let's say total 14 lakhs reinvested. Reinvestment exemption. If total net consideration is reinvested 13 crores, total 5 crores capital gain is exempted. Are you able to understand? But total 13 crores, what net consideration? Total 13 crores was not reinvested, only 11 crores was reinvested. Then how much is exemption? Cost of new asset minus cost of old asset. New asset 11 crores, old asset is 8 crores. Only 3 crores is exemption. Are you able to understand? For example, let's say 9 crores is reinvested, then 9 crores minus 8 crores. 1 crore is allowed as exemption. Are you able to understand? So, if only 6 crores is reinvested, 6 crores minus 8 crores, it is negative 2 crores. In this case, exemption allowed is 0. Are you able to understand? So, whenever trust sells any capital asset, then what you need to consider is net consideration. Net consideration should be reinvested. If total net consideration is reinvested, total capital gain is fully exempt. If proportionate net consideration is reinvested, then exemption is equal to cost of new asset minus cost of old asset. I hope you are following me. Next, we will discuss something interesting, anonymous donation. Okay. I framed one problem on this as well. So we can discuss that problem also after we discuss. Anonymous donation. Under section 115 BBC. Anonymous donation means what? Someone whom we do not know. Okay, unknown person deposited money. Unknown person gave donation. It's also called as Guptadan. So if any anonymous donation is received, anonymous donation is taxable. So if anonymous donation is received by religious trust, anonymous donation received by religious trust, then whatever the anonymous donation received by religious trust is there, that anonymous donation we will treat as income derived from property held under trust. However, if any anonymous donation is received by charitable trust, then 115 BBC gets attracted. So in this case, 115 BBC will not get attracted. It will be treated as income derived from property held under trust. But if anonymous donation is received by charitable trust, then it is taxable under section 115 BBC. Let's say anonymous donation received is 10 lakh rupees. Anonymous donation received 10 lakh rupees. From this 10 lakh rupees, deduction is allowed. See, total 10 lakh rupees is not taxable under section 115 BBC. Deduction is allowed. How much is deduction? 5% of total donation. 5% of total donation or 1 lakh, whichever is higher. That will be allowed as deduction. And whatever the balance is there, that balance amount is taxable under section 115 BBC on a flat rate. Okay, no deduction will be allowed on a flat rate at the rate of 30%. Are you able to understand? And whatever the donation that is allowed, that is not exempt, that will be treated as income derived from property held under trust. Okay, so that should not be exempt, that will be treated as income derived from property held under. Here, sir, what do you mean by total donation? Total donation includes anonymous donation plus corpus donation plus any general donation or voluntary donation. If any government grant was received, that is also to be considered in calculation of total donation. Because see, anonymous, why this concept was introduced? Many people are converting black money to white money using trust concept. So they are saying unknown person gave this much of amount and they are bringing that money to the trust. So to counter this, if any unknown person gives money to the charitable trust, it will be treated as anonymous donation. But at least some people will be there now who will give, some unknown persons who will give out of genuine reasons. So further deduction will be allowed, 5% of total donation or 1 lakh rupees, whichever is higher. Balance is taxable as anonymous donations under section 115 BBC at the rate of 30%. Whatever the deduction that is allowed, that is not exempt, it will be treated as income derived from property held under. Now, sir, there is Uma Trust, like it is having temple, it is also having hospital. That means what? The trust is having both charitable entity, like that is charitable trust as well as religious trust. Charitable as well as religious. So if it is charitable as well as religious trust, then for charitable purpose, if it receive any anonymous donation, then 115 BBC is applicable. For other purpose, if any anonymous donation is received, then 115 BBC is not applicable. Very simple. If any trust is formed for both charitable and religious purposes, TTD, educational institution is there, religious purpose is there. So if any trust is created for both educational as well as both charitable as well as for religious purpose, for education, for health, if any anonymous donation is received, 115 BBC is applicable. For orphans and for any other purpose, if any anonymous donation is received, that is not taxable under 115 BBC. Okay. Now, shall we solve one problem for better understanding? Shall we solve? There is one trust with the name Gali Trust. There is one guy who constantly commenting. How do you expect that I can reply while I am teaching the class? Gali Trust. Now there is Gali Trust. Income derived from property held under trust is 20 lakh rupees. Next, donations received. See, even donations received is also considered as income derived from property held under trust, right? Donation received is 50 lakh. Out of 50 lakh, anonymous donation is 12 lakh. And corpus donation is 20 lakh. Next, business income incidental to main objects. If it is incidental to main objects, then it will be treated as income derived from property held under trust, right? So business income incidental to main objects is 3 lakhs. Next, amount applied for charitable or religious purpose is 30 lakh rupees. Compute total income of Gali Trust under section 115 BAC. That means if trust is paying taxes under section 115 BAC, we need to calculate the tax liability. Shall we calculate? Everybody. Now, first, we will write income derived from property held under trust. Computation of total income of Gali Trust. First, how much is income derived from property held under trust? 20 lakhs. How much are donations received? 50 lakhs. Corpus donation is not taxable, na? Corpus donation is exempt, right? If it is deposited in safe modes. So, total donation is not taxable. Only other than corpus, other than anonymous. See, out of anonymous donation also, total is not treated as income derived from property held under trust. 5% of total donations or 1 lakh, whichever is higher. So, we will do one thing. How much is anonymous donation? Anonymous donation is 12 lakhs, right? From this 12 lakhs, deduction is allowed. How much is deduction? Deduction is 5% of total donations. So how much is total donation? 50 lakhs. 50 lakhs into 5%, 2.5 lakhs or 1 lakh, whichever is higher. That means 2.5 lakhs is allowed as deduction. How much is balance? 12 minus 2.5, 9.5 lakhs is balance. This 9.5 lakhs is taxable under 115 BBC at the rate of 30%. And whatever this 2.5 lakh is there, that will be treated as income derived from property held under. So how much is total donation received? Donation 50 lakhs. But from the donation, you need to reduce corpus donation because corpus donation is not taxable. How much is corpus donation? 20 lakhs. Next, how much is anonymous donation? Anonymous donation is 12 lakhs. How much is balance? 50 minus 32, 18 lakhs. Correct? To this, we are going to add income derived from property held under trust. So, anonymous donation total will not be treated as income derived from property held under trust. Only 2.5 lakhs it will be treated as income derived from property held under. Now, out of this, total how much? 20 plus 18 plus 2.5, 40.5 lakhs. Out of 40.5 lakhs, standard deduction is allowed, na? How much is standard deduction? Standard deduction at the rate of 15%. So 40.5 into 15%, 6.075 lakh. Let how much balance? 34.425 lakhs. I am making one small change. Please change this. Amount applied for charitable or religious purposes 21 lakhs. How much? 21 lakhs. So from this we will reduce amount applied for charitable or religious purpose. How much? 21 lakhs. How much is balance? Balance is 13.425 lakhs. So if we convert 13,42,500. So this is total income of the trust. Now shall we calculate tax liability? Total income is 13,42,500. Out of this, no. 13,42,500. To this we need to add amount taxable under 115 BBC. How much is taxable? 9,50,000. So how much is total income? 13,42,500 minus 9,50,000. 22,92,500. I hope you are following till here. So total income is 22,92,500 divided into two parts. Anonymous donation 9,50,000. Other 13,42,500. This is taxable at the rate of 30%. 9,50,000 into 30%. How much? 2,85,000. Next, 13,42,000. He is following 115 BAC. If he follows 115 BAC, then tax rates up to 3 lakh there is no tax. Greater than 3 lakh up to 7 lakh tax rate is 5%. Tax amount is 20,000. Greater than 7 lakh up to 10 lakh tax rate is 10%. Tax amount is 30,000. Greater than 10 lakh up to 12 lakh tax rate is 15%. Tax amount is 30,000. Above 12 lakh tax rate up to 15 lakh tax rate is 20%. So 1,42,500 into 20%, 28,500. So how much is tax? 28,500 plus 80,000. 1,08,000. So how much is total tax? 2,85,000 plus 1,08,500. Total 3,93,500. To this you will add HEC at the rate of 4%. 15,740. How much is final tax liability? 393. 4,09,240. I hope you understood. So, do you also got the same answer? Today I am live from Vijayawada. Previously I used to come live from Hyderabad. Later on that incident happened to Ongole, then came to Vijayawada. So from here onwards I am taking class for you. So you also got the same answer? Please reply. Hello. Am I audible? Next, we will see registration process of the Before we start with registration process of trust, I wanted to explain 1023C. See, as per 1023C, clause 3A, clause 3AB or clause 3AC. Whatever the income of government hospital, government school or hospital is there, that is fully exempt. Sir, when we call an institution or hospital as government institution or government hospital, when any hospital or institution is substantially financed by government, then we call such hospital or educational institution as government institution or government hospital. So if like substantially financed means what? Whatever the government grant that they receive, government grant is more than 50% of total receipts. Such type of educational institution or hospital we call as government hospital or government educational institution. Income of government hospital, government educational institution is fully exempt. It is not at all. 1023C, 3AD, 3AE. Private educational institution or private hospital whose aggregate annual turnover is less than or equal to 5 crores. Then also their total income is not taxable, their total income is fully exempt. Let's say I started one small school for the purpose of education. Okay, I am a private one. Like my trust is not a government trust, it is a private trust formed for educational purposes. But whatever the fees that I collect from students is there, it is less than 5 crores. So if you create any trust whose aggregate annual turnover is less than or equal to 5 crores, if it is either educational institution or any hospital, then whatever total income received by the trust or educational institution, it is not at all taxable, it is fully able to understand. 1023C, 4 or 5 or 6 or 6A. See, these people are there na, they are not required to obtain any registration, any approval from CIT or PCIT. Any educational institution which is formed solely for charitable purpose, any hospital which is formed solely for charitable purpose, whose aggregate annual turnover is less than 5 crores, they are not required to obtain any approval from CIT or PCIT. Their total income is fully exempt. However, in case of any private trust, educational institution or hospital whose aggregate annual turnover is more than 5 crore rupees, then they are required to get approval of CIT or PCIT. Approval of CIT or PCIT is required, then only exemption is allowed, otherwise exemption is not. Then only exemption is available, exemption under section 1112, otherwise exemption under section 1112 is not. Okay. See, trustees registered under section 12AA or 12AB or trustees registered under section 1023C clause 4 or clause 5 or clause 6 or clause 6A. See, in either case 11 and 12 exemption is available. If they get registered under 12A or 12AB, 11-12 exemption is available, or if they get registered under section 1023C4, 5, 6 or 6A, then also section 11-12 exemption is available. So Nirmalamma thought, our finance ministry is Miss Nirmala Sitharaman, right? She thought, see, in either case exemption is available under section 11-12, then why registration under two different sections, 12AA, 12AB, 1023C4, 5, 6, 7, why? Then, so with effect from 1st October 2024, if you want to obtain new registration, you can apply new registration only under section 12AB. You cannot obtain registration under section 1023C, 4 or 5 or 6 or 6. This is not allowed from 1st October 2020. So earlier two options are there. If you want to claim exemption under section 11-12, either you can get registered under 12A or 12AB, or you can get registered under section 1023C. But nowadays, this is the recent amendment made in Finance Act number 2 of 2024 with effect from 1st October 2024. If you want to apply for new trust registration, you have only one option. You can apply under section 12AB. You cannot obtain registration under 1023C clause 4, 5, 6 or okay. Now this registration I will explain in ICA material. Now see, 1st April 2021, remember this date. Before 1st April 2021, you have to get registration under 12A or 12AA. After 1st April 21, they introduced one new section, 12AB. Okay. See, before 1st April 21, if you take trust registration, lifelong the trust registration is there. TTD got registered, for example, in 1976. That's it. Again, they need not go to Commissioner of Income Tax. So whenever Income Tax Department is doing audit, when it asks for certificate of registration, they were not able to give. They are saying it got registered in 1976. Certain documents were not found. Irregularities are there. So Nirmala Sitharaman, after she became finance minister, she introduced one amendment with effect from Finance Act 2021. She said that every trust is required to get its registration renewal for every 5 years. That means what? Like today, if I take any registration under section 12AB, it is not for lifetime. It is only for 5 years. After 5 years, again I have to get my registration renewed. Okay, only if I get my registration renewed, then only 11 and 12 exemption benefit is available. Otherwise, section 11 and 12 exemption benefit is not available. Are you able to understand? Now, those trusts which are already existing as on 1st April 2021, they need to migrate from 12AA to 12AB. So for migration, they were given 3 months. So within 3 months, 3 months means what? 1st April 21, 3 months means 30 June 2021. So within 3 months, they should keep application for migration from 12AA to 12AB. However, 30 June 2021 was extended. Okay. You can see 30 June 2021, it is extended up to 30 June 2024. It got extended by circular 30 June 2024. So those who wants to migrate, those who are already registered as on 1st April 2021 are there. Within 3 months, they need to keep application to commissioner or principal commissioner for migration to 12AB. Then commissioner will pass the order for registration under section 12AB within 3 months from end of the month in which application was received. So the month in which application is received by commissioner, he will ignore that month. Within next 3 months, he will pass the order for registration under section 12AB. Sir, when he is giving registration for migration from 12AA to 12AB, will he check any documents? Will he do any inquiry? He will not do any inquiry. Without any inquiry, he will give the registration, and that registration is valid for 5 years. Are you able to understand? The year in which a trust is created, from that year they can claim exemption for additional 5 years also. Are you able to understand? Last point, if you want to create a new trust, let's say today I got thought I wanted to start one trust for those who are unmarried. Okay, for unmarried people I wanted to create one trust under advancement of any other object of general public utility. So like for new trust, first I need to apply for provisional registration. They will grant provisional registration. Once I get provisional registration, then I should apply for final registration. So when should I make application? At least 1 month prior to commencement of the previous year relevant to assessment year. What is today's date? 24th July 2025. So today I got an idea. I wanted to start a trust for unmarried people. You know, right? If I start new trust today, then previous year will commence from 24th July to 31st March. Generally previous year 1st April to 31st March, but if I want to start in case of new business, new source of income, new profession, previous year will start from date of commencement of business or profession or source of income. I'm starting trust today, so date of commencement is today, so this is previous year beginning. So I need to be upfront within before 30 days, before 30 days only, or before 1 month, I think. At least 1 month prior to the commencement of previous year. So 24th July, 1 month means 24th June 25. Before 24th June 2025 only, I should make application for provisional registration of the trust. The month in which application is received, ignore that month. Within next 1 month, commissioner will give provisional registration to. Are you able to understand? So within 1 month from end of month in which application is made, application is made, order to be passed for provisional registration without detailed inquiry. So commissioner, principal commissioner, they will not do any inquiry. So I am applying for provisional registration. So I made application. The month in which I made application, ignore that month. Within next 1 month, I am going to get the provisional registration, and that provisional registration is valid for 3 years. Next, second point. Once I get a provisional registration, then I have to apply for final registration. Sir, when I should apply for final registration? So within 6 months from commencement of activities. See, I am starting trust now, I will do some activity. The date on which I started the activity, from that date within next 6 months, or within or before 6 months from expiry of provisional registration, whichever is earlier. So the date on which I start the activity, from that date within next 6 months, or the date on which provisional registration expires, before 6 months from that date. Okay, I need to apply for final registration. When I apply for final registration, commissioner or principal commissioner, he will ask all the documents, he will go through the entire documentation, he will completely do inquiry upon my trust. After doing complete inquiry, if he is satisfied, he will grant final registration. If he do not satisfy, then he will give opportunity of being heard and he will reject the application for final registration. If he gives approval for final registration, it is valid for 5 years. Like those 5 years are to be counted from the year in which that trust application, provisional application for trust was made. From that year onwards, 5 years is 5 years that final registration will be granted. Trust is already registered under section 12AB. I said now for every years they need to get renewal. So trust already registered under section 12AB. And it want, and 5 years time limit is over. 5 years time limit is getting over. Then it needs to apply for renewal na. So for renewal application, when it should apply for renewal application should be made 6 months before date of expiry of registration. So whatever date of expiry is there, for the date of expiry, you need to calculate 6 months. Before that 6 months only, you should apply for renewal of registration. Then if you apply for renewal also, like commissioner will go through entire documentation. If he is satisfied, he will renew your registration. Otherwise, he will reject your renewal registration after giving opportunity of being heard. Now renewal registration is again valid for another 5 years. Okay. If your trust is inoperative and you wanted to make it operative, let's say in 24-25 trust is inoperative. In 25-26 I wanted to make trust operative. So in 24-25 only, like I wanted to make it operative from 1st April 25. So from 1st April 25, I need to do back calculation 6 months. 6 months means 30th September 24. Am I correct? So before 30th September 24 only, I should apply for operation of inoperative trust. Are you able to understand? Then again, income tax officer will go through entire documentation. If he is satisfied, he will grant final registration. Otherwise, he will reject the registration after giving opportunity of being heard. It is also available for 5 years. All class 2, class 3, class 4. All three are available for 5 years. Next, there is modification of objects of trust. If there is modification of objects of trust, then also the trust is required to make application for change of objects. Within 30 days from date of change of objects, it should make application. He will go through, officer will go through the entire documentation. If he is satisfied, he will grant registration. Otherwise, he will cancel the modification of object. Okay, if he grants registration, again it is valid for 5 years. So this is the concept relating to registration of. Now last concept, important concept, a question you will get in examination, that is tax on accreted income. This is also called as exit tax. Now, what do you mean by exit tax? This exit tax, this is applicable in 3 cases. What are those 3 cases? I will tell you. In these 3 cases, whatever the accreted income is there, that accreted income is taxable at MMR, maximum marginal rate. Sir, what do you mean by MMR? 30% tax plus 12% surcharge plus 4% HEC. So what is effective tax rate? %34.944%. That is effective tax rate. Now I will explain these 3 cases. In these 3 cases, whatever the accreted income is there, on accreted income, tax rate applicable is 34.944%. Let's say trust is closed. There is dissolution of trust. Till 30 years, I am claiming exemption under section 1112. I accumulated so much of assets. So what I will do at the time of closure of trust, whatever the income that I accumulated, whatever the income that is accreted is there, on such income I am required to pay tax at the rate of 34.944%. Are you able to understand? That is maximum marginal rate. Now, shall I discuss those 3 cases? Actually 4 cases, but in Act they were given as 3 cases. Now let us see one by one. Trust got converted into non-eligible form. Trust got converted into non-eligible form. What do you mean by this? Let's say non-eligible form means trust registration was cancelled. You know, like if income tax officer finds something suspicious, then commissioner has right to cancel the registration. If trust registration is cancelled, in that case, whatever the accreted income is there, on such accreted income, you are required to pay tax at the rate of 34.944%. Next, trust made modification of objects. Just now we have discussed, if trust made modification of objects and not applied for fresh registration, or applied for fresh registration but it got cancelled, applied for fresh registration but got So in these cases, whatever the accreted income is there, on such accreted income, tax is applicable at the rate of MMR, maximum marginal. So first trust registration is cancelled by commissioner, or trust made modifications and it did not apply for fresh application, or it applied for fresh application which is cancelled by commissioner. In these cases, whatever the accreted income of trust is there, on such accreted income, trust is required to pay tax at the rate of not migrated from 12AA to 12AB. You know, right? After 1st April 21, every trust is required to migrate from 12AA to 12AB, but they did not migrate from 12AA to 12AB, or not renewed registration under section 12AB after 5 years. See, for every 5 years, it needs to renew its registration, right? But trust failed to renew its registration after 5 years under section 12AB. Then also, like whatever the accreted income is there, on that it is required to pay tax at the rate of MMR. Next, after provisional registration, not applied for final registration. In this case also, like accreted income, on such accreted income, it is required to pay tax at the rate of M. Case 2. Trust merged with another trust. It got merged with another trust. Another trust is not registered under section 12AA or 12AB or 1023C, 4 or 5 or 6 or another trust is registered but not having same object. That means what? If one trust gets registered with another trust, if one trust gets merged with another trust which is unregistered, then also accreted income concept is applicable. Registered trust getting merged with another registered trust. Registered, like I'm in educational field, education trust got merged with hospital trust. Even though both are registered, still accreted income concept is applicable because both objects are not same. If there is a dissolution of trust, what you need to consider? You need to consider date of dissolution. From date of dissolution, from end of such month, within next 12 months, it need to transfer all assets to another registered trust having same objects. Another registered trust having same object. Then whatever the assets transferred to another registered trust having same objects, on that tax is not levied. Whatever the not transferred are there, on those not transferred assets to another trust having same objects, on this MMR is applicable. Tax is required to pay at the rate of M. Now, what do you mean by accreted income? Here I said accreted income. Sir, what do you mean by accreted income? Accreted income means fair market value of all assets less total liabilities. Whatever the balance is there, that balance we call as accreted income. Here, another important point is there. When you are calculating fair market value of all assets, you need to exclude three assets. Three assets are excluded. First, asset purchased out of agricultural income. That means if any asset is purchased out of agricultural income, on that asset will not be considered in calculation of accreted income. On that asset, MMR, maximum marginal rate tax, is not applicable. Next, second, asset purchased before 12AA or 12AB registration. So if you purchase any asset before obtaining registration under section 12AA or 12AB, see, only if you obtain registration under 12AA or 12AB, then only you will get 11 and 12 exemption. Before that date, there is no concept of 11 and 12 exemption, right? So if you purchase any asset before obtaining registration under 12AA or 12AB, that asset is purchased out of tax paid money. Already you paid tax in earlier years. Now again, why will they levy maximum marginal rate? That's why if you purchase any asset before obtaining registration under section 12A or 12AB, that asset is to be excluded while you are calculating accreted income. Third, assets transferred to another registered trust having same objects within 12 months from dissolution date. So whatever the assets that are transferred within 12 months, we have discussed at this point, right? If you transfer within 12 months to another trust having same objects, then whatever the assets that you have transferred, on that no tax is required to be paid. Whatever the untransferred assets within 12 months are there, okay, on those accreted income, you are required to calculate tax at the rate of MM. See, whatever the tax at the rate of maximum marginal rate is there, that is required to be paid within 14 days. Are you able to understand? That 14 days is required to be calculated from date of from expiry of 12 months. You need to pay within next 14 days. Or if there is modification of objects, from date of cancellation of modification of objects within next 14 days, you need to pay maximum marginal rate tax on accreted income. Otherwise, interest will be levied. Now, valuation. Here it was there. You can see the valuation also. I will explain in simple terms. Valuation. How to calculate fair market value of assets valuation. If it is immovable property, it is calculated at stamp duty value or fair market value, whichever is lower as on valuation. If there are quoted securities, then you need to consider lower price plus highest price divided by 2. Nothing but you will consider average price on the date of valuation. If there are unquoted securities, then you will consider A plus D minus L divided by PE into PV. Don't worry, I will explain you. Let's say trust is there. Trust is having 10,000 shares in Reliance Industries Limited. Now, let's say Reliance Industries Limited balance sheet is there. In this balance sheet, let's say equity share capital 60,000 shares, 6 lakhs, current liabilities 10 lakhs, fixed assets 80 lakhs, current assets 5 lakhs. Now, what you will do? You will consider fair market value. Let's say fair market value is 90 lakhs. 90 lakhs plus 5 lakhs, current liabilities minus 10 lakhs divided by total number of shares 60,000. How many shares trust is having? 10,000. So 10,000 shares means nothing but PV. 60,000 shares means nothing but PE. And this 90 lakhs plus 5 lakhs we call as D, and 10 lakhs is liability. See, if there are gold, jewelry, immovable property, for all of them you will consider fair market value. For any asset which you will not consider fair market value, you will consider book value. That's how we are going to arrive A plus B minus L divided by PE into PV. So we are going to calculate value of unquoted shares. So if there is any other asset, you will consider fair market value on valuation. Shall we do one problem in ICI module so that you will get better understanding? Let's do 7th problem in institute material. Helpage is a charitable trust set up on 1st April 2010 with the object of providing relief to the poor. Later on, in April 2012, it changed its objects to medical relief. So when it was formed, 1st April 2010, correct? So at that time, objective is relief of poor. When it changed its objects on 1st September 2012. So the objects was changed. What is the objective? The objective is to provide medical relief. Again, it applied for registration on 1st April 2013 for 12AA. That means during this period, there is no registration under section 12AA, right? As there is no registration under section 12AA, no exemption can be claimed under section 1112. No exemption under section 1112. That means what? It has paid taxes during 1st April 2010 to 31st March 2013. From 1st April 2013, it took 12AA registration. So it is eligible for exemption under section 11 and 12. Exemption under section 11 and 12 is on 1st April 2024, Helpage got merged with Poor Aid, is not eligible for registration under 12AB or approval under section 1023. So what happened on 1st April 24? Helpage merged with Poor Aid. See, Poor Aid is also another trust, but is it registered trust? No, it is unregistered. So when one trust gets merged with another trust, okay, another trust which is not registered, in such a case, like it is required to pay exit tax. I told now in 3 cases. Now Helpage registered trust under section 12AB, it is getting merged with unregistered trust. As it is getting merged with unregistered trust, it is required to pay tax on accreted income at the rate of maximum marginal rate. So assets were given: land, immovable property. What will we consider? Stamp duty value or fair market value, whichever is higher. 1st September 2010, that means before 12AB registration. So if any asset is purchased before 12AB registration, that should not be considered in calculation of fair market value of assets. Next, 1st September 2013, stamp duty value or fair market value, whichever is higher. That means we will take 120. Shares, quoted shares. For quoted shares, you need to consider average price. 320 plus 300 divided by 2, 310 shares into 5000 shares. How much? 5000 into 310. 15,50,000. Next, 2000 preference shares. What you need to consider? Fair market value. For any other asset, you will consider fair market value. 2000 into 180, 3,60,000. Next, book value of liabilities 120 lakhs. Corpus fund. Corpus fund is like share capital, right? Share capital is not treated as liabilities. That should be excluded. Another important point. Here, fair market value of all assets minus liabilities, right? While calculating liabilities, you should exclude corpus fund. That means corpus fund is not a liability. Provision for tax is also not a liability. See, generally provision for tax is liability, but for calculation of accreted income, provision for tax is not a liability. Next, if any reserve is there for dividend, that reserve for dividend is also not a liability for calculation of accreted income, and reserves and surplus are to be excluded. Reserves and surplus is also not a liability. Next, provision for contingent or unascertained liability, that is also not a liability for the purpose of calculation of total liabilities. Are you able to understand? So all these items you should exclude. So whatever the items are there, all these you should exclude while calculating liabilities. So here liabilities are 120 lakhs. From 120 lakhs you should exclude corpus fund, because corpus fund is not a liability. 12 lakhs you will exclude. Next, provision for tax, it is also not a, generally it is a liability. For calculation of accreted income, it is not a liability. Next, reserves and surplus 18 lakhs. After you reduce all these three, 120 minus 12 minus 8 minus 18, 82 lakhs. So your total liabilities are 82 lakhs. Now shall we calculate accreted income? Accreted income. Fair market value of all assets. So immovable property you will consider 120 lakhs, right? Land. Next, quoted shares. How much you will consider? Quoted shares 15 lakh 50,000. Next, unquoted shares 3 lakh 60,000. So how much is fair market value of total assets? 1 crore 39 lakh 10,000. From this we are going to reduce liabilities. We have calculated liabilities na. While calculating liabilities, we should not consider corpus fund, we should not consider reserves and surplus, we should not consider any reserve for dividend, we should not consider provision for tax, we should not consider provision for unascertained or contingent liabilities. So we have calculated na 82 lakh rupees. So how much is accreted income? 57 lakh 10,000. On this accreted income, tax rate applicable is MMR, maximum marginal. So 34.944%. How much? 19 lakh 95,302 point. So this is the tax that they need to. Now let us check the answer. As no one is there to tell me the answer, what can I? 19 lakh 95,302 we got, rounded off to a previous multiple of 10, which is nothing but 19 lakh 95,000. So dear students, this is the concept of trust taxation. I hope you understood this revision very well. If you like this, please share with your friends as well. Thank you very much. Let's meet tomorrow with